introduce yourselves and kind of how you got into capital markets and what your field within that was and what markets you traded and maybe what was your favorite and what was your least favorite, if that works. Do you want to start, Talon, and then we can go to Betty?
Yeah, sure. Hey, everyone. So yeah, I got into markets. It was kind of funny. When I was at university, I went to the library once and I got a video out, because back then it was videos. And I watched the Chicago, I think it was the pits in Chicago, some crazy trading going on there. And I thought, geez, that looks really fun. That sounds like something I'd want to do. Even though I have it's typically very soft-spoken, I don't think I would have actually survived trading in the pits. But I was really drawn to the kind of type of maths that was used in, financial markets, and I'm very quite a competitive person, so I thought this would be a good thing to explore. And when I left university, I'd done a master's in financial maths, so I quite sort of by chance ended up getting a job in the power markets, and I didn't even really know about the power markets. They kind of exist in a way that most people don't really know. You turn the lights on, you expect power to arrive, and you get cranky when there's a power cut. But basically, you don't realize actually how much financial, really complex and really awesome financial market infrastructure is going on to deliver that to you in the lowest cost possible way. So I got into the power markets. I loved them. I learned a lot. I saw a lot of change during the time that I was in them, because I was trading pretty much pushing 15 years. My favorite market to trade was probably the weather derivatives. They are just mental. I mean, the power markets at the time I was trading them were, I think, the most volatile markets in the world, and they were pretty crazy. And then I met the weather crew, and I thought, wow, they was just, storm chasers turned financial markets experts. And, obviously weather is highly dynamic and highly volatile. So, that's my background. That's my favorite market. But I obviously now love crypto and DeFi.
That's really nice. So I'm going to go next. First of all, thank you for having me here today. It's really nice to be here. So my name is Rafaela. I'm from Brazil, and I'm from the countryside of Brazil, and I went to São Paulo to study business. And I think that my college in Brazil has a very strong background in investment banking. So everybody that goes out of there, or most of the people, go to investment banking careers. And so I kind of did that too in the beginning. So I went to several different areas in the financial system in Brazil, and that would be sales and trading, and then family offices, and then I also went to back office one time in a hedge fund, and then trading desks in an investment bank, in the largest investment bank in Latin America, that is called Itaú BBA. And there, I was living my dream, which was I was working at the trading desk at that largest fund, largest bank, and we were trading their credit and structure products. And so I thought it was amazing at the beginning, but as time passed, I got a little frustrated with the technology of the bank and how things were executed and done. You might need 5 to 10 people to close one ticket from different areas. And so that got me very frustrated, even though I still loved credit and structured products. For instance, I think that my favorite market would be CDSs and bonds, like sovereign bonds. I think that's really nice. It was my favorite thing when I was at the bank. So when I left the bank because of that, because I thought that technology was still pretty archaic back then in the banks, and so I left to find out what would be the technology that could actually help that infrastructure be better. And then I found blockchain and crypto, completely fell in love, and here I am now.
Nice. Thank you so much. So even in your introductions there, you guys have touched upon a couple of what seems to be different types of derivatives. So could you maybe explain what differentiates the different one derivative product from another, and how would you even know that you kind of need one, and how would you go about getting them? Whoever wants to start.
Yeah.
I don't mind. Yeah, sure. Okay, so I'll just say, what I think the thing about derivatives is they're basically an agreement. They're to trade out a risk that you have. So say you are subject to some kind of financial risk, and we live in a world where things change all the time. So supply and demand is changing, meaning prices of things are sort of inherently changing. And basically derivatives allow people to smooth out that crazy price movement by locking in sort of prices ahead of time. And really, when you boil it down to, actually, I think David, who's speaking next, Alquan, he always talks about like trading promises. You're sort of saying, okay, it's not just the here and now, let's swap some cash or some money or some assets. It's like, it's what's going to happen in the future that I'm worried about, and all that uncertainty. And I don't really like uncertainty. I mean, humans don't really massively like it. And in fact, the proof of that is that derivatives have been around for basically as old as writing, really, or written law. I think maybe the first written derivative was recorded in the sort of Babylonian times, and it was an agricultural derivative. So, like you talk about sort of hedging corn futures. This was basically an agricultural derivative that it basically got somebody out of needing to pay their mortgage, which their mortgage payments were paid in the crop they were growing. And if they didn't, if their crop failed that year, they didn't need to pay it. And then about 1,000 years later, Aristotle also wrote about derivative. And it was a little bit more of a speculative one, where a philosopher had basically figured out or decided, I don't know how, that it was going to be a really good olive crop the next season. And so he went around in the winter and he negotiated with all the olive farmers to rent their presses and agreed the price ahead of time. And then when the demand surged, he was right. He was able to then lease those presses to other people and make a profit. So that was more of a sort of speculative derivative. So yeah, it's very, I would say it's a very base human, it feels a very base human need of increasing certainty.
So but could you expand a bit on the difference? So there's a difference between needing a derivative and having a risk to mitigate and speculating on one.
Yeah, do you want to take that one, Raquel? I'm happy to.
Yeah, go ahead.
Yeah, I guess, how do I say this? If you have a natural risk, so you have an asset and you want to protect that asset from maybe major devaluation or whatnot, then you want a derivative to protect that asset. Whereas in the olive farm example, the olive press example, he didn't have an asset to protect. He was designing something because he had a particular risk appetite and a belief, and he wanted to express that belief in some way or another. Perhaps you could say he was hedging his need to have money to support his family or something. That's a more sort of typical speculative example.
No, that makes sense. And could you could you talk a little bit about the different types of derivative products?
Yeah, of course. So when you're talking about derivatives, you have like all different sorts of things that you can do. So you have forwards, you have futures, you have options, you have swaps. In each one of them do something kind of different. And most of the differences are like, I would say, in cash flows as well. So in how you trade and what is the underlying asset. So for instance, what we do at pods are options. And essentially what an option contract is like, I want to try to say that in a very easy way. So it's like just a contract that you do with someone else that allows you to do something in the future. You have the optionality of do that or not in the future. So it's like when you buy insurance for your car, you have the optionality to use that insurance in the future or not. So an option could be seen in a kind of the same way. And like each one of them has like different ways of pricing and actually executing in the market. So if you think about like options have a very specific way of being traded in traditional finance, and this is like at this point completely different than DeFi at this point. And some people may even look at options in DeFi and say that they are not even normal options because they are not. They're very different at this point. So, Tamara, do you want to?
Like, what makes it so different?
Okay, so one of the things that you can think of DeFi is that it's completely transparent and like decentralized. And in order to be decentralized, you have to make sure that you're not going to have a counterparty risk. So you're not going to end up not having the collateral or the margin to offer to the other part. So you require the one side of the trade to put up 100% collateral or 100% margin. And for instance, in traditional finance, this is almost bizarre because it's not how they work. Normally, they work with like 10% margin or even less, depending on what is your type of like account inside the exchange or the clearinghouse. So what we do here is like 100% collateralized options. So there is not real leverage on this. And this can be very capital inefficient on the perspective of allocating capital. But I don't want to get too complicated. If this is going too fast, let me know. But so DeFi needs to have at this point 100% collateral, which is not very effective for traditional finance. But it still allows someone to agree on the optionality of exercising a right in the future, which is interesting. It's like the beginning of derivatives in DeFi, I would say.
So that kind of touches a little bit on something else that I'm wondering, which is why have we seen such an explosion and growth of derivatives, not just in crypto, but in general? Is it because crypto markets are so volatile, or is there, I mean, of course, there's more uncertainty in the world right now for reasons I don't need to mention, but even pre-pandemic, it was just an ever-growing market. Why is that?
Okay, Tim, do you want to take this one? Do you want to start? No? Okay, so I would say that at least in crypto and DeFi, like the tools for doing that are being born right now. We're just starting with that right now in DeFi, I would say. So I think that's why the interest in this area in DeFi is growing, because now it's actually possible to do that. Before it wasn't. And I would say that even if it's possible right now, it doesn't mean that we are actually attracting like people that were trading derivatives in Deribit, for instance, or other crypto platforms. And also, like, I would say that it feels a lot like you could even seeing this as like since there was not too much liquidity happening on those places. People that understand derivatives saw that there were spreads and they could arbitrage those spreads, so they started like looking into this more carefully. And probably there was also a macro situation related to this. If Tam wanted to take this on.
I was actually curious, are you guys talking about just the crypto world, or are you talking about just globally generally?
Globally and generally.
Oh, right, yeah, cool. Yeah, sure. I can't speak too confidently to that, except to say, like, I've watched, say, like the growth of index equity options in India, for example, and I think that's my sense of this is that the people in general are becoming more financially literate and more able, perhaps through sort of internet finance and web-based kind of access to exchanges and so forth, to understand and participate in the financial markets. But yeah, that would be my sense of things, and I don't really have too much more to say on that. I'm not a sort of expert in sort of the global growth of all the different markets, but it's definitely been something I've watched. Like, for example, SMEs, there's been a huge growth of, small, medium enterprise over the last decade, and small, medium enterprise has a lot of risks in their business, processes, and these risks are not things that they are necessarily, it's not their core business. If you're growing coffee or and you need to export that coffee, you don't want to have, the concern about the sort of economics of the whole world and what kind of exchange rate you're going to be dealing with if you're receiving an alternative currency just isn't about where your expertise necessarily is. And so I think with the growth of SMEs, we're also getting a growth of derivatives adoption and usage. Although sadly, SMEs are still charged something like 40 times what an investment bank might be charged for trying to do the same derivative. I think, Raffaella, you saw this actually in your
so that kind of brings me on to something I wanted to ask. So for example, I studied in the UK, but I got my student loan from Norway. But when that was calculated, the currency exchange was set, like the kroner to the pound was set at a certain level. And then it actually dropped 40% by the time I had to pay. So, like, for example, that would be a risk. But I mean, I'm not an SME, but as an individual, like, could I have gotten a derivative or insurance for that somehow?
Yeah, I would think so. Definitely, that's exactly the kind of forward risk that a derivative is really just perfectly good for hedging. And by hedging, I mean protecting you from that movement so that you stay whole no matter what. And there are different ways you could have done that actually, but as Raffaella talked about earlier, you could have bought an option that gave you the right to lock in a specific exchange rate if you could have sort of decided what the worst exchange rate you could handle was. And bought that. You might have had to pay a little bit of upfront money for that, and then in response, you would have had that guarantee, the worst exchange rate you get. That said, I say all of that is theoretically how you should do it. Where you would actually get the ability to transact that at a decent price is debatable. There are sort of retail exchanges where you could do something, but you'd have to look quite carefully that you weren't going to say get closed out. You'd have to look at the leverage that you were taking and just make sure that your hedge was going to be there for you at the end of it.
Because you talk about, and I know also, from Marx, you talk about finding a price. Like, how does that actually happen? And when you say that something is more expensive for SMEs than an individual, like who sets those prices and who sets the fees?
Yeah, really great question. And there are so many different ways that derivatives trade. There's all the way through from direct, like you call someone and say, I mean, in your example, had you been able to call someone who had the opposing problem, maybe another student that was worried about going to Norway and was saving in British pounds, and you guys could have sort of agreed a side deal, and that's a derivative, right? And said, okay, we're going to agree what exchange rate we're going to lock in. So there's sort of direct sort of peer-to-peer trading. There's markets like the over-the-counter markets that you're often heard talk about, OTC markets, and these markets are a form of that kind of direct trading, but often also broked. So have brokers that facilitate between banks and individuals and businesses who might want to trade it quite standard, like they've pre-agreed a sort of standard type of contract or type of derivative that they want to trade. And then there's also exchanges like, the CME, for example, and, a whole bunch of global exchanges that also list products or contracts, derivatives contracts, and they're tradable on that too. But I was thinking back, actually, the reason I laughed when you asked that was back when I started trading, the way that I would get a price, I was trading swap contracts, and there was a broker. There were brokers in the markets. And the way I would get a price was I'd have these speakers, these kind of big speakers that would sit on my desk, and I had they're called swap boxes, and I had about 8 of them. I had brokers shouting down at me all day, every day, telling me their prices, and they They would also get a screen on Reuters. They would sort of rent some space on Reuters, and they would put their prices, and so I could see their prices. And when I wanted a price, I would press the button, and I'd go down to them and I'd say, "Hey, I want to take that price, or I want to give that bid, or whatever." And the broker was essentially like a matching engine. They were the ones deciding who got the price, and sometimes they'd be like, "Oh, no, that price is gone," or and they had kind of full discretion over whether I got the price. And if you got really cranky at your broker, it was a big deal, but you'd pull their line. You'd literally pull out the plug and say, "Right, you don't get into my business anymore," and you'd throw a little tantrum. But yeah, it's kind of funny. That was how prices were done in the sort of early days of the power markets, and then the exchange listed contracts, and then that was sort of more transparent, let's say. So, way.
I have a question. Good question. How do you think that this is going to change? When you were talking, I had the impression, and I also remember from the things that I experienced in my life, that it was pretty much siloed. Like the U.S. market, Brazilian market, UK market, and then you have those brokers that are sometimes doing it, like the connection between them. But it feels that like we're moving into a very global technology world where you're building this infrastructure. How does the figure of that connector in those like price discovery mechanism change in your perspective?
Yeah, it's a good question. I think different markets suit different price discovery mechanisms. So some markets really suit, say, auctions. So like you might have like I think Chicago Booth academics did some really good research on looking at which price determination methods, or I think they were specifically looking at auctions actually, like how fair that was compared to like a limit order book that you'd find typically on an exchange. And I suppose the less liquid derivatives markets would, the sort of voice broked or the auction price determination methods could work quite well. And I suppose the equivalent, a global equivalent of a voice broked one might be some kind of, global RFQ market, or, some sort of, like less liquid determination method than a limit order book, which is what you typically see on an exchange. I think that all these price determination methods, I think the markets need to be able to choose the price determination method that works best for them. And actually that's the model that we've gone with at Vega. And so we have, we'll be launching Vega with both a limit order book and auction mode, but also, looking at, thinking about AMMs down the track and other different price determination methods. And we're building it quite modular for this reason, because I think it really depends on the market, and markets can change over time as well. As they can start liquid, or they can go through periods of illiquidity and liquidity.
Yeah, interesting.
Yeah.
Cool. So just to bring it a little bit back in to our 101 session. So now, so say that I, as an individual or an SME or a larger corporation, have acquired a derivative. How do you kind of know that you have it? Do you kind of get ownership of it? And can I, like, for the ones that have an expiration date as well, could you resell it, or like how does this work?
Do you want to talk to this, Rafa, or do you like me to?
I can talk definitely about the DeFi world and how that works. And then maybe Tamlin can talk a little bit about the traditional finance, how it works. So in DeFi, especially with us, for instance, if you buy an option, you have it in your MetaMask. Like you have the ownership of that right, and you can take it anywhere you want. And then in the future, if you want to, you could resell it. You could maybe put it back to the pool where it came out. And then you could also keep it until the expiration and then maybe exercise it or not. So you basically can see it there. And there's a price associated to it, so you can basically track it very easily with your MetaMask. Now, with traditional finance, it's a little different.
Yeah, well, actually, traditional finance, I mean, derivatives are often, and I may have even used the terminology earlier in the chat, often referred to as contracts because, there's this agreement, this promise, but how do you know that that person is going to turn up? I mean, with your student loan, if you'd matched off with someone in England, but how do you know that they're actually going to fulfill that and agree and not just leave you stranded? And so in traditional world, there are contracts that govern it. It really depends on the way that you're trading as to what type of contract. But for anyone who's interested, it's worth checking out like the International Swaps and Derivatives Association, ISDA, and that is a industry body that has helped establish sort of a generic contract template, let's say. And then like when I was trading and a participant wanted to trade with me, I would pre-negotiate this ISDA contract agreement, and then after that, and it would define the contract and all the obligations in it. And then after that, we could very quickly and easily, the broker could match us up, like I was talking about earlier, very quickly and easily. And then, of course, on exchanges, you have essentially the rules and the mechanisms of the exchange, and you essentially have contracts with your clearing broker that talk about everyone's respective obligations.
Would your relationship with the broker affect that?
So the relationship with the broker definitely affected how good prices I would get.
Yeah.
yeah. But no, once the deal is done, actually, what would happen is that we would get onto a recorded line, and then we would confirm the deal, and he would tell me who I've dealt with because I wouldn't have known at that point. And then I'd have to write out a deal ticket on carbon paper. I'm going back 20 years. And then I would, sort of tear off one bit of it, and then the risk department would pick it up and take it to the middle and back offices to sort it out. But what those middle and back offices did was process and fulfill the obligation and make sure that the other side was fulfilling it. So yeah, that's sort of how it works typically in the traditional world. You can also just have contracts that are bilaterally agreed, and especially some of the more complex structured products. I think some of the contracts that I negotiate are just hundreds of pages because they're all about if, this power plant comes online at a time when the weather is this and the gas supply is this, and there's all very complex kind of triggers that were going into the the optionality of the contract. So that would take sort of extensive and bespoke contracts.
So something that you touched a bit on there is, fulfilling the counterparty here. So, because of course, part of what can happen is that something that you I don't want to say that, but something that you predicted or hedged yourself against can actually happen. So if that happens and I'm owed money, like how do I know that? And how do I get that? And is there a fee on that? And how do I know that they're going to honor that? And it would be great as well to understand that from both a DeFi perspective and a traditional perspective.
Yeah, sure. Well, I'll just cover it quickly from traditional. I mean, there's obviously the sort of last resort is to take an entity to court and say you owe me money, and obviously that's expensive and undesirable for everyone. So what people tend to do is try and put in a lot of sort of things in place to try and prevent that. So one thing that they'll do, and this is what credit rating agencies are good for, is they help you understand what the counterparty risk, like how likely your counterparty is to default. And so then part of your middle office and risk department's job is to be continuously assessing the composition of your credit risk. Like, actually maybe it's better for you to not only trade with the one entity, because if they go down or something bad happens to them, all your contracts are, they're in a bad place and you're going to have to fight for the value. So yeah, sort of diversification principles obviously apply. And on exchanges, what exchanges do is they basically, and there's a similar mechanism can be done in the OTC world as well, and doing swaps. But basically the idea is to say, like, on the day that we dealt this trade, it has a fair value that we both agreed. Now, the next day, maybe the price has moved, It's not the same price anymore. So 1% of the trade is what we call sort of out of the money, or they're losing money on this, as in they've sold something that is now worth more. And so what an exchange will do is, first of all, it says, okay, there's a potential we don't know on the day that you.
She left the stage.
Oh, I think maybe she lost connection.
Yeah, I think so too. Well, do you want to talk a little bit about how you would do this in a decentralized way?
Totally. Well, she was just talking about something super nice, which is marking the positions to market and then having to put up more margin as collateral. And this is completely connected to what I was going to say around DeFi, because in order to, in traditional finance, one person or one exchange is able to require more margin for someone. Oh, she's back.
I could hear you guys the whole time. I think I messed up with the link that I joined with, so apologies.
No worries, go ahead.
Oh, sure. I'll just very quickly finish then. So the exchange will go, okay, price could move and we don't know, so we're going to charge you an initial margin. So you're each going to put some money in, and it's sort of held in a, like, let's call it an escrow or like this account. Actually, the exchange holds it. And then the next day, they figure out who's winning or losing, and then they do what we call mark to market. And so they will take the person who is losing, pays basically the amount that the contract has changed in value into this pool, and the person who's winning kind of gets a little bit of credit to their account, broadly speaking. And so what they do is they have very sophisticated risk models to decide and figure out how much can this contract move in a day, and then not just this contract, but all the contracts you're holding, because people will often trade a portfolio of instruments on an exchange, and so it's not just this one contract might move, but your portfolio, how much will it change, how much risk because for an exchange they are acting like a central counterpart, as in they are the ones. So if I did a deal with Rafaela, and you're the exchange, Christina, we've actually both dealt with you. Like, you're actually we call novate the deal, and you're actually guaranteeing this trade. And we don't even know the identity of each other. And so it's actually you that bears the credit risk. If I disappear, you still have to, pay Rafaela. So, it does make for a really fun challenge in DeFi. But I think we're really excited because we feel we've designed a way to run really sophisticated risk models on chain and offer the same, even better capital efficiency than you get in centralized markets. So, more on that later. But
Could you just give a nice definition of what does it mean to be capital efficient?
It's a good point. It just means you need to. It's not quite being cheaper, but it's like you need to deposit less. So those deposits where I said the exchange charges initial margin, you have to put deposit on. It doesn't mean that you're going to necessarily lose that money, but you have to have the money and put it on hold, and you can't go and use it somewhere else. And the extent to which you can use your margin elsewhere depends on the exchange.
Okay. That was good. Thank you.
Yeah. It's how expensive it is to sort of do the deal for the trader.
Okay, cool. Do you want to talk a bit about how this is done or return to what you were starting to talk when Talon disappeared?
Yeah, of course. So Talon just described how margin requirements work in traditional finance. So that the two sides of the trade has to be like looking at their positions and then maybe adding more margin. In DeFi, this doesn't happen at this point because it's really hard to. First, you don't know who your user is. You can't track them down. So second, there is no way I could allow try to send them a message and hope that they will come back to put more margin if they need to, right? We just can't do that because otherwise there is no way we could back the other side of the trade. So I think that a little differently from what maybe Vega is doing, which is being decentralized counterparty, we are actually letting them trade between themselves. And in order to do that, at this point, you have to require 100% collateral initially, which is actually terrible for capital efficiency. Because as Timlin said, that you have to let your money park there and wait until expiration before you can do anything with it. So one way to reducing that capital inefficiency is to actually allow that token that is parked there to be an interest-bearing token, so that this token is generating interest on itself. It's like if you have a bond inside of that, you know. So this is just a way to, you know, get back a little bit of that, but still is inefficient.
No, that makes sense. So when you say, you know, derivative almost.
You could think of this as a kind of a structure product on the seller side, because you add like a bond, which is this interest-bearing token, and that could be, in our case, is a token, meaning the token from Aave that was supplied as like lending. So you have this A token inside your option, and then you mint that position, and then you sell it on the market. So what you have is an interest-bearing token with the possibility of being exercised on a certain strike price and an underlying asset. So that is like a package of a position, basically. You could think of that like that.
No, that makes sense. Thank you. So for people who are actually, something I want to ask about as well is just the risk that comes with trading derivatives, and you know, you often hear about people trading with a higher risk appetite than they perhaps should have. What are the kind of rules or guidelines or something that you'd recommend to people who are just starting to getting into this? And also if there's like any resources or favorite things that you guys would recommend.
Okay, I could suggest one thing from start is that trading derivatives in traditional finance, as we said, is very different at this point from trading derivatives in DeFi, but still both have risks. So I would say that if you're just starting, especially in the case of options, don't sell an option at this point. You can buy options as many as you want, but if you don't understand it very well yet, don't sell it. And research more, understand the risk that comes with it, understand what is exactly the position that you're trying to do, and what is your intention with using this tool. Because remember, this is a tool, right? You're going to use a tool to build something, to do something, right? And know what is it that you want to do out of it, so that you can choose what is good for you. And study a lot, I would recommend. I don't know, maybe try to talk to someone that also understands about this, so you can, you know, sanity check what you're doing. I think it would be a good start, and being very careful about selling options, I'd say.
Yeah, I was going to say definitely a strong focus on risk management. You know, traders in the traditional world are typically really good at risk. They understand how to think about risk. They look at all the possible outcomes from this.
Hello.
50.
So welcome to our next session, which is the presentation by Dr. David Siska on how to price and risk manage derivatives and teaching mathematics at Edinburgh University, more specifically mathematical finance, stochastic controlling games, stochastic partial differential equations, and theory of machine learning. He's also a member of the founding team and lead quant at Vega. And if you don't understand what most of those things are, don't worry, neither do I. I think we will learn more now. And if you have any questions during the presentation, please write in the chat and we will get or David will reply. Thank you. And I'm going to have today.
Thank you, Christina, for the introduction. So when Dagan said, I'll give a comprehensive talk about pricing and risk in 30 minutes, I was thinking that that's quite ambitious, but nevertheless, that's what I'm trying. Of course, you can spend then, well, as long as you like, really, on making these things more general, more complicated, and more correct. And, people do, and they spend their lifetimes doing that. But we'll see what we can do in half an hour. So what I'll talk about is just a little bit of what you've heard in the previous talk about futures and options basics, and then I go to actually how you price these, and for that you need this big assumption, which is an assumption of no arbitrage. We'll talk a little bit about that. Then we construct a no arbitrage argument, which quickly gives you price for futures. And then we move to pricing options, which is in a way a lot more exciting, because for options you always need a model. And the models can be very complicated, and we'll get to the complicated ones as well. But the simple one, really, I would like you all kind of, to say, okay, I know how to price an option binary tree model. It's actually not that hard. You have to solve two linear equations. So, after this talk, you will be able to say, I know how to price options. And then if time permits, I'll talk a little bit about risk and how it's all related to what came already and what will come later. So first of all, a derivative is effectively any financial asset where the price is derived from one or more underlying assets. So think of a future or an option where the price directly depends on an underlying, or you can think of other derivatives. So for me, it's really important, which Tamlin already said, that a derivative is a promise, and when someone gives you a promise, you have to trust them. So you have this thing called counterparty risk, which is the risk that, whoever gave you the promise actually won't have the money, in this case, when the time comes to pay up. And, part of the reason why we had the 2007-2008 financial crisis was because a lot of institutions forgot about counterparty risk. So they had, all their managed derivatives positions. And then when things started going bad in one sector, if one bank goes bad and then they can't keep the promise to you, then that means, you also go bad. So counterparty risk is quite important. So, of course, there is a whole zoo of derivatives. Today we'll focus on futures and options, but then there are, contract for differences, there are interest rate swaps, credit default swaps were already mentioned earlier, there are credit default obligations, and then many, many more are being invented because, different risks can be managed with different derivatives. And each of these derivatives then comes in many flavors. So, for options, you will have the basic, what type of payoff, whether it's European style or American style. Each of these can be call and put. And then, Asian is a little bit how the underlying goes in, whether it's at a single point in time, which is what happens in American and European options, or whether you do a bit of averaging, which you might want to do. And, a lot of possible options. The nice thing is that there are certain basic principles which make all of these work the same, and we'll look at some of those. So probably most of you know what a future is. I'm going to repeat anyway. So it's a promise where one side promises to buy an asset at a future date for an agreed amount. So you agree the asset, which is the underlying, and the price today, we will call it ST in what comes. You will agree the future date, which is the maturity or settlement date, and you agree the strike. And in the previous talk, I think someone mentioned payoff diagrams. So this is what a payoff diagram is. This is on the y-axis, you have the payoff at maturity, and on the x-axis, you have the price of the underlying in relation to strike. So if you think that the strike is 100, and at maturity, which is the future date, the asset actually happens to trade at 100, then the payoff is 0, because you can buy something for exactly the same price that it's trading in the market, and so it's not very interesting. But If the price, if you're long a futures position, if the price of the underlying goes up, it goes to 200, say, why then? Well, your profit is 100 because you just bought something that's worth 100 for 200. And indeed, this is kind of a basic principle in futures, and you can have cash settled futures or physical delivery futures. And quite often the cash settled do the job because you're really only interested in this difference in price. And the other diagram is the payoff diagram for a short future. And the fun thing about short futures is that your potential loss is unbounded. So if I, bought a short future for, let's say, Tesla back in February for expiry on something like 1st of September, I could have lost a lot of money because the price for some obscure reason went up and up and up. So that's the bit about, being careful with derivatives and understanding what they can do in different situations. So being short a future can be dangerous. I mean, being long a future can also it's as a mathematician, I think of it, at least it's a finite number. Here I can go all the way to infinity. So that's futures. Now, options are actually not that different from futures, and we'll just modify, what we agree, what the promise was. For a future, I promised to buy it at the price that I agreed, whether it was a good deal for me or not. An option, I'm buying the right to buy the asset, but I don't have the obligation. That's for a call option. And for a put option, it's sort of the other way around. I'm buying the right to sell the asset, but I'm under no obligation to do it. And you see, here are my payoff diagrams. So if I buy a call option, once I've paid the option premium, my payoff is always positive. At that point, either I get nothing if the price goes below the agreed strike, or here I can get potentially unbounded positive payoff. And for a put option, again, if the price goes above the strike, I get nothing. But if the price drops to below the strike, I'm getting my payoff. So that's all good, I bought the option. I had to pay the premium, which is the option price. We'll get to option prices in a moment, and then I can only win. And as they mentioned in the previous panel, if you sell an option, what you basically do is you will flip these charts along the x-axis. So it will be the same, but now it will go down, 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 and again it's unbounded. So if you sell a call option to someone, you collect the premium up front, but you're opening yourself up to a potentially unlimited loss. So that's quite a dangerous thing to do. So that's options. So let's talk a little bit about, how can we price these derivatives? So the first thing to understand is the idea of an arbitrage. So, there are more precise definitions of arbitrage than this, but the idea of arbitrage is that somehow you're making riskless profit by trading in the market. And, the most basic arbitrage is, you can make the trade and you make a profit, but, there are more subtle forms of arbitrage where you say, well, I've got this trade, I have a positive probability of profit, and I have zero probability of making a loss, right? So I can make the trade, I can try it as many times as I like, and eventually I'll win. That's also an arbitrage, but not as strong as saying I make a profit every time I do this trade or this sequence of trades, because typically you need to do a bunch of things. For example, buy something on one exchange and sell it on another exchange. Right, and then all derivatives pricing is done with this crazy sounding assumption which says that there are no arbitrage opportunities in the market. And of course we know that's not true. There are arbitrage opportunities in the market, and there are a lot of people keeping themselves busy trying to exploit these arbitrage opportunities. And as soon as they discover it, the prices move in reaction to them trading, so they close the arbitrage. And the idea is that typically these get exploited so quickly on the time scale of seconds then when you're thinking about derivatives that have time scale of months, the arbitrage doesn't matter. If you go back to thinking about the short time scales, then you might have to start thinking about arbitrage again. So once you sort of digest the no arbitrage assumption, it gives you two related ways to think about derivative pricing. So the first observation is if there is no arbitrage, then it immediately follows that two assets with the same future cash flows must have identical price today. And the other thing that follows, and it gives you another way of thinking about derivative pricing, we'll have a look at using both, is that, you know, imagine I put some derivative contract to trade in a market. So I start with a market where just the underlying is trading, for example, the price of oil, and I claim that there is no arbitrage in the market. And now I say, right, well, let's put an options contract on oil into the market. Well, if there is no arbitrage, then it must have a very specific price, and that price is the one that does not introduce arbitrage. And both of these ways, that they're related, but they can be independently used to establish what the price of a derivative should be. So no arbitrage. That's the workhorse. Without it, everything falls apart. So let's have a look at futures. So remember, futures contract is where I agree to buy something at a future date, which is capital T, for an agreed strike, which is capital K. So let's say that I sold a long futures contract. In other words, I agreed to be the one who delivers the underlying asset and receive the strike amount. So how can I replicate the payoff of a futures contract? Because once I've replicated the payoff of a futures contract, I go back to this 1.1 and say, well, if I've got a portfolio which exactly replicates the payoff of the futures contract, then the initial amount that I need in this portfolio must be exactly the price of the futures contract, because otherwise there would be arbitrage in the market. So let's construct a portfolio, and we're working in a very naive world, because otherwise all the reasoning gets very difficult. So we just say, well, I can borrow the money from the market. I can borrow money from the market as much as I like, and so I borrow the price of the underlying from a bank. So let's say the underlying is 100 today, so I borrow 100. Now I go to the spot market and I spend the 100 and I buy the underlying asset. And then let's see what happens at time capital T. Well, at time capital T, I deliver the asset, that's gone. I receive K, and I have to repay the bank, right? Otherwise, we're working in a simplified world, but not completely crazy. It's crazy to say that I can borrow an arbitrary amount, but it would be completely mad to say that I then don't have to repay it. So I repay the bank, and there is this exponential with R, which just says, well, there is some interest rate. The time went from little t to capital T, and with some interest rate, I have to repay the bank a little bit more, if the interest rates are positive, which is not a priori a given. Right, so what does that give me for the price of the futures contract? Well, at the time of settlement, I've received K, and I paid what I borrowed with interest back. And then, of course, an equivalent to get this amount of money actually at time little t, I just multiplied by what's called a discount factor, which just tells me how to take the interest rates back, right? Because if I've got this amount at time little t, then over time, because of this interest rate, it will actually grow. It will actually grow to be this amount at time capital T. So I arrive at this point, and I say, exactly this is the price of my futures contract. That's the fair price. And if you throw away the interest rate, if you say that the interest rate is 0, you will see that it's exceedingly simple. The fair strike for a futures contract is just the current spot price. So the one interesting thing here is, from a modeling or mathematical point of view, we made some assumptions. We made assumption of no arbitrage. We made assumption that we can borrow and lend money at the same interest rate. We even made an assumption about what interest rate look like, right? We said that they are continuously compounded with constant interest rate. But one thing that we didn't need to do is to have a model for how the underlying asset behaves. We didn't need anything complicated, no trees, no stochastic differential equations. There's no arbitrage argument would work, no matter what the underlying does. So that's futures price from no arbitrage argument. Now, can I just check that I'm not talking to myself, that the connection didn't die? Can I have someone ask a question or something? I'm going to go back to this, and I'm going to see a chat if there are any questions. Okay.
We hear you.
Good. Would anyone like to ask any questions?
You're just getting compliments. So
Question would be nice. Come on, guys. It can't be all that straightforward. I was going quite quickly. Okay, so maybe we'll have.
So we have a question here. How do you price futures when you can't hold the underlying, for example, with power? And then a second question is, can you explain the difference between an option and a future contract?
Yeah, so to answer Tamlin's question, if you can't, well, okay, so if you can't hold the underlying, I'm actually not sure. You could quite easily generalize the argument that we had here to include something like storage costs. So, maybe you have to actually, it's not a piece of paper that you buy, it's really barrels of oil that you buy, and then you could throw storage costs into the no arbitrage argument and everything will work the same. If you can't hold the underlying, I don't know, Tamlin, you traded power futures, so you might have to tell us either now or later. It's interesting, never thought of that. And I'll go to explain the difference between an option and a future contract. So we go to futures. For a future, you agree to buy the asset at a future date for an agreed amount. And that's it. So I can agree to buy, I don't know, Bitcoin in December for $10,000. And, $10,000 sounds a little bit cheap, so probably I will have to pay someone a little bit of money to enter that contract with me. But after that, if Bitcoin goes up, let's say to 15,000, then I win $5,000. And if Bitcoin goes down to $5,000, then I would have lost 5,000. I'm out of luck. For an option, it's very, very similar, but I have the right to buy, but not the obligation. So if I have an option to buy Bitcoin at $10,000 in December, and Bitcoin in December is actually trading at $15,000, so I'm somewhere here on this diagram, then I say, great, I've made $5,000. But in the opposite case, if Bitcoin is trading at $5,000, I say, oh, well, I've lost the option premium, but at least I didn't lose the remaining $5,000. So that's the difference. For a future, you have to go ahead with the trade. With an option, it's an option. So no obligation, right? But no obligation. Right, so let me carry on. So if you were to trade futures on an exchange, they would typically trade, so the numbers on the price you would see on a futures exchange is this fair strike, which always makes entering the contract worth 0 when you enter it. And it's given through this formula. And again, if you throw away the interest rates, it's just that the fair price is exactly the price of the underlying. And the contract is worth 0 when you enter it, but of course it's on an exchange, so we have a margin. And I do have this example on the slides, but it's slightly contrived, and I am a little bit short of time, so I'll skip it. And we move to option pricing. So to price an option, you have to come up with a model for how your underlying moves. So maybe it's a binary tree. You say one day it goes up, then it can go down and down again. Or you do something in continuous time. So you write something which is stochastic differential equation, which is effectively just differential equation with noise thrown in. And then, there is again a whole zoo of models, and, you can make them better and better. But finally, the truth is that all models are wrong and some models are useful. So that's, always a thing to bear in mind. Every model you take is wrong. If the model captures the essential phenomena of the world, then, it's useful. If you get this wrong, then you can lose a lot of money. So let's take the simplest possible model for stock price move. So let's say we have a call option where we agreed that the strike is 100, the initial asset price is 100, so we would say the option is at the money, and I have the simplest possible view of the world that, from now to the maturity, the price can either go up to 120 or it can go down to 90, Is this a reasonable model? No, of course not. It's a model, but it allows us to do a fairly simple calculation. So the payoff of the option, how much money I get at maturity, if the price went up, then I get 20 because I exercise the option, I buy the asset for 100, I immediately sell it for 120, and I made 20 profit. So that's payoff, and U stands for up, for in the case when the price went up. In the price, when the price goes down, well, I can buy something worth 90 for 100, but I don't have to, so I'm not going to do it. So in that case, my payoff is 0. So we've got 100, which is the price now, that's a 0. We've got the price, that it could have gone up in our model, the price it could have gone down, and the two payoffs, 20 and 0. And then our aim is to find a portfolio that, if I start with enough money at the beginning and made the right allocation, then I will get exactly this payoff. So 20 if it went up and 0 if it went down. So I need effectively to find two numbers. One of them is how much of the underlying I should buy, and the other one is how much actually initial investment I need. Right, so that's what we have. We have the diagram that unfortunately now is gone, but effectively we need to choose how much of the underlying we buy, call that psi, and how much we want to borrow or deposit, which is, well, the initial amount that I put in minus all the money that goes into the underlying, which is however many units I bought times the current price. And then if I want to match the payoff of the option, then I would need to solve these two linear equations with two unknowns, and we probably all remember from school how to do that. And this is the actual calculation. I think you'll be able to do this yourself. I'm not going to bore you with the calculation. It turns out you need to buy 2/3 of the units of the underlying. So that's another assumption you have to make. You can buy fractional units of the assets, or you simply have to think, well, I sold 100 options, so this would be, 200 over 300, and I round it to the nearest unit, and it works. and the option price turns out to be 20 over 3 US dollars. So a little bit more than 6, little bit less than 7 for something that can either give me 20 if I'm lucky or 0 if I'm unlucky. So just solve 2 linear equations with 2 unknowns, and you know how to price an option in a one-step binary tree model. So that's quite nice, nothing complicated about option pricing. I wouldn't recommend going to the market with this, but it's a start in understanding. You understand the main concept because you know how to construct a replicating portfolio that gives you the payoff of the options, and because of the no arbitrage assumption, the initial investment in this portfolio has to be exactly the price of the option. One interesting thing that you would have noticed is that actually we didn't need any probabilities in the tree of moving up or down, and even if we gave the probabilities and then sort of calculated the expected payoff with some probability that we put in the tree, it wouldn't match the price from the no arbitrage argument, and we would have been wrong. So that's quite an interesting observation. And in fact, you can use this and say, well, you know, there might be a probability measure under which it's just a payoff, and it just so happens that it's exactly the probability measure which allows you to ignore the up and down moves in your underlying asset. And the reason why you can do that is because the up and down moves, you hedge away with your hedging portfolio, so you don't care for them. So if there is a probability measure in which the underlying asset is what's called a martingale, which is effectively something that has got the same expectation in the future as it has today, then that would be the probability measure in which the derivative price is just an expectation. And we can do that with the model that we have. Here I calculate the expectation with Q. Q is my probability of going up, 1 minus Q is going down, and these are the 2 possible values that I can have for ST, and 100 is the initial price. So I solve this. So under the model, under the risk neutral measure where I say I've got 1/3 chance of going up, I can then say that the payoff of my option is just the expectation under this what's called risk neutral measure. And I've run out of time. How much do I have any more time, or should I finish now, Christina?
You do have to finish now, but we have 2 questions. So first, we have a quick math questions. Say the matrix securing from the linear equation is not invertible, then we cannot replicate the option. How do we price the option then?
That's a very good point. But you chose your model to begin with, right? You wrote it down. So if you write down a model that gives you something that's non-invertible, you just say that's not the right model, and you put, you choose a model that makes sense.
Okay.
And then the second question, I'm reading it, and
I'm going to read it out loud so we have it for the report.
Yeah, please.
So, Dr. Siska, do you think it makes any sense to use index options to hedge a completely diversified portfolio? Is there a way to make them?
Hello, and we are live. Welcome back, everyone.
Right.
I have a very, very interesting panel discussion coming up for you next. So at this point in the day, you've participated in a workshop.
Can anyone hear me or see me?
Yes, yeah, you're on stage. You're live.
Oh.
Yeah? Can you see yourself?
Obviously not.
No.
Hello, test.
Yes.
Testing, yes, you're good.
Okay,
Perfect.
cool. Sorry, yeah, for some reason I thought we were lost there, but we got everyone. Cool, sweet.
Okay.
All right, we good to go?
Yeah, let me introduce. So,
cool.
Let's begin. So yeah, what I was saying, you've had a workshop, you kind of understand derivatives now, you have a basic understanding. And so now we have Abel Tedros from Abel's Abstracts, Barney Mannerings from Vega, Dan Dane from Key Tango, and Andrei Belyakov from Opium. And this will be a kind of panel discussion focused on DeFi, how it's eating the world of fintech, and how derivatives play a role in this ecosystem. They'll be covering topics such as where fintech has fallen short and why it can't innovate past distributing access to existing financial products and services, how DeFi will change finance from the ground up, the role of derivatives within DeFi, and also the fact that DeFi still has a long way to go. And so the access to DeFi in general and the risk management level that we need that comes with that. So we're going to do 30 minutes of discussion. Abba will be leading. And then from there, I will jump in the last 10 minutes and we'll do Q&A from the audience. And we have a raise hand feature. So it'd be really cool to get some of the audience to come on stage themselves with the speakers and ask questions and just join the discussion if you have a really important point or something to input. So yeah, this will be the last session before lunch and it should be a good one. Without further ado, I'll hand over to Abel.
Fantastic. Thank you so much, Dagan, for the introduction and setting this up. I'm super excited to be here and be speaking with these amazing folks. I guess a natural place to start is introductions. So perhaps we'll go around, we'll do introductions, maybe a 1-2 minute kind of introduction on yourself, and then the problem you're solving with your company. The problem you're working on, and how you're solving that with your company. So, yeah, that should be a lot of fun. And I guess we'll go Andre first, then we do Dan, and then we'll do Barney.
Hello, everyone. So the problem we're creating by our company, actually solving a problem, yes. So, hello everyone, I'm founder of Opium, and the Opium is the protocol for decentralized derivatives. And in short, it's a very flexible protocol, so you can take any oracle and any derivative instrument, which is well known, or you can make your own definition, very simple, and combine those two. So you combine any oracle and any derivative, and then you have a very traditional view like a Bloomberg. You have tickers, you have derivatives. Super flexible and everything decentralized, fully composable with DeFi, but also traditional system, because we started to build it 2.5-3 years ago, and even before DeFi. So happy to bring my expertise on this, but also I was a professional trader for 10 years of derivatives. I traded all kind of fixed income rates derivatives, and I have my views, which I will share about what is the difference, why it's important, so on and so on.
Yes, and I'm very excited to hear those views. Thanks for coming along. Definitely have a wealth of experience in the traditional finance world and also in DeFi. And I guess working on DeFi before DeFi was even a term. So yeah, very interested to hear your views there. Cool. Dan.
Sure. Hi, everyone. Dan Danai, CEO of Kitengo. Kitengo is a platform for retail investors to discover and invest in deep DeFi products. So things like liquidity pools, yield farming, all the fun stuff. The problem that we are solving is that we believe that DeFi is supposed to be inclusive. But really, if you look at the numbers, you can see that less than 500 wallets hold more than 90% of all DeFi tokens. The average borrow position on Compound is $18,000. It's clearly dominated by professionals, and we want to make it more inclusive. Happy to join the
Yes, and it's a pleasure to have you. Definitely a lot of whales in the world of crypto, and that could be put down to many different things. Obviously, complexity is a big one. So yeah, very excited to hear your views, and yeah, thanks for being on the panel, mate. Last but yeah, killer whales, yeah, that is very, very true. Yeah. Last but definitely not least, the man running the show behind Vega, Barney. It's a pleasure to have you. Please feel free.
Awesome, thank you. The problem we're solving in Vega is the problem of derivatives in a completely decentralized environment. And one of the things that is that's important to understand about derivatives and about trading in general is that things like efficiency, things like the quality of the product, being able to replicate the payoff that you want are super, super important. And with spot trading, that's easy to do. You're exchanging something straight away, so you don't have a product with a life cycle, you don't have risk management. That's quite easy. When you come to derivatives, the problem you have is that, with on-chain systems and things like Ethereum, you have computational constraints, you have all kinds of issues with those systems that make it quite challenging to have really high-quality derivatives. And so the problem we set out to solve with Vega was how to have derivatives that, when it comes to real trading, so when it comes to crypto and DeFi breaking out from the crypto world and starting to influence the real world of retail, the real world of business, that you actually could have derivatives that would be able to be used in place of kind of legacy platforms. And that's really what we're solving at Vega. And I think we've made a very good start with the first version of Vega that's in testnet now, but there's an absolute ton of work to do to get it to that point where it can really challenge traditional finance.
Fantastic, and definitely a very interesting project. That's all kind of why we're here, to talk derivatives and that having an impact not only in the world of DeFi but also traditional finance as well. So yeah, again, thank you so much for being here, and super excited to be moderating this panel. So just a quick introduction on me, very, very brief, before we start today's panel. I'm a technical product manager, and I'm obsessed with the world of open finance, trying to create an open financial system that's fair, transparent, and global. And obviously DeFi is a real opportunity to do that. So very excited to kind of be in this world and be talking about different things and building different products. I have a podcast called Abel's Abstracts. It also has a newsletter as well, where we highlight different founders and product people trying to build this open financial system, and essentially bring us to the world that we all want to live in, right? So that's a bit about me. Very, very excited to be here and be moderating this panel. Dagan obviously did a great job of letting you guys know what we're going to be talking about, but I'll just do a quick refresher on some of the things we'll be talking about. Fintech and where it kind of falls short, and how it can't innovate past just simple distribution of different existing financial services and products and stuff like this, and how DeFi could potentially fill those gaps. And yeah, essentially how DeFi will be changing finance from the ground up, and the role of derivatives within that. And also, we've spoken a little bit here about whales in DeFi and the complexities. So we're also going to touch on some of the risks, but also, some of the issues facing DeFi right now. So that's generally the structure of what we want to cover in today's topic, in today's panel. But we also want to keep it very loose. But I guess we'll start off with the first topic, fintech, and how it's kind of not able to innovate past the distribution of financial services, right? So I guess I'll talk on this piece very quickly, and then we'll open it up to the panel to talk about. But I mean, I've worked in fintech for a while. Many people know about what fintech is, so I don't think we need to kind of do a definition of that. But fintech has done a great job of increasing the access to financial products and services across the world, right? Like, there's a lot of different companies doing very interesting things in different parts of the world, but ultimately fintech is about distributing financial products and services on existing infrastructure, and a lot of this innovation is still very much tied to existing systems, which means that a lot of for example, the UK has some of the best financial services in the world. And if you go to other places around the world, that's not the case. It's fintech and finance is very localized. And, that's a real issue in that there's no one giant, financial system the same way that there is one giant internet, right? And so very curious to hear everyone's thoughts. What are your opinions on what's going on with fintech, and how DeFi can plug into that? Maybe you start off with Andre, then we go Barney, and then Dan.
Yep, sure. Thanks so much. And I like to be critical to many points, so I can challenge also something what you say. So I just like to challenge ideas. That's, I think, how we can make it better. So I don't completely agree that fintech is not able to bring the value and so on. I think fintech actually is doing a great job. The problem that we have in the traditional financial system, traditional banking sector, it is the biggest in the world. That's the biggest sector of the economy, but it's most conservative. So it looks like pretty much 100 years ago. And fintech was the first attempt to improve it, so to bring some innovation. And it's pretty cool. So I like some bank apps. I use them. I see this, but it was so conservative. The sector was so conservative. Then there is already a new technology. There is already 2 steps ahead, and we see already better solutions where there is no company. It's no central point of failure. there is mathematics behind financial instruments and services, and mathematics is always better than any company, any human behavior, and so on and so on. And that's why I'm so excited about DeFi. That's a good thing about DeFi, and definitely I'm very bullish on it. But also being critical when you have this happening too fast and you don't have basically any rules. Anyone can do anything. It's cool, but at the same time, it's not so cool for all of us. So if we have no regulation, it's not extreme. Having like hundreds of regulators, that's one extreme, which I faced a lot when I was working in financial markets. But having no regulation is not extreme. And we should just be aware of what's going on. The whales is not the biggest problem in DeFi. Oh yeah, it's natural, you know. But amount of risks that we run in DeFi, amount of tail risks, amount of leverage we run, and amount the risks that users are exposed without knowing it. That's interesting. And I will stop here. Let's have a discussion maybe about it. But that's my point, and I think. That's very important, and something like 2007 is coming. And yeah, derivatives are important instruments. We can speak later, but some derivatives create even more risk in the system. Some derivatives can completely get rid of the risk, but some derivatives, they can make it worse. So I'm happy to challenge you guys or hear your view on this.
Yeah, I mean, so that's probably going to lead us into the conversation around risk and derivatives, which I'm very excited to have because I think derivatives play a really interesting role when it comes to risk. So I guess before we jump into that, any comments from Barney or Dan on what Andrei's saying? And by the way, I love that this is kind of turning into debate. Those are the best kind of panels where you have different opinions and you kind of go back and forth. So yeah, Barney, Dan, any thoughts?
Yeah, I mean, I think, obviously, I think, it's worth being very aware of how early things are in DeFi. Like anyone who thinks that a thing that looks like DeFi looks now is what, if DeFi is successful and everyone, retail users are using DeFi, most of them will not use things that look like what DeFi looks like now. Like, DeFi is experimenting and is early. And I think that's super important to understand. Like there are some people out there who really just want the Ethereum things they're using to just be in everyone's wallet pocket tomorrow, and that's kind of chaos, and it's not actually what will happen. It's like the early days of the internet. Everyone was using text-based protocols, and there were no rules, and you couldn't make payments, and nothing was encrypted. Like that's not where we ended up by the time the internet got in everyone's phone, and it's going to be the same. Like these are tools and things we're building. But what I would say, there's kind of a gap, and the problem that fintech has is that fintech is doing things within finance first, and it's therefore stuck within finance. And what I mean by stuck is if you want to go and do something where you need to interact with the bank before you do anything else, where you need connections to credit cards and everything else, if you want to do that, you have to play by those rules, and you have to pay the gatekeepers and not upset them too much, otherwise they close your account. I mean, you put the wrong words in your PayPal transaction and they'll shut down your account. So, the problem with fintech is that the solution space for innovation is relatively small. You can build some really cool innovations and make things more efficient. You're mostly doing it around the edges, and kind of in the same way that was true. TV, when TV got technology and people started rendering, using technology to make TV programs better and to move the data around the world, it was still broadcast, it was still TV, it was still run by TV channels. Then when we got the internet and we got communication peer-to-peer, it changes everything because you have an entirely different model. And the goal of DeFi and the goal of cryptocurrency in general and this space is to decentralize and to disrupt and to allow a complete change of the way that model works. And then you can re-architect and build things that are safe for everyone to use on top. And I think it's not really about giving everyone access to Sushi Swap. It's about giving everyone access to tools that are built on this new, much more efficient, much more open and fair set of infrastructure. And I think that's where we have to go. But to Andrei's point, if we do that without being aware of the risks and building the right tools for the risks and protecting consumers, then we'll probably end up in the same place we're kind of getting to with the internet, where there's all kinds of things going on that we didn't really want to happen. And it's bad enough when they're happening just with information. You see what the problems you can have with Facebook and with fake news and all this other stuff. Like when that happens with people's money and people's livelihoods and people's bank balance, that's like 10x worse. So we really have to try and avoid putting ourselves in that position again with this kind of technology.
Yeah, I want to build up on Andre's point as well. I feel like the pace of innovation really sets apart like all fintech from DeFi. I'm a big fan of Andrew Law. He used to be my MIT professor of finance, and he discussed financial systems that are changing in the speed of thoughts. He discussed this like 10 years ago, and I think DeFi is a perfect real-world example of that. And I think even in the short amount of time that DeFi is out there, it invented those amazing concepts like automated market making, flash loans, even things like stablecoin. And I think that if DeFi continue to evolve in the pace that it evolves, it is going to hit fintech. And I'm absolutely fascinated by this idea of like natural evolution. It's almost like this social thing rather than just financial.
I very much agree with both of the sentiments there around fintech and DeFi, and you guys kind of alluded to it, all of it, kind of in your answers about the pace of innovation, but then also risk as well, right? Derivatives plays an incredibly important role in mitigating risk. So maybe we could talk about DeFi and where derivatives sit within that. I know, Andre, you have some interesting thoughts here, so maybe you could start off, and then we can dive.
Sure. And I first gonna disagree a little bit with Barney about that the fact that it's gonna go 10 times worse. I think it's gonna go a million times worse. So the same thing is gonna happen with your bank account. So you're not gonna be very happy to losing $50, but if you lose all your or half of your money, probably it's gonna be disaster. And I only pray that this financial crisis, which is coming, let's face it, in DeFi, it will be not big enough to destroy the belief of the people, the system. But I think the break-even point is already passed, so it's going to be fine. Talking about derivatives, it's what is derivatives? We discussed it another day. Derivatives, derivative is just a way to pack a risk and to trade a risk. So if you talk about options, it's one risk, futures, transferring of another risk. Why people invented derivatives? Just to exchange risks. So there's classical example, one party is buying, another is selling. They don't want to run into the price risk. They make a forward agreement or they print futures and trade futures. And then it goes as complex as CDOs, CDS, and some instruments which nobody understands in the world, and maybe few people, and there's no collateral, and it's extremely dangerous. So that's all derivatives, and that's all the risks. And the market is pretty huge. So I always say like the approximate number is like 20 times bigger than the global economy. So the market of derivatives per year. And that's really exciting to try to innovate on this market and to cannibalize a little bit the bite from this market. At the same time, there's a lot of derivatives are not being created because it's very difficult at the moment. So if you want to create exotic derivative for something, we have an example on the Opium network. We have an example that companies in Spain, they just trading olive oil, and they don't have an instrument to hedge. They now building olive oil future on top of Opium. We were able to build it within a day, I think, or correct me, like 48 hours, but maybe probably less. And they can use it directly. If they go to investment bank, they will just feed the army of lawyers with this, and it's going to be very difficult and a lot of regulations, so on. So this is example of good usage of derivatives. It can be also creating a lot of risks and selling it to retail investor, which was also happening a lot. So that's all derivatives. I'm pretty excited, and within DeFi we definitely don't have enough, because normally credit market is 100 times, credit spot market 100 times smaller than derivative market, and credit market is something like 10. that's the normal ratios, and we're definitely not there in DeFi. And the maturity of DeFi will bring much more derivatives. And yeah, happy to speak about details, but let's continue the dialogue maybe.
Yeah, I think you're 100% right, and there is definitely a lack of derivatives, and that can be put down to, like you said, the maturity of this space and how it needs a lot more time to get to true maturity, right? Curious to hear other thoughts. Maybe Barney, since you're working at Vega, and then Dan, thoughts on derivatives, the role of.
Certainly, obviously agree with Andre. At Vega, we're doing a very similar thing. I guess we're creating derivatives, and with a sort of aim of creating capital efficient and high quality derivatives that can be really used to increase to improve markets. And as Andre says, the point of derivatives is you move risks around. You kind of unbundle risks from the physical things they're attached to, and you move them around. And if you don't want a certain risk, you can trade out of it. And if you want to take on a risk and you have a position on the future, you can trade into the risk, and derivatives allow that. And for the users of derivatives, particularly who are hedging, it's very important for them to have things like capital efficiency. It's also important for them to have derivatives products that work properly. So if you have kind of some of the attempts that have been made, particularly in Ethereum, to create derivatives, have created kind of poor Xerox copies of the real derivative, where actually you've got an option where you have a 10% stop loss either side, or it's fully collateralized or something, and you end up with this position where you can't actually replicate the same transfer of risk that you would with a real option somewhere else. And so if you can't do that, then you're actually not able to use it for those purposes. So I think it's really important. And markets are improved by the existence of derivatives. They tend to improve liquidity, they improve price determination. Some of the volatility and crazy pumps and dumps that you see actually happen because people who know that it's crazy and would like to take a position against it, which would help to mediate that, are unable to. And so part of the evolution of cryptocurrency and DeFi is to enable to have derivatives. But what I would say is there are actually a whole class of derivatives in DeFi which people don't realize are there, and they're probably the riskiest thing of all. And what I mean is most of the DeFi protocols you see, like all these crazy yield farming protocols, even things like Maker, they're all actually kind of derivatives, and most of them are kind of really complicated derivatives, except no one has actually taken the time to look at them and go, well, this is actually a derivative which is kind of like the payoff of this, plus this, plus this, plus with these risks, and it's dependent on the price of this and the performance of this Oracle feed, And if that was finance, if you were in an investment bank or a fund, someone would be sat there with a Monte Carlo model, and they would be modeling it under all kinds of assumptions. What happens if the Oracle fails? What happens if the price of Ethereum drops by 50%? They would be doing all of that, and they'd be going, okay, here's all of my risks that I'm taking on by taking out this position. And what we're not doing is actually acknowledging all of the existence of these risks and derivatives in the system we have, and actually understanding what that means and how they react. And that is probably the most dangerous part, is that we're kind of pretending things that are complex and are taking on a lot of risk are actually much simpler than they are. And that's one of the things that we're trying to actually, bring out in the open as Vega, is to say, this is a derivative. When you have a market, this is the market, this is the derivative. And one of the things we plan to do over the next couple of years as well is to roll out tools that let you say, here is your risk, here is how to think about the risk, here is what you're exposed to with this product, and actually make it so that people can learn. Because I think people don't get enough credit for their ability to learn and their ability to respond. When they see stuff fail, they won't do the same thing again. They'll see that went wrong, and they will try not to do it again. It's like if you see people skiing, falling over, you don't go down that run, or it's icy and you take more care. But if you don't show them that, and if no one understands, it's much more like gambling, where in fact the role of gambling is the casino hides from you the true risk you're taking and makes you excited to take it and not really understand, and makes you feel like you might win even though you won't. And that's kind of the difference between trading and gambling. And I think if we're going to succeed in letting everyone have access to these quite complex and dangerous products, we have to do it by succeeding in letting them be educated about the risks that they're taking.
So what do you think at the moment, the DeFi, is it a gambling or is it a trading?
It's gambling.
I have a number of different opinions. It probably depends on the things, but one of the things I think there's a lot of in DeFi is, we're talking about the fact that a lot of the positions are held by whales, and I think one of the things that you kind of get in DeFi is you get people who are big and who are influential, who can go in on a new thing and make it seem popular and grow. They can get in early with their big size, and they can know they're going to sell to the next guy. And there's a quite unsustainable kind of, there's a lot of things all getting smashed together. It's like, is this a fair launch? Well, you say it's a fair launch because it was all to community, but if it's all to the section of the community that knew it was going to happen and got in early and is going to get the big payout and leave someone else holding the bag when it turns out to be worthless, that's very different. That's not actually as fair as you might think. And so, what do I think is DeFi? I don't know. There's a kind of a bunch of things. There's some things that are really interesting and good. I look at Compound and I think they're aiming to create some things that will be really useful and in their long-term goals are sort of aiming to create an alternative way of sort of lending and making money, which can be used by banks. And Rob has a really good way of looking at that. And you look at some of the other things that are going on, and they're trying to create markets and they're trying to create products that are difficult to create on Ethereum, and they're taking shortcuts, and we'll see how that turns out. And then you get others which are simply kind of quite cynical, like money grabs by the people creating them, I think. And so I think I think there's a lot going on. There's a lot being learned, and I wouldn't want to dismiss anything out of hand, but I do think it's important for us to sort of understand that they're not all created equal in this sort of DeFi world.
That's very true, and kind of going back to your earlier point of like if you're not fully understanding of all the potential risks, then it kind of falls into the category of more gambling than it is investing or trading, right? So if you're like, I guess, curious to kind of dive a bit deeper. So like if you are aware or in the in crowd with some of these early fair launches, and with the hopes to kind of dump on retail later, would you still consider that to be gambling? Because I guess in that case you're still quite unaware of all the potential.
That's a good question. Some of the people who are doing that, I think there are people who know exactly what they're doing and they know they're going to make money, and they're like they know exactly what they're doing and it's fine. There are also people who think they know what they're doing, who are going in and they've made money so far. And I think when Andre talked about the 2007 event, you're going to find and this happened it happened in 2017, so you don't even need to go all the way back to 2007. You just look at the ICOs, and you can find there are a bunch of people who think they know what they're doing. They think they're informed. Same as what you see on Robinhood with the people buying into bankrupt Hertz go bankrupt, and then people on Robinhood buy it even though they're bankrupt. Like, you get this that people think they're informed, they've read the right website, whatever, they're in a Telegram group, they're pretty certain they're making good trades. But at the moment that there's a rising tide lifts all boats, and when that stops happening, someone pulls the rug out from underneath, you then find out that actually that you weren't as informed as you thought. And I think there's a large, there are some people who really do know what they're doing and are just making money out of the whole thing. And then there are probably a large number of other people who are, who are exposed and don't necessarily realize it.
Very, very true. I guess we'll go, Dan, if you have any comments on that. And then what we'll do is we'll open up to the audience so we can do Q&A, because I think there's an interesting conversation.
Just a small caveat on Bernie's points. I can't agree more on most of it, especially the beginning, when I think there's a lot of artificial complexity that is added to the system for different reasons. But people don't call like the financial instruments that they're using in their old names. They're inventing this new jargon that I find very confusing. So people are ending up taking things like long and short positions without realizing that's what they're doing. And like one example that I find really interesting, that when people invest in liquidity pools, they're actually betting against price volatility. Like that's something that took me a while to realize myself. And I find this really interesting that it's not written clearly anywhere. At least I haven't encountered it. But that's one thing aside that I completely agree with Bernie. The other thing which I want to counter is that I don't want to make this claim that this is super complicated and only professionals should be doing this. I think that there's a certain amount of education and discovery that retail consumers can do. And I wouldn't want to tell people who can't commit fully to this to be professionals and spend all their time doing this, running models, that it's absolutely not for them if they can't commit fully. I think that there's a risk in like not being inclusive. I feel like the industry should be responsible enough to present things in a truthful way and to present the risk in a truthful way and allow people to invest in DeFi without like having this casino-like experience. So people can and should, in my belief, invest a small amount of their portfolio into DeFi instruments or into blockchain. That's, again, I'm not a financial advisor, but the people that I love in my life, I tell them take like 3% of your assets, 5% of your assets, invest them in things like Bitcoin, and yes, you can lend them out. That's, again, that's my risk profile. That's what I believe in, and I don't want people in the audience to feel like if they can't go fully professional, it's not for them. Like, I don't agree.
That was definitely not what I was trying to say there. I think what I was actually trying to say was probably two things. The first one is that many of the DeFi products that sound simple are much more complicated than they're made out, and often artificially so. Like, they don't need to be, and they're actually, that complexity makes it look like, or that makes it look like they're actually very intelligent products that are going to make people yield forever, when actually they're products that are just exposed to a certain type of risk that's not exposed to, not made clear. And so I think the first point is kind of, we've got to try and design things in DeFi that are useful for some type of investor, rather than things that just are going to blow up as soon as something goes wrong, or are just not actually useful. So that's the first thing. I think we've got to try and keep on the side of designing things that have a use, even if they also have a risk. And then I think the other side of it is making sure that we are transparent about the risks, and making sure, like, as I said in Vega, the thing that's most important to me is that if we take these things to anyone on Earth, that we also take them some ways to find out about the risk they're taking, some ways to visualize that risk. Like, you should be able to see, a good example is leverage, right? If a simple visualization that an exchange could show you when you take leverage is how long on average would your position last, not taking any particular opinion about the market, but how long on average would your position last if you took this much leverage before it would get wrecked, just based on the volatility of that market, right? Because if you take 100x leverage on Bitcoin and you have an opinion about where Bitcoin will be in 2 months' time, the probability is not that you get to find out whether you're right or wrong. The probability is you lose all your money long before, because your leverage kills you. And like, there's a simple visualization to show you that. Like, what's the time horizon of your trade? What's the time horizon of your volatility? But until we start to build platforms that are responsible to users and say, hey, this is the risk, this is how to think about it in a way that's understandable, then we don't make something that the general people can actually approach and use in a good way.
I actually want to comment. That's you're bringing a really good point, guys. About building something which looks sexy but nobody understands. That was in 2007. We had this movie when I used to work on the trading floor. Like the guy was saying to another guy, "Let's make a high yield fund." And I say, "What does it actually mean?" It doesn't matter. So people like yield, people like high yield even more. So let's just put there all the crap and sell it to retail, and we'll make money. And that's lead to the financial crisis. That's pretty much what you're saying. On the interesting points on the betting on the against the volatility on the Uniswap or automatic market makers. I don't fully. I think it's actually betting on the mean reverting. So the volatility is not so dangerous, but it should be mean reverting. And actually, if you look at the Uniswap of by 1 inch, they made this Uniswap, which we discussed. It's a long volatility. You take a long volatility position if you use it. So on a high volatility, it outperforms the Uniswap. So it performs better. And of course, that's pretty cool to see. But this is not the end, right? You can make a pool which performs better on a bear market, on a bull market. You can make informed. Finally, somebody needs to make an informed market maker that takes actual information into account. So if the price goes up or down too much, then as arbitrageurs, they will make more money than investors of the pool, because investors of the pool will pay to arbitrageurs, and that's okay. That's good first step to introduce, but that's nothing even comparable to professional markets. So the market maker always take information into account, and if Ethereum goes down too much, it immediately reprice and keep this money in the pool, not giving it away to arbitrage, and so on, so on. And doing this on chain, how scalable it is, how smart it is to do all these calculations on chain with one single market maker. So it should be like 100 to 1,000 market makers, and they should operate somewhere on the layer 2. That's how we build Opium, by the way. So we only believe in settlements. That's it for the blockchain. But all these market makers, they should act somewhere else. And that tells you about the maturity of DeFi, and we now see it's going. So Serum basically said about it. Kyber Network yesterday dropped very nice report. They have this same idea. They have idea of order books instead of just pools, and so on, so on. And that's a good traction. And the final point, talking about risk disclosure and educating people. For the last 2,000 years, the problem was not solved. So it's not a recent problem, you know. For the last 2,000 years, people are driven by two things mostly, by fear and by greed. And sometimes there is more fear, sometimes more greed. But I think it's a bit romantic to think that, okay, we're going to educate people and they're going to be educated. So it doesn't work like this. Because even what Barney said, if you show some implied metrics, like, okay, you would run this long with this leverage, immediately going to be financial engineer who going to overcome it and make a product which actually has a quite good measure, but put you extra risk for extra money, and so on and so on. So that's actually interesting topic, how to educate people and how to disclose the risks. I don't have an answer. So 2,000 year problem going to still exist, but I think at least we should all speak the same language. We should all say, explain the risk or disclose the risk in the same terms. So whatever it means, that it's comparable at least. If we not measuring the risk or measuring everybody measuring in own terms, not going to help.
I completely agree, and I'm curious to kind of dive deeper into that point around if you're able to label the risk, and a financial engineer can come in and create something gives you more risk, more return, but for more risk. But I realize Dagon's also here as well, and Dagon's going to help me out with Q&A. So maybe we can quickly discuss that, then we switch over to Q&A, and then we can get some audience participation going. So just if you could elaborate on that, and then we'll switch to Q&A.
I don't know. I think we can get the audience involved now. Sure.
Oh yeah, sure. Yeah, I realize the time's actually going pretty quickly. Cool. So I can see a couple of questions. So I guess Dagon, we can get people on stage to ask.
Yeah, we can actually get people up here on stage as one of the speakers, and they can ask questions to any of the panelists. So if anyone wants to raise their hand, you can come and join us on stage. And if you're too shy, then you can ask the questions in the chat instead. But if someone wants to raise their hand now, I can let them in.
Raise your hand, guys. Let's do this. I can see Dan.
We are. Dan, go. Okay, let's go with Ashley then. Okay, Ashley from Vega has asked a question. He says, in UK retail finance, there's now a self-certified sophisticated investor test that websites have been forced into making all their users take. These tests include questions like, does the FSCS guarantee your deposits on this platform? Do you think we need the same kind of test for users of DeFi? So you guys can answer that. I've also noticed someone's raised their hand, so we'll get them next.
I don't know. I tend to think those sorts of tests are not the right way. It's kind of funny. If you've got enough money, you can be as dumb as you want and trade anything. And if you're relatively poor, then you have to pass tests and fill out forms and tell everyone what you're doing and get permission. And I think that's, I don't think that's the right way to do this stuff. I think, I think part of it is actually letting people see what happens when things go wrong. Part of it is giving them the information to be doing things with their eyes open. I mean, ultimately gambling is legal, and you can go and lose all your money betting on horses. So if you can get to a point where people know when they go in that they might lose all their money if they don't feel like, if they haven't taken the time to understand something and if they don't know what they're doing, then it's no worse than gambling, right? So, ultimately, I think you just need to give people the information, you need to give people the tools, and you need to give people the ability to educate themselves if they want, and then you need to kind of let them do stuff. Like, ultimately, you can't stop people taking risk, and so when we try to, we tend to just create these perverse incentives.
Absolutely. So my ex-colleague, he was an old trader, an old gentleman, and he said he started to invest in equity when he was a kid, and now for his kids it's impossible to open an account, normally account, because they're not 18, so on and so on. And the bank said, no, it's risky. And he said, how risky it is if they earn $100 over the summer and want to buy some equity just to learn how it works. What is risky? Is it risky to educate people? So by taking the real risk? So I completely agree.
Okay, I'll open to the next question. We have someone who's raised their hand, so they're going to join us. This is from Morgan. Hello, Morgan.
Hey, what's going on? Yeah, I was wondering, what happens when the tightest markets in crypto are on DeFi? So say you had the best market in the world for wrapped Bitcoin to USDT that was sitting on 0x or Kyber or wherever it was, and you've got that economic incentive to hop onto DeFi. What occurs? Like massive regulation or massive adoption, or like what happens if you can do that?
Probably a combination of those two things, to be honest. I mean, I think the larger DeFi gets as a share of everything, the more it's going to be attempted to be regulated. But regulating decentralized systems is going to have to be very different to regulating centralized systems, just in order to be effective, because you don't have this you don't have the player in the middle who you can just sort of ask them to do KYC and AML on everyone. So it's got to happen a different way. But then, once that happens, once liquidity is there, once people are trading on those platforms, the advantages will be clear. It'll be global, and I don't see how it gets stopped. So I think massive adoption comes.
I think regulation is a little bit easier for the government than you imply. So everybody use, on 90% of people, they use MacBooks, iPhones. So if just on an iPhone I don't have a wallet in an app store, so 90% of the people, they would never go install Linux and run a node or do something like this. It's pretty easy to regulate within 80% or 90% of people.
Yeah, I mean, I agree in that you can stifle this stuff if you really wanted to, but ultimately, these are networks, and yes, you're right. Not everyone is gonna, spin up nodes and go the full 9 yards, but you can, and maybe if there was a way to make that process less complicated, then there's still a level of resiliency there, right? But yeah, I totally agree. You can definitely stifle this stuff, and we should be. And I think what Barney said is right? Where there should be a more educated or a more refined approach with these new systems, right? Like you can't just map the old way of regulating these instruments and these networks like you do in traditional finance. It's just a new structure from the ground up. And there's a popular idea that's circulating that the role of regulators will become more like auditors. Not saying that's going to happen, but that's an interesting idea to explore, where they're just going to be kind of there to audit these systems and to kind of help make sure that they work as function as they say they do, right? But yeah.
Cool, appreciate it. Thank you.
Thanks for the question.
Morgan. We have one last question, unless anyone wants to post another one. How will we bring in liquidity from traditional finance, e.g. typical market makers? And this is from Dennis from Opium Protocol.
I know the answer. So, but I'm wondering what other guys think. So we have basically.
Go ahead.
No, we just think it's quite important, and we had an approach. How to do it? We just clone the liquidity, because we can list the same instruments like centralized exchanges. We can also market make and hedge yourself on centralized, and then it's not we, like everybody. We will, maybe Dennis is spoiling a little bit already, but we will open it to everyone. Everyone can run a Hummingbot and just transfer liquidity to DeFi. and earn his interest without taking classic risks of DeFi. That's our approach, but we've discussed this a lot, and there are many ways, and we think that it should be done. It's a cool thing to do. So take all the centralized liquidity and bring it there, decentralized. Maybe, what do you think, guys?
Yeah, I mean, to me, it's very, very important, and I think the sort of the strategy you talk about works for some things, and i.e. the things that are already on the centralized exchanges, and certainly with Vega, it's kind of similar. You know, if Vega has US dollar Bitcoin markets, then obviously the first thing that you do is get people running Hummingbot and arbitrage bots and arbing it against BitMEX and wherever else, and that gives you liquidity in the first markets. But you know, the part of the point of DeFi is to not sort of cut the umbilical cord actually away from the centralized exchanges and let people create new things that didn't exist elsewhere and avoid that dependency. You know, and I think it's actually the same way that liquidity gets attracted in centralized markets, and it's if you have a good return that you can make by providing liquidity, you know, and Vega's built, you know, with additional incentives. So effectively, the fee revenue and the revenue that an exchange would otherwise make goes to liquidity providers in order to give them an incentive to do this. But if you have good and efficient pricing, if you have reasonably capital efficient derivatives, so if you have good leverage and low margin requirements, and if you have good returns and people are coming in and there's lots of volume and trading, then there's no reason why you saw jump market making on Serum, right? So, you know, there's no reason why these large traditional market makers won't come in. The big thing that's stopping them coming in now is, although we think there's, look how many billions is locked in DeFi, it's basically tiny. Like compared to the markets that will get big traditional market makers excited en masse, DeFi is still tiny. And if we make DeFi big, and if we make the pricing efficient, we make the derivatives work well, and get the capital efficiency, the money will come because, you know, market makers are profitable activity.
Exactly. So it should be just the first step. So absolutely, and DeFi is a million times bigger than the derivative market still.
So building on that, even if you only look at the current crypto market, if you look at the current crypto market cap, you see that only about 5% of crypto is generating interest. Like 95% of crypto still sits in wallets that don't generate any interest. 95%. So I believe we just have to keep on innovating and creating value for users, and if we can sustain certain amount of interest on DeFi products, the funds are just going to be attracted there. Like it just makes no sense of 95% of all crypto being ideal, not generating any interest. And specifically what we're trying to improve there is the discovery and education part for retail. But just the pace of innovation, I think, is the key.
All right. Well, I think that's a great way to wrap up this panel. I guess just final thoughts, quick fire. Anyone want to say some final things before we wrap up? That'd be great. So if anyone has anything, just shout, and then we can.
Yeah, sure. My last point is the same, basically, like my first point. Think about the risk, because it's a key, and it's going to be a key. I agree. It's cool when the token or project generate interest, but this interest coming from somewhere, so it's paid from somewhere. If it's a zero-sum game, that it's paid by someone, it's somebody's loss. And I hope that this is going to be clear for the users, and they're not going to run into big problems. And I hope the DeFi will reach real economy, and the real economy is growing, and that's where the interest is coming from.
Yeah, I agree with that totally. And my final thought, I guess, would be, you know, what we're looking at the moment is we're looking at a lot of stuff that's happening on Ethereum, which means you have super high gas prices, you have super low computational capability, you have quite basic products. Even, you know, most of the trading's AMMs. By the time we get serious amounts of traditional liquidity and real finance moving across to decentralized stuff, the pricing of major markets won't be AMM curves. There's no way. Right? You know, if you think about the price of a company that has just announced it's gone bankrupt, it doesn't smoothly move down a curve to zero. It goes to zero immediately. And as soon as you get to needing to have large amounts of liquidity and large amounts of trading happening, that's not going to scale. It's good for low liquidity launches of stuff, but it's not going to scale. And that's going to be true of a lot of these things. So I think we're kind of seeing a first wave of Ethereum DeFi. And I think there's an entire round of kind of, second wave DeFi, if you like, if you want to call it something like that, which is going to come along and increase the efficiency and increase the sophistication of what's available. And I think, we're starting to see some of that stuff get built on things like Polkadot, things like Vega as well, things being proposed for Ethereum 2, Cosmos. People are building all these things, and you're going to start to see a wave of the next generation of stuff coming, and that's going to be really exciting to see how that addresses some of these problems we've been talking about.
My final thoughts are that DeFi is, in fact, risky and complex. But I encourage everybody who can and want to learn about it to try it out. Like, don't be afraid. Don't make crazy bets. Don't do anything you can afford, but try it out. Don't be afraid. And if you want to learn more about what's out there, you want to help in discovery and education, like, look me up personally. I'm gonna make it my mission to try and help you out. Be careful, but don't be afraid. It's not that complex.
Well, that is a wonderful note to end the panel on. It's been my absolute pleasure to be here with you guys. Thank you all for spending your, Friday coming here to chat more about DeFi, derivatives. I think this was a really fun conversation. I definitely learned a lot. I hope it's the same.
I hope you had a good lunch, as brief as it was, and you're ready to talk some more derivatives with us. Here I have Juliana on stage. Christina, are you joining us for the session?
No, I'm not, but you seem to.
Sorry.
Around. So now I wasn't
Here you are. You can hide if you want, or you can stay. But yeah, essentially, we're doing a nice little AMA with Juliana. Juliana's quite extensive experience in derivatives, in traditional derivatives. She's worked at UBS on the trading desks, and she has worked in wealth management and many different areas of traditional derivatives. And so she has a nice little slideshow that she'll show us and kind of go through the history of things and just kind of give you an insight into her life. Also, she's living in Brazil currently, in Sao Paulo. So there's a lot of interesting tidbits of information she could give us that I think we haven't really touched upon, focusing more on decentralized derivatives. I'm really excited for this session. And I'll let Juliana give herself a little intro. You guys know who I am already, I think. If you want another intro, ask me for it later. But without further ado, Juliana, you may begin.
Impressed, like how we started with 62 people, then after lunch they dropped to like 51, and now we're like 47, 48. So hold on, we're gonna have a lot of fun now because volatility can be painful, but we learn a lot from those experiences. And I think I wanted to give something like interactive, so I'm gonna need your participation. Please bring all kinds of questions. My background started back in 2001 in derivatives, so I've seen quite a lot, and I would just like to share screen. Let me see if I can do this. But pretty much my story starts as a Brazilian back when inflation kicked in our country. And so this is pretty much my website today. I am a consultant, and I am, if you go to my LinkedIn, I'm doing a lot of development today. So today I'm a total dev. I am into mobile. And I use this framework from Google called Flutter, which builds for both Android and iOS. Back in 2018, when the hype of cryptocurrencies was going on, I decided to take this very seriously, and I had a master's degree that year from the University of Nicosia, which was one of the first ones in the world to give a technical background on blockchain. And I chose the path of the developers and programmers in my journey through the blockchain space. Today, I also am pretty much the voice of Ethereum Developers São Paulo. It's a meetup group in Brazil. We have around 300 members. And I'm also the summoner of the coolest downtown. So Christina is part of us. Rafaela, who also spoke. Then we have Rebecca, we have Tamerlane, and all the most brilliant women in the blockchain space. So we have a DAO, a decentralized autonomous organization. And I'm also like entrepreneuring. I'm starting this journey, interested in topics such as like neuroeconomics, so why people make bad decisions when they invest, why women have this risk aversion, and also like why women are not investing as much as men or taking so much risk as they do. So women know for sure that they cannot lose money, so they don't risk as much. So we have to understand why this gap is happening. And my background started back in 2002 was the year I graduated. But in 2001, I was already an intern in the brokerage house in Brazil. So I was an equity analyst first, and then I became Brazilian futures trader. So we did a lot of FX and interest rates back in 2002, 3, 4. And then in 2006, I was invited to go to New York and work. Actually, the address was Wall Street number 100. So I worked for GFI Futures. It's a brokerage house internationally. And I traded over there swaptions, which are an option to enter an interest rate swap agreement in the future. So you have an option to decide something about the future date. So you can buy today an option to enter an October 2022 agreement that will settle in 2024, for example. So it's a very, very illiquid market, and it's an institutional product. It's not for the regular people. Then Lehman Brothers happened, so there's lots of interesting, peculiar stories about that time. And then I was invited by UBS to be part of their trading desk in the Bahamas. At the time, we had 5 people, where we ended up with 2 people. So that was also my migration from institutional investors to wealth management. And then 2014, UBS closed its branch in the Bahamas, and I was invited by another bank because I did not want to leave the Caribbean, so I was invited by Deltec to take the lead of their trading desk. So pretty much I answered to regulators in the US, in the Bahamas, in many European countries as well, because when you have clients from Colombia, from Greece, from Japan, you are also liable and you have to respond to regulators. But this is how I kind of started. This is how the market actually looked like back in the day. So this was an open outcry. I added here, let me just mute this, but this was the scenario of the markets when I became like a junior trader, more or less. It was a market that was pretty much, you think it's a mess, but it's very organized that right now, everything that they say is being recorded on those phones. Every camera is recording even like where they're looking at, and their hand signals also have a purpose between who's buying and who's selling. That guy was selling. He was doing like this movement of like, go, leave, sell. So I added this just for like illustrative purposes. This guy's buying. This guy for sure is buying. When they do this, they're buying. And they have to cry, to yell to the others. So pretty much that's the scenario when I joined. This market is also very liquid when you think that the interest rate and the currency are the most liquid ones. So what does liquidity actually mean? So I also brought like some nostalgia from the trading floor, which is like this, everything you see, it's underlined on this presentation, are links for you to click and read. But those are the stories about like when Chicago closed also its trading pits on July 2nd. So this is the story of like the end of the trading pit. And today everything is done electronically by buy and sell buttons, regardless of their colors. It's just with one click that you actually buy and sell. But there's a lot of routing of those orders so they finally hit the exchange. This is Chicago Mercantile Exchange. When I was working in Wall Street at a derivatives brokerage house, we had a clear separation between Chicago and New York, NYMEX. So the New York Mercantile Exchange. Today, they're just one group. So the CME group got all together by specialization as well. They concentrated every derivative trading in Chicago. I also traded, I had the Series 3, which is a certificate you need to have to be, it's like a license in the US. So I could also trade like in the London Metal Exchange. So just for you to understand, this was the banking era back in 2006 and 7. This was when UBS had one of the biggest trading floors of the world in Stanford. So the size of, I think, like 2 soccer fields or something. But as you can notice, everything is electronically. So the need of calling the trading floor is not there anymore. So no, and there's like some stories about the trading floor in Stanford. There's also links to the New York Times. And I would like to invite you also today to not be afraid and think that this is a very distant reality. This to me, it's like I'm super comfortable in walking around the floor like that. This doesn't look something crazy unusual to me, but pretty much you're very welcome to enter those exchanges. And I put here even DeFi polls, and you're going to know why in a second, but anybody can just go to Chicago in one click, cmegroup.com, and you're going to see where all the derivatives are actually trading and why. And we do deal the language of millions and billions. So pretty much I added here in the spreadsheet that I did for you, something that like people totally lose the sense of money. When we trade derivatives, we trade notional value. And that notional value can be like, I noticed that in New York when my minimum ticket was 200 million. And I used to think like 200 million is the smallest trade I could do. I would do trades of 4 billion and up. And
I think we lost the spreadsheet.
We did? Oh.
Yes, the screen share.
You cannot see my screen anymore?
Yeah, just try and bring it back if you can.
Okay, there you go. Let me also do something here. So it's going to look probably more visible. So I just added here. So don't be afraid of like, oh, I don't know exactly how many zeros is in 900 million and how many zeros are in the billion. So it's like
we still can't see the screen. Is it?
Okay, I'll put like a link for this later, which is a pity.
It's a shame.
It is. It is a real shame. Can you see the screen now? And thanks for letting me know.
No. Maybe refresh, like come out, come back in. We'll paste the link in the chat if there's a link to it.
Okay. Yeah, for some reason I was not
Yeah, put the link in the chat and I can share it. I can just share my screen. Oh no, we're back. We're back.
We're back.
There you go.
Right. So I was talking about the trading floor. I think you saw that. Could you see this?
Yes, we got here.
Okay. And then I added a link to the Chicago Mercantile.
This is where we stopped. Yes, this is
it. Are you seeing? Can you see my screen?
Perfect.
Okay, good. So I'm just telling people to not be afraid. Any contract as a derivative contract is nothing more a PDF file. And that agreement is a set in stone agreement. When you trade OTC, that PDF is a very important document that's signed by parties in the bank, so the legal director or the traders. Very few people can pick up the phone and do a trade and call the other bank. But in the futures market, this is set by the exchange, all the rules. When do a market expires? Or how much is it trading right now? How much margin are we going to have? So if you go to Chicago, for example, you click on markets, you can pick any product. And I picked here for you like a net gas example. Okay, so from agricultural commodities, energy, FX derivatives, interest rate, metals, and the same can be done by the London Mercantile Exchange, which is this website right here. So you also have like metals, For example, if you need to understand, like from precious metals, how is gold traded, how much margin is it asking. So you have all the details here. So don't be afraid to explore those two exchanges. They are your best friends in terms of what are the current rules. So if we pick a market, and I'll pick like on purpose nat gas, because I know some of you do have years of experience on trading one, but let's say I don't know anything about nat gas. I'm going to pick not a random contract, because you can easily get lost in this. So what's my first filter as a beginner or as a non-trader of nat gas? Of course, I remember that the code of nat gas when I traded back in 2007, it was NG. But people don't know that NG is the one. How do? I go by volume. If I check by volume, I check what is the one that has the most liquidity one. And this one matters a lot, because then I pick the future that is giving me the most amount of trading liquidity, actually. And the same, I am not focusing too much the stock on the derivatives market, but this is my main radar. So I added here like a radar. DeFi Pulse is when I actually need to see on derivatives. I just go and filter by locked US dollars. And you can totally see that $756 million is completely different than $1 million. So where am I going to find liquidity right now? I hope Vega is going to be the passing synthetics shortly. But to reach this amount of volume, you need people participating, you need people trading, and you need a lot of money locked in those protocols. So this is just for you to know that there is a very good radar. This information is public, DeFi Pulse. I think it's maintained by Consensus or the Ethereum network. But this is where you can actually see where you're going to lock your crypto. Okay, because this matters a lot. If you don't have liquidity, you don't have a way out. And in derivatives, you really need to know. So here's like a spreadsheet that I did for you called Draft Derivatives. I hope you can see this. Can you?
Yes, we can.
So this is like this market that I was talking about. So here's Henry Hub Nat Gas Futures. What does this screen tells me? Contract unit, 10,000 million BTU. Does anybody know what this means? It's like Greek. Very good interactive session. We have 10,000 million British thermal units, which is something also called the multiplicator of the contract. So each one contract of nat gas trades 10,000 million BTUs. That's their main unit. Okay, 10 million BTUs. And then you can check BTUs. If you go to your AC, you're going to see how much they are trading. And then this is also information I got from last week, but I think it didn't change much. But this is like the trading hours. So on the expiration date, you actually have a minute to expire things. And then some specifics about the contract. But here is like minimum price fluctuation. So the minimum you can actually have a fluctuation of a price is $10. So every one tick higher or smaller, you're moving like from 50 to 60 or to 40. You don't trade 55 or 45. You cannot meet in the middle. So every implication matters to this point. And then here, when you go to volume, you can see the contracts by also liquidity. So usually here they do chronologically, but here is usually the most liquid one is usually the first or the second month. It's where you're going to have your position. And then you have to roll this position for another month. And also I would like just back on the nat gas, I'd just like to show the fact that like how much one of these units actually mean. And then in pricing, it's like I just want to get quotes. So if I go here, quotes, and then let's say we're talking about the October contract, we have 2.26. Okay, so 2.26 is my price. You're obviously not seeing anything because I did it on purpose, so we're not going to do a lot of math, but it's just pretty much like multiplication. So if 2.26 is the last quote, 2.26.4, 2.26.4 is the last quote. So if 0.001 is equal to $10, meaning on their contract specifics, they say that like this is $10, then how much is 2.64? So pretty much you're gonna have like something I'm gonna just unhighlight like this. So $10 is 001, 20 is 002, and so on until we get to, excuse me, like my mouse is like not the best. So here is 226.4. So we're talking about 22,640 US dollars per one contract of nat gas October 2020. Okay, so this is how much one contract is worth. Here it was like 2,901, but here we can just change to 22,640. All right, and this you can do for any derivatives. Soybeans or corn, they trade in 5,000 bushels. Coffee, you have packages of 60 kilos, and every derivative is going to have its own specifics. So if we have, if we need, here's a question for you. Do we actually need to have 22,640 $22,640 to trade one contract of nat gas? Do we need to have all this amount of money?
I don't think so.
No. How much do you think we need?
It depends on the leverage, or how much you have to offer up.
How much money will leave your account?
Yeah, explain.
So here it is. Again, the exchange will give you all this information. Okay. On price quotation, you're also going to have something about margin. So here it's price limits, position limits. I'm just going to try to dig here in price limits. Nat gas, crude oil. I just want to go to Henry Hub nat gas. Reference price, dynamic. No, this is not like the most. I really lost the sense. When I had a Bloomberg terminal, I could see this. But pretty much, remember when we would have, where did I find this? I lost my futures, options, contract unit, 10,000. Margins, sorry, right in front of me, big button called margins. Here we are. So on margins, I have here, remember we were trading the October one, so product code. I'm looking for the 10th of 2020. This is when it's going to expire. I need a maintenance margin of $2,300. So $2,300 is actually how much margin I'm going to need to have to trade one contract of nat gas that is worth $22,000. So you understand that you don't need to have $22,000 in your account. You only need $2,300 actually, to be super specific. How much do I need to trade 5 contracts? That's easy math. That's 5 times this number, right? So you need 11,000. And 5 times, this is going to be equally to like more or less $100,000. So to trade $100,000 notional here, 100,000 to trade this number, you don't need to have this amount of money in your account. So going back, you're going to receive this spreadsheet as just an example of very easy math. So you know more or less, don't be afraid to do this math to any derivatives. And then to finalize, let me see if I need to press play. But I guess that was what I had. So I had curious stories about some margin calls and all that. And this is an AMA, and I think I spoke already too much, but let me know if there's anything you're curious about.
I thought this was great. I think we have a couple minutes left, so we could open it up to the floor if anyone has any questions or wants to come on stage and ask. But otherwise, I will kick off some questions. So does anyone have any questions they'd like?
How many people here traded derivatives in the past? Can you raise hands?
Ooh, we can do a poll.
Can we do a poll?
There we go. We've got a question. Do you use funding rates and spreads?
Funding rates and spreads. This is going to depend on how much margin the exchange asks. But to get to the exchange, you need to go to a brokerage house. The brokerage house might ask for more margin than the exchange asks. For example, at UBS Wealth Management, we needed to ask twice as much margin as Chicago would ask to the same product. So the funding, if you can explain better your question, Anik, but pretty much the rules are going to be set by the participants in the game. The exchanges have their rules. The bank where you have your account are going to set probably same or sometimes higher margins for you to trade those derivatives. And the spreads are also probably a reality for those that can access the exchange. Anybody can access the exchange by going to a brokerage house. If you go to a bank, they might give you a larger spread. So they might not say the bid is at 13 and the offer is at 15. They might say the best bid right now I have is at 10 and the best offer is at 20. So you have a 10, let's say, dollar gap between best bid and best offer. And then you as final client is forced to either accept or reject. You don't have too much of a call. You can tell your banker, hey, look, are you crazy? I see they're bidding at 13 in the exchange. I want to get paid 13 for this asset I'm trying to sell, right? So you pretty much always negotiate with the trader. It's on the other side of the line.
Okay, the poll is updating. We've got 31% of people have traded derivatives and 69% have not before.
Okay.
And question from Ashley, what's the strangest thing you've seen in your trading career? Wins, losses, market madness, etc.
Yes, this 31%, it's a very good start. For the 71%, I can say sometimes it costs $10 to trade a contract of derivative. And you saw it's around $2,000. So it's something to put in the to-do list of risk-taking for life. You should definitely try to get engaged with derivatives. Strangest things I've ever seen in my trading career. When I started, I can say we got a call from the exchange for a client that traded cattle, and it was expiration day. And they said, where can we deliver the cattle? Because when you do not sell and the contract expires, you have the obligation to deliver the commodity or derivative or metal or currency that is written on the contract. That's why you have a date and time to expire. So in case you don't, you might have a very, very unfortunate experience to pay insurance, to pay storage, and many other things. So I can say this one was quite unique. You never wait until expiration. You sell, you roll your position to the other month, or if you're buying, you just like roll the position to the other month. And also like Lehman Brothers was quite unusual as well. We got a call from Chicago, and I answered that phone call, and they said, you have 1 hour to close all the positions, or Chicago is going to close them for you. So that's what really happens. You get dismantled in seconds if you're on margin call. So they can be a very unfortunate, dangerous game if you're not ready for volatility. So you really need to be paying attention to margin, initial margin, and also if the price goes down, they go down very fast. And then you are going to be called to put more margin. And if you're not ready for that, you have to close at a very hefty loss. So.
Okay, I'm conscious of time, but we'll take a few more questions and just push the others back, maybe 5 minutes. Juliana, is there any question you want to pick of these that you prefer, or should I pick one?
Let me see. Global RFQs for request for quotes will be truly revolutionary. We're designing this within Vega, but won't be on V1. So if anybody's curious for request for quote, which the name says you request for a quote, Tamerlane is going to be the person to explain more about that. So don't be afraid to explore more on the topic. And I think it's super cool that they're doing that. Another important thing, like liquidity. Who generates buys and sell orders? They need to be incentivized, right? You just don't create a bid or an offer. So you need participants. And the more participants we have, the more like fair this market is going to be. The spreads are not going to be very large, meaning like people are buying at 13 and selling at 14. That's quite fair. Then I have the best buyer paying 5 and the best seller just wants to sell for 200. You don't have a market. You have days and days of no trading, no liquidity. So you need that in crypto.
Final question, I think. Do you see blockchain tech and crypto assets and its derivatives being accepted as a trading asset on the traditional financial markets anytime soon? Widely accepted as in not just ETFs?
Well, and
you can be as honest as you want.
Okay, totally. To be in the tradition of financial markets, you need to be under a regulatory framework that is different than what we do know today from the crypto space. So all those exchanges, they're audited to the nanosecond of an order. You can ask the order book anytime. The order book is not an illusion of a price. It is a real bank or a brokerage house that actually sent that bid. It's not a bot that just puts the order. Of course, there are bots from high frequency trading, but bots can get hit. And if they get hit, they have money in the account that they need to send to the liquidity chamber and get cleared. So in this sense, I think like blockchain and crypto does not have today the fact that you can be totally anonymous. It's also a problem on margins that they were discussing, like how do you collect the margin? If you can lock on the person's Ethereum MetaMask or in the wallet of a person, then you have the certainty that that person is going to pay and not go away. So I think like there's a lot of things that regulation is there to inspect and to make sure that participants are going to deposit, are going to, like, if they say it's going to close at 5 p.m., that's 5 p.m. If the market is avoiding inside information, is because every company, for example, in equities, every company has a specific date and time to release their balance sheets, their income statements to the public. So everybody knows the information at the same time. In crypto, you're sleeping and you wake up like Chinese are already trading. So it's not that you're going to wait until the market opens. The market never closes. So this is a tricky thing because the exchanges also need to take some time. What else?
Perfect. I think we'll wrap up there, but I really want to hear more from Juliana. So okay. She'll be hiding in the social lounge in the break between this session and the next session, and you can find her. Hello, everyone, and welcome back to our next session with Tamlin, who is a former derivatives trader in the power markets and also the co-founder and head of strategy at Vega. She was in an earlier session, and she'll be also leading a panel later on. In between the start of the panels, we're going to have a quick demo of a derivative platform, also the thing we're building at Vega. It'll be very, very high level, I think, because it'll be like 10-15 minute overview. So I will leave it to Tamlin to begin. And then, yeah, you can have a look, give some opinions. And if you like what you see, come along to one of our onboardings or come and find us on Discord and you can chat with us a bit more. All the best, Tamlin.
Thanks, Dagan. Hi, everyone. So, yeah, what I really wanted to do today was walk through a bit of a trade life cycle of a future, so a futures product. And I'm going to use the Vega platform, as Dagan said, but it's also, I'm going to just sort of more broadly speak about the trade life cycle. And then I'll try and, sort of have a little bit of discussion around, how you decentralize those bits of the trade life cycle or even the full the full trade life cycle as we've done at Vega. So yeah, as Dagan said, I'm a former derivatives trader myself. I traded the power markets for many years, and then power markets are really, really volatile because supply and demand, basically power can't get stored, and so you get these major price spikes. So futures and swaps and swaptions and so forth are other things I traded quite a lot of. So yeah, I think that one point, actually, you know what, I'm just going to dive straight into it. Hopefully my share screen works. Let's try this. Great. Hopefully you guys can all see this. I'm going to make this full screen. Yeah. Okay, maybe the sharing of full screen isn't working. I'm not sure exactly what you guys can see, but hopefully this is all good. I'm going to check the chat, actually. We can see. Brilliant, thanks, Christina. Cool. This is slightly awkward because it's a squashed version as a result of something to do with the sharing, so apologies for that. But yeah, this is what is pretty much a typical sort of looking futures exchange. You might have seen similar things either in the traditional markets or maybe some of the crypto exchanges. A bunch of us come from the traditional markets, so we sort of set out to build something that was a little bit Bloombergy and a little bit flexible, and you can make layouts, and we've got a bunch of shortcuts and so forth. I'm actually just going to first show you is, I just want to make one point sort of kind of up front, is that what you're looking at here is, instead of an exchange that's being run by a central server and a central operator, you've got an exchange being run by, a derivatives exchange being run by a network. And this network is just 5 validator nodes. They're fully globally distributed, and we've been building our own blockchain designed specifically for trading, and we're currently using Tendermint, although we're designing to be quite modular. Great. So, right, let's talk about the trade life cycles. So, probably the really, I would say, the first part of the trade life cycle is making a decision about, well, first of all, what you want to trade, and then a decision of the price level at which you want to put that trade on and the volume. And there's a range of different strategies that can drive those decisions. But the price especially really relies on a couple of things. And one thing you're always going to want to know as a trader, you always want to get a fair price. You don't want to pay more than you should. So you want insight into where the market is currently trading. So I'm actually going to go into the ETHUSD market because that's the one I'm going to put a trade on in a sec. And if I wanted to put a trade on an ETHUSD, I might go to the order. There you can see the order book over here. Just get rid of this. And you can see where the market's trading. By the way, all the trading happening on here is either traders interacting on our testnet, or we've got some bots that are we've set up to basically place orders. They send an order to one of our nodes. It gets gossiped, added to the order book. And so, yeah, I'm looking at this order book and I see where the price is. So having good visualization of that's really important. I think something that really frustrates me about a bunch of the professional exchanges at the moment, and they only do it because they can get away with it, but they charge a lot for live data access to see where the current prices are. I think CME made us something like 500 million last year, just from that alone. And forgive me if I've misquoted you, CME. I don't intend to, but I'm fairly sure in any case, it's hundreds of millions and in fact billions every year that the global exchanges do charge for access to the data as quickly as possible. And some of you may have heard of even strategies like co-location, where people buy to sit really close to the exchange so they get the really, really super live pricing of what's going on. But of course, on Vega, running on a blockchain, that is all going to be open, transparent, accessible data for everyone, which is nice. So let's put a trade on. So we've got different ways that you put a futures trade on, different order types rather. A limit order would put basically my order, it would specify a price, and that would be the sort of maximum price I would be willing to buy at, or the minimum price I'd be willing to sell at. And we can do that, if I was picking a limit order, I'd also pick what time in force I'd be willing to do. So this fill or kill just refers to the fact that I'm saying when my order gets hit, at any point it gets hit, either do all of it or none at all. Immediate or cancel is like do what you can and then cancel the rest. And then you've got a good till cancel and a good till time. Good till cancel is just, let this roll until I cancel it. And good till time is good till cancel plus an extra thing about if you clock over a certain time. But I'm going to actually go do a market order, which means I'm just happy to put an order onto the order book and let it trade. So let's pop, let's get rid of you guys. Let's have a look. Just pop my fills over here. Sorry about all these margins. Like I said, things are just doing a funny squash up at the moment. Let's just open these up so we can see what happens when we put the trade on. So this is my positions window. And if I place a market order, it's going to trade immediately and I should see a position open up immediately. So I should have some open volume, a price that I've achieved on the order book. And then I'll talk through the rest of these columns in a second. Right, what are we going to do? We're going to buy or sell. I'm going to suggest I'm going to buy. All right, so I'm going to buy 100. Let's do it. Let's see. Sorry. So we've got some fills. Like I said, just remember this is all happening on a decentralized network, which I think is really cool. But if it were a centralized server, that would also be going to a central matching engine, basically the exchange. It's just that the difference is our nodes are all running our matching engine and all the trade logic that handles the post-trade processing. So as you saw, an open position I have now, I'm long 100 of this futures contract. Basically, I've done that because I think ETH is going up, potentially. And I have an average entry price, and you can see that's just the volume-weighted price of each of the trades that comprises that this position. And now we've got the mark price ticking over, and at the moment for this particular market, the mark price is just clicking over with the last trade. And I have some allocated margin, and let's talk about collateral quickly, actually. So to put a trade on, I needed some collateral. Vega is not a collateral blockchain, so actually sort of our architecture is such that people deposit collateral into a smart contract on one of our adjacent collateral chains. Our first integration is Ethereum. So this would be a futures market potentially settled in some kind of stable coins. So you can see our sort of fake version of the stable coin at the moment is Vega US dollars. We're not building a stable coin at all. But in the future, that could be, DAI or any of the stable Tether or any of the stable coins out there. Right, so I've deposited some VUSD, and this position has incurred some margin. So you can see that the margin that's incurred is now deployed. It's basically there's this sort of inbuilt accounting system in the Vega core that is keeping track of what's deployed in margin. It's also keeping track of what I should owe in margin. And something that is really super cool, I think, in general about crypto and blockchain and whatnot is, and actually I was watching a great fireside chat by Blockworks Group, and it was Chris Haymeyer and he made a really fascinating point that cryptocurrencies are really unique in that this underlying asset is just kind of moving 24/7 and switching hands. And, if you think that's sort of akin to a live settlement. And if you think about it, like really in terms of live settlement of assets, if you hand cash to someone, and they give you something, that's a kind of live settlement, right? But, typically in sort of banking systems and online transactions and so forth, you don't really get that. And, obviously swapping cash and, or swapping assets can really only happen locally. Otherwise, you need to go through layers of validating that the person across the globe has the thing that they say they do, and it literally takes days to do settlement. But so blockchains are really good at doing that kind of thing, and so we've harnessed that in our system as well for the sort of ongoing calculation and what we call marking to market of a position. So what happens is when you put the trade on, and this happens in any exchange, the exchange will keep a track. They'll first of all incur an initial margin that from everyone who has put this trade on. So all the people who are on the other side of this trade would have to put up some initial margin that would look a lot like my initial margin. And then the exchange would basically every day they would what we call mark to market the position. They'd basically say they'd revalue the open positions, of all the traders with open positions in the market, and they basically say to the people who owe money, we need you to, the position has moved against you, and if it's moved enough against you, you might get a margin call. But they definitely keep track of that on a daily basis. And what Vega does is it actually does that on a near live basis, because it's able to do that really fast. And so, yeah, we keep track of this, and you can see the unrealized P&L is your market of your position. Sadly, I'm losing money, but yeah, that's, I think, really fascinating. And what it basically ultimately leads to is the fact that we don't need to charge as much margin, because the actual margin represents the amount that the exchange is worried it might lose in between the times it remargins you. And if you're remargining people really quickly and you're doing this kind of live settlement, you don't need to charge as much. It's not like a whole day until they get to take some money off you. So yeah, I'm going to just click in and show the margins. So in typical exchanges, you have an initial margin, and then, depending on the exchange and the way it operates, you might also have a maintenance margin. And what these basically do is say, look, we want you to put up some margin. If you're we keep track of the mark to market and the valuation of the instruments and a few other things. And if it goes against you too much, and if it hits maintenance margin, we'll basically margin call you and take you back up to that initial margin. And we wanted to figure out how to do that in a decentralized setting. And so we actually invented something that I think is really cool. It basically is a way of doing cross-margining. And by that, I mean that you incur this initial margin. And then if the position goes in your favor and you start to make enough money, you hit a level called the release level. And what that does is it says, the network basically says, look, you've made enough money off this position. We're not going to hold it on this market anymore. We're going to give you back your collateral. And so it basically sweeps back any of your gains and takes you back to this initial margin level. And it sweeps it back into this general account. And then you've got any other markets I've got trades on can search this available balance if they need more collateral to back the trade that I might have on a different market. And so, yeah, so if the market moves against me a bit and we get down to the search level, then the system will all do this for me. I'm not having to manually figure that out at all. If it goes to search for some available margin and can't find any, then the position keeps going against me, and I might end up hitting this maintenance margin level. And at that point, being a decentralized network, due to a few design decisions, we basically go and source order book liquidity to close you out. And so your position basically gets resolved. This all happens atomically, so unlike other sort of DeFi projects, it's not really you're not needing to put a request for, I don't know, someone to come and close out the position on Twitter or running any kind of liquidity auctions. None of this needs to go back through the blockchain, so you don't get the same sort of weird front running and sort of dark pool behavior stuff that you get on Ethereum. But yeah, that's basically how our sort of atomic margining works. As I said, it all sort of happens live. It means that we have really nice capital efficiency, and so I think this is what I don't know, like what are we getting, sort of 16x leverage on the ETHUSD markets. I think our ETH-BTC market that we put up is roughly, you're sort of being charged 11% of the face value, and which I think is about a 9x leverage. And then we've been playing around a bit actually with our GBP USD market, because Vega specifically is designed for non-crypto markets. And I think our leverage at the moment we're testing is around like 300x or something. We're just experimenting. We're wanting to stress test the system and see what, this is a test net, see how it performs under such stress environment. If you want to understand the futures markets, they're all cash settled futures. As I said, the settlement happens on the adjacent chain in the crypto asset, the settlement crypto asset that was nominated at the point of creation of the market. And something that I think is really different about Vega is that you can create and launch your own futures markets on this ecosystem really quickly and easily. And we'll be doing a little bit of sort of demos of that in the near little while. But basically, it comes down to how you define a market, and we also have a whole bunch of inbuilt economic mechanisms to kind of help incentivize the right behaviors. I'm very mindful of time. We have an amazing few panels, so I won't dig in too much more. I just wanted to touch on, to end the trade life cycle, I talked about entering the trade. I talked about kind of the risk management of the trade, and I'd like to talk about exiting or settlement of the trade. So if I close this position out, so if we just take a look, unfortunately I'll be locking in a loss, but if I close this position out, hopefully this will, I just can't really see the full deal ticker, there we go. There we go, that's closed it out, and I have locked in a realized P&L loss, unfortunately. If it were a gain, if I'd made money, that would have been swept immediately to my available balance for use on other markets or withdrawal from the Ethereum smart contract. And that is essentially the system settling me because I closed this position out. If I decided to carry it through to expiry, the system will use an oracle or some sort of data source to input what the final settlement should be of that market. And we've actually designed a very generic kind of oracle framework so that anybody can launch a market and nominate an oracle or a sort of data source that performs this role. That data source could be another Vega market. It could be some kind of data, from oracles on Ethereum. It could even be you as a market creator saying, "Look, hey, I've got a good brand. You know who I am. Maybe I've built up either a pseudonymous identity, or maybe I'm on a Goldman's trading desk or something, and have some kind of reputation in the real world." And then you can also be the oracle. And again, if you dig into our economic incentives, you'll see why that makes sense in terms of being able to build businesses and have kind of long-term reputation on Vega. Anyway, as I said, this is a lightning run through. I'm really sorry, I'm not going to take questions because I'm really keen for the next panel to get on.
Freddie Farmer, Anjan, and Carlo. I'm sure they'll get to introduce themselves properly when I hand over to Barney. This will be we're going on until 7 p.m. British time, so 15 more minutes from now. Let's see how the conversation goes. I'll hand over to Barney without further ado.
Thanks,
Dave. Best, guys.
Cheers, guys. Thanks, and welcome, everyone. I just want to introduce myself very briefly. I'm one of the founders of Vega Protocol, which is a decentralized derivatives protocol, and one of the things that we've been working on since the beginning is incentivizing liquidity, both for kind of creation of new markets and the creation of new liquid markets, but also ongoing incentivization. And obviously, that's also become a massive topic this year in the kind of DeFi space as well. So we thought it'd be great to bring some people together kind of to discuss liquidity and crypto in general, how that's working in DeFi, how the difference between order books and AMMs and all of the kind of issues around liquidity. We've got a great panel here, and I'm just going to hand over to the guys to introduce themselves, just maybe talk a little bit about what they're working on and their background and how it pertains to this, and then we can get started with the panel. So, Carlo, how about you go first?
Sure. So I'm Carlo, co-founder, COO of Hummingbot. So we've created an open source market making trading bot that trades on both centralized and decentralized exchanges. We also wrote the original white paper on liquidity mining back last year before it kind of blew up in the DeFi space. And basically, if you're probably familiar with liquidity mining in DeFi, we basically launched a platform in March this year that does that on centralized exchanges.
Awesome. Thank you, Carlo. Freddie, how about you?
so I'll just come off mute. Yeah, so I was the first employee at Wintermute Trading, which is an algorithmic liquidity provider. So we would be a centralized liquidity provider who would basically do, I guess, what is equivalent to what Hummingbot does, but it's not open source. This would all be proprietary technology. So I was there heading up decentralized finance initiatives. And have left now, and I'm both investing in DeFi builders, massively interested in the AMM space in general, and kind of participate in all mannerisms of liquidity mining, which is definitely Hummingbot's original term, so you guys get that one. But yes, all of the farming and all those kind of things is what I'm kind of interested in right now.
Brilliant, thanks. And Anjan.
Hey everyone, this is Anjan here. I'm part of the investment team at Parify Capital. So Parify is an investment firm focused exclusively on the decentralized finance space. We invested in core infrastructure and applications across the DeFi space. We also serve as large liquidity providers and users of many DeFi protocols. So, we like to leverage our insights as power users to also inform our investing thesis. Super excited about all the liquidity mining stuff going on, and we're seeing some of the most talented teams in crypto work on DeFi, including Vega. So excited to be here and looking forward to the conversation.
Brilliant, thanks guys. Just a quick note, we were hoping to have Carlson from Fractal join us. He's currently experiencing some connectivity issues, so not sure if he is going to be able to join or not, but if he does, we'll kind of slot him into the panel as we go through. So really, I wanted to kind of introduce this by talking a little bit about liquidity. I spent the beginning of my career working in kind of, I guess, traditional finance with kind of trading firms and exchanges like the London Stock Exchange and a number of large investment banks as clients of mine. And, you'd always hear the term liquidity thrown around, and it was never anything that was measurable. Certainly people wouldn't talk about, liquidity in such kind of absolute ways as they do now, and it was kind of always this thing that's provided by market makers, and it was always subject to different deals going on. The one thing you always knew about liquidity was that when you wanted it, it wasn't there. So, when things go wrong, the market's going south, you suddenly found there was much less liquidity as there was when you were just happy holding onto your position. And so, even quantifying how much liquidity is available depends on a number of factors. And I think that's the kind of thing we'd like to explore during this panel. To start off with, I would like to sort of open that question out to the panelists, though, because we have a number of different ways we look at liquidity, from the Hummingbot way of sort of order book liquidity mining to the AMM and CFMM type of sort of liquidity as capital provision almost, to kind of liquidity more as a kind of intangible concept that sort of traders think about when they trade on markets. So just wanted to open it up and maybe Carlo, as you're the sort of Hummingbot, you guys define liquidity and liquidity mining. Maybe let's just sort of talk about how we each think about liquidity and what it means for a market to be liquid.
Sure. So I have actually a similar background before Hummingbot. I was in investment banking doing structured derivatives. So in that space, you have a lot of esoteric risks that you're trying to move around the market. So you have to find kind of a buyer and seller. So when we think of liquidity from our perspective here, it's in similar ways. How easy is it to trade an asset? And obviously, with the crypto market space being so fragmented and so forth, one of the key metrics that we look at is slippage. So this is kind of a measure that even CoinMarketCap introduced to some degree in their ranking of exchanges last year. So we think of it as how easy is it to trade in and out of an asset. So that means a few things. One is to some degree, it's what venues it trades on. So is it available on an exchange that's easier accessible? That's kind of the first layer. But then within each exchange is, if I need to trade, there's kind of a few factors. So one is order book consistency, like how deep is order book, and will it dissipate when the market's volatile or not? So that's one thing. The other thing is kind of like if I had larger amounts of blocks, what's the price differential I'm going to get? So basically, what are the screens showing, kind of mid prices versus what am I going to get executed at? So if you have very illiquid order books, obviously that's going to be a pretty big range, could be several percentage points. But other markets which are highly liquid, you expect to see, even for large amounts and at any time, that the actual trade ultimate price you get executed at is fairly close to the mid-range.
That's great, thank you. And so, Anjan and Freddie, do you have anything else you want to sort of add to that? Any other ways that you think about liquidity? Do you agree with that?
Yeah, no, I definitely agree with Carlo's approach, and I think an interesting perspective that Hummingbot brings is they're in a way kind of democratizing the actual ability to provide liquidity, right? By being able to run these bots and being able to provide more market making, that's ultimately helping improve the liquidity of these exchanges in a very economically incentivized way. I think the other component to think about here is, well, what actual venues are you trading on? Is this a centralized exchange? Is it a decentralized exchange? I think when your definition of liquidity kind of varies, right? In some of these AMMs, for example, say Uniswap or Balancer, which quote unquote may have a ton of liquidity in terms of the total value locked, but what does that actually mean in terms of the trading experience? Well, on the curves themselves, even though you may have massive amounts of liquidity, the way these AMMs are structured, the curve structure themselves, they may not facilitate great execution themselves. So the liquidity in terms of total value locked, or the DeFi mindset or characteristic may be there, but in terms of the actual execution, the trader may face a ton of slippage just given the inherent kind of dynamics of the AMM curve itself. And that's less of a fact, you can argue that's less of a factor of market liquidity, and maybe that's more of a factor of the actual curve itself. And that's something we can dive into kind of later in the panel, but essentially some of the differences between stablecoin trading on Curve versus stablecoin trading on Uniswap, for example. They both may have the same amount of maybe core liquidity deposited, but the slippage or the execution you get is fundamentally different.
Yeah, and I think, look, there's not too much to add to that. I think it depends what the kind of mindset you are. I think talking of those TVL metrics in DeFi, that kind of is an attempt to show the total liquidity available. But as we know, really with the trader's mindset on, I'd say it's both the ability and confidence that you can have in entering and exiting a position that you put on. So that's kind of how I just, one line, probably explain how I see what a liquid market is. And that's suitable for different sizes of traders, when considering different risks that they have to either put on or get out of.
Brilliant, yeah. I think, Anjan, you touched on a really important point there, which is kind of the AMM curve thing. And one of the ways I think about it is that what AMMs do is they don't necessarily acquire liquidity super efficiently, because, as you said, like $100 million locked up in an AMM curve is probably way less useful than $100 million worth of orders close to the bid and the offer on an order book. So, in terms of how liquid the market is, there's a huge difference in the AMM curve, $100 million versus $100 million worth of orders if they're well placed. But what the AMMs do, I guess, is they make it easier for someone to supply. So they basically increase the amount of capital that can participate, because if you're going to place orders on a book, you're going to have to deal with inventory risk, you're going to have to price them, you're going to have to actually manage your position, and in AMM you're not. So I guess, that's a core concept which I think is really interesting in the sort of the DeFi versus CeFi, like how do you provide liquidity in crypto? What are the pros and cons? We've talked about some of the cons of the AMM liquidity, the curve going in there. But, does this matter in practice? Is it actually the case does that mean that you're going to have difficulty reaching the levels of liquidity that you see in centralized markets via AMMs and via sort of CFMM type curves, or is that actually not a big problem?
Yeah, I mean, maybe I can just kick it off here. I think it's a great question. I think what we're starting to see is, we have this generalized AMM model such as Uniswap or maybe even Balancer, and what you're starting to see is that it's not a one size fit all for all types of assets, right? And I think this is where the design space is really interesting for liquidity mining and trading in DeFi specifically. So let's look at Curve, for example. They're also using the AMM model, but the curve itself is fundamentally different from Uniswap or Balancer. And what we're seeing is stablecoin trading is actually more efficient and cheaper on Curve than many centralized stablecoin markets. And quotes you can get to the OTC desk. So that to me is an automatic improvement of DeFi and fundamentally shows the advantages of an AMM, a specific type of AMM, used for a very specific use case. And I think, we're going to start to see more and more specialized AMMs come to market, whether it's for prediction markets, whether it's for options, interest rate swaps, whatever it may be. And so this allows liquidity providers to earn a passive yield, but for traders to actually get good execution on very specific assets versus the one size fits all, such as Uniswap or Balancer.
Makes a lot of sense. So, a question I guess I would sort of bring up as well. Obviously, partly providing liquidity is providing liquidity, but actually, even in this sort of the AMM style of liquidity, when you place liquidity in those, depending on the sort of ratio of how you place the assets, for instance, you're placing a view on the price of that asset, and you're helping to price it. So, one thing I'm kind of interested in, what's the relationship between like the revenue that a market maker makes, the incentives that they get for providing the liquidity, and the overall sort of underlying liquidity of a platform?
Yeah, I guess I could get started there. I think everyone generally is pretty much profit driven, so they're in this to make sure overall they generate some value from it. So I think market making is kind of it's generally very hard to make profit unless you're taking directional views. That's why you have traders on Wall Street who are market makers. They're good at it because they can make directional views. But in a lot of cases in the crypto space, because it's so volatile, it's hard to make money. So market makers require other ways to make money. So whether before AMMs, where that's like that they'll provide market making for their tokens and these things. So that's a big part of it. And what's interesting now is we've kind of seeing it evolving. So market making incentives aren't really that new. They're just kind of evolving. So I think one of the biggest kind of clear examples happening right now is like Sushi Swap. And I think like where you had before Uniswap, there is these automated market makers, you still have risk. You have the concept of impermanent loss. And we're Uniswap kind of got some traction, but the rewards there probably didn't make up for the strategy for profit. And so what we've seen is things like Sushi Swap, where it's basically the very same contract, but you're adding a sweetener of incentives. Then it comes a point, and then we've seen kind of participation massively spike. And I think the interesting thing there is that the Uniswap incentive model is probably not sufficient. And so why these things like Balance or Curve have really proliferated just in the past few months is because they've added more on top of that. And so now kind of we quantify permanent loss. And this is actually something we struggle with as well. It's how do you quantify a market maker's loss? For us, where we're introducing lots of new traders to market making, it's hard to evaluate how well they're doing. But then right now with Balance or Liquid and all these other AMMs, liquidity mining incentives, you're kind of masking that. So overweigh the permanent loss so that it becomes a less significant part of your profit calculation. So it's kind of less significant. So that's why a lot of folks are increasingly participating in these because it's a lot easier to do so. So I think right now we're probably still kind of probably too little, but then the Balancer and other liquidity mining protocols are probably too much. And so I think we'll see it's kind of will evolve, and that's something we are working on ourselves to try to see what's the right level of incentives for market makers.
Right, it makes sense. And I guess talking to bring together a couple of concepts we've been talking about there. We were talking a little bit earlier about the difference between, say, $1 of liquidity in an AMM pool and $1 that's kind of close to the best bid and offer on an order book. Obviously there's a kind of efficiency thing going on there, in terms of the efficiency of capital deployed versus liquidity that gives a market. And so, something that I've been thinking about a lot is the idea that, if you can deploy $100 more effectively to effectively provide more liquidity than someone who's deploying that into an AMM, then effectively the rewards for that $100 are going to be much higher than if you're getting less liquidity for it, because effectively what I believe is that liquidity begets trading. The more liquidity there is, the more of the demand for trading is going to be satisfied, because the less slippage there is going to be when people want to access the market. And so overall, if you can provide liquidity more efficiently, you should end up effectively receiving more rewards for the same amount of money than if you're providing it very inefficiently. Is this something that's going to make it hard for? I think there's AMMs obviously have a role in very illiquid markets where the cost of liquidity provision, the fixed costs of running the algorithms and participating are too high. So AMMs have a clear role there, because I think it's basically you don't pay those costs. There's no humans needed. But once you try and scale a market, is that efficiency problem going to mean that AMMs can't compete with centralized, or not necessarily centralized, but with order book based platforms where people can provide pricing information and more efficient liquidity? Or is there a way they can keep up?
I think I think the design, as Anjan spoke to, I think the design space of AMMs is just going to continue to increase. I think it's needless to say that at the moment they're limited in capacity. I mean, the majority of them sit on the Ethereum blockchain, so they're actually just limited by throughput as a design. And I think what they're very good at is supporting the long tail of assets, which is what Uniswap, as the original kind of proposed itself to do. I think what's kind of important is if you take a bit of a step back and you just kind of view what a centralized market maker is very good at, and whether you can abstract those things or abstract them away enough and incentivize people to apply those to AMMs, I think that's going to be a really, really exciting space to both invest in and partake in. But I think if you just look at what traditional centralized market makers, the Wintermutes of the world, do really, really well, is they're very, very efficient. So they have the ability and the confidence, in the prices in which they quote. And they also have the ability to vary those to ensure that they don't get run over. So they never take the opinion that someone on the other side of their trade has more information than them. They just make sure that in the long run they adjust, so they only pick up natural order flow. I think what's kind of interesting when you look at centralized market making, I think Carlo spoke to it itself. It's actually quite hard to make money. You need pretty much economies of scale. And centralized market makers have power law distributed, so the majority of the income from a market goes to the very, very efficient market makers who have economies of scale, very low cost of capital, and who turn over their inventory. So they trade their base of inventory many, many times a day. But I kind of feel, I guess, having had that mindset, but being so interested in decentralized finances, what's potentially clear is that what market makers aren't as good at and never will be in terms of the long tail is the rapid coordination of inventory. So they will always want to remain delta neutral. They'll look for a service which allows them to borrow that inventory so that they can remain flat in the market and quote. That's not something you necessarily do as an LP in a decentralized AMM like Uniswap. You are taking price risk and impermanent loss risk, if you can want to call it that. And I kind of think that sorry, Siri's joining the call. Spooky. It always comes up at the weirdest times. But look, I think what is interesting is I think they have the potential to be a bit of a 0 to 1. Like you may have seen, if you were to provide inventory to a market maker or lend to a market maker, you can get very comfortable with the risks they take, so they can borrow very, very cheaply. But it is potentially possible for the power buyers of the world who sit on various investments and inventory to allocate and use that capital for something very similar and not quite as competitive, but very close on many markets going forward. And I think that's where it will get quite exciting.
I agree. I think that's a very, very interesting point. And that leads me to something actually that we've been thinking about a lot at Vega, which is the idea of the kind of the incentive solution space that you create by removing the exchange. And what I mean is, when I worked with the exchanges and large banks, it's very clear that they're taking a huge amount of money out of the system compared to the value they bring. They are not actually the market maker. They might pay a market maker early on in a market's life. They might give a small rebate, but the market maker is still actually paying fees. And so if you remove the exchange and you put things onto a decentralized footing, when what you're seeing now with the rewards that liquidity providers get on Uniswap and indeed on platforms like Vega as well, is that you can basically share that revenue that would otherwise have gone to the exchange and still have reasonably low fees. And I think what's interesting with that is that you can kind of incentivize people to keep the liquidity there when they might want to take it away. And you can kind of incentivize them so that fact, like you said, making money as a market maker might be quite hard. But if you receive 2/3 of the revenue that an exchange would have made out of the trading during that same period of time, now actually it might be a profitable activity to supply liquidity to that market, whether it's in an AMM or something else. And I feel like that's a really interesting way that we can potentially create more liquidity in the decentralized space than in centralized markets. And is that something that you guys see?
Yeah, I mean, absolutely. At Parify, we work with a lot of DeFi teams very closely, and we're always thinking about, how do you incentivize the right type of activity, whether it's TVL, trading volume, whatever the activity is, using a thoughtful token design. And I think what we've seen over the past couple months is liquidity mining has kind of catalyzed the DeFi space by encouraging a ton of passive capital to come and deploy onto these various protocols. I think the next iteration of that is, look, capital's flowing. It's very fluid, right? Every new sushi or kimchi we see, capital immediately moves to the other protocol. But I think the real question now is, how do you create lock-in effects with this capital, right? How do you have a thoughtful token design that creates that lock-in effect so that capital doesn't immediately flow from one protocol to another? Very similar to how, I guess, in the centralized exchange, you have designated market makers. You don't want those market makers leaving every day or every week. You want to have some type of consistency and commitment to the markets that you're providing liquidity and using. And I think creating lock-in effects with these new token designs is going to be incredibly important to making sure that these protocols continue to have liquidity, well beyond these rewards kind of dying out and no longer playing a role.
Absolutely, yeah, and that's something in the Vega design for liquidity reward. What we effectively do is we treat liquidity providers almost like investors, like equity investors. It means that if you join the market, we value the market based on its trading volume, and if you join the market while it's small and commit liquidity, effectively your share of the rewards is higher than if you join when it's large. And the goal of that is exactly what you said, to actually give people a reason why they got in, they supported the market early, they're now profiting, so it's now worth continuing to support it. It gives you a reason to support markets that need it, and it gives you a reason not to just run away at the first sight of things. So we're thinking about some of that stuff, and I think that's very, really interesting. And something else that we've been thinking a lot about is kind of, one of the things I think is that market makers do when they provide liquidity, when they think about the risk, is they actually synthesize a lot of information, which is very hard for algorithms to synthesize, and that means that market makers tend to help with price discovery, or at least, in liquid markets with order books, they help with price discovery. And, one of the things that I think, we talked a bit about stable coins where maybe it works okay to have an AMM because you're actually not moving very much. But if you look at, some other types of situation, you can imagine, where you're valuing a company. If the company goes bankrupt, it doesn't slowly follow a curve down to being worth nothing. It is worth nothing. And I think, that's where someone like a market maker and priced orders has a huge advantage. And I think, particularly interesting Carlos's view, because obviously you guys have been thinking about liquidity mining from an order book side. How can we best integrate, how can we best make efficient markets that are liquid and that are well priced, that also provide these incentives and provide for liquidity mining and kind of, work in this sort of DeFi setting? How can we kind of marry those things together?
Yes, so what we've done is we've kind of created rules, and you work on that as well. So how do we try to quantify it? So what we've been doing is, so we're a data-driven company. So we've been actually using actual orders from folks to determine pricing, and it's kind of an iterative process because it's we have to collect a number of data points. I think we've been running campaigns for a number of issuers. So there's a lot of things that, like, for example, we weight tighter spreads versus wider spreads. But setting the right amount to do that, it's just a bit of takes time to kind of establish that. So similar in AMM space, like what are the amount of rewards, Uniswap versus SushiSwap? There has to be for us, we have the advantage that we actually have data kind of play around with some of these tools, and like what max spreads are allowable, what the spread steepness curve is and see how that impacts the market maker's behavior. So I think it's kind of still at early stages, but we're finding the right way to make. And it's kind of still, it all depends by market. We have to factor things like how volatile market is. There's lots of factors that go in. So I think just what we're going to do is create a framework, at least to kind of quantify what those risks are, and so we can align that. So for us, we think that's at least a step in the right direction, and it will just take over time, based on data that we get from participants. That's something we'll be able to refine and evolve on.
It's sorry, Carla. I had like a little thought, which is quite funny, but I can imagine I can imagine Hummingbot making for an incredible agent-based simulation for like a future AMM. Kind of using basically all of the users of Hummingbot market makers to simulate a complex phenomenon, which is to the effective and efficient provision of.
Yeah, that sounds very interesting. So, do you guys think that with the tools that we're building and have built, kind of in crypto and in decentralized markets, do you think that it's possible to build markets that are as liquid as the equity markets or the FX markets in traditional finance? Do you think that that's something we can achieve with a fully decentralized marketplace?
I think there's potential. To be honest, I think one thing right now is that's hard to see through is right now there's just not that many assets available on the Ethereum exchange. Cross-chain problem. The more there is, then it becomes a lot easier. So with a lot of financial markets, there's a lot of blockers. You have to set up accounts, get licensed, all these things. But if you have more accessible to many more people, more participants, then I think that there is potential just to have that once we refine and get over these initial kind of technological. I think there'll also be places, even in traditional markets, where I think in 80s, 90s, there was always the concept of electronic trading, sales and trading desks, obsolete and things like that. There's always going to be kind of different needs that need to serve different cases. But I think in crypto space, for general usage, for ordinary folks who are not professional traders and so forth, I think the possibility of having so many people involved and having the barriers to entry be accessible to anyone does create the potential that it could be adopted more generally by a large amount of the public.
Yeah, I would agree with that. I think it's kind of clear the potential is there, but I think we also need to take a step back and think about where we are in terms of the layer 1 and layer 2 scalability, right? Because that is a clear bottleneck right now, right? Like, Ethereum cannot support, it's already running into throughput issues right now. Now imagine when you scale the number of assets, the number of users. I mean, this bottleneck is it's a serious problem for Ethereum right now. So I think as we see improvements at the base layer, we're seeing a ton of experimentation and implementation on layer 2. That's really promising from bringing on the high volume traders, because right now it's very difficult for active traders and the really serious high volume traders to partake in AMMs or DEXs or any type of decentralized protocol, just given gas fees, front running issues, just general throughput issues. Once we have those scalability improvements in place, better UX UI improvements, then I think we could see more traditional market makers jump in and participate in more complex trading and market making strategies that aren't inherently limited today by the kind of challenges of scalability and throughput at the base layer right now.
I would say from the point of view of a more centralized market maker though, and this is the classic the chicken and egg problem, liquidity is touted a lot. Ultimately, a market maker will go if, for example, order flow just begins to aggregate around AMMs, then market makers will go there. There's absolutely no reason for not. I agree that the bottlenecks right now are preventing that from scale. Shows that these decentralized fabrics are providing a lot of value to a lot of people, or building out new business models, or even completely new paradigms of how one trades with each other. But to go back to Barney's original question, yeah, easily I think will be the answer in terms of competing with. If you just go down to first principles and you view like an Ethereum wallet as just the financial. If you view, sorry, not necessarily Ethereum, but if you view your your wallet or your account as just like a financial passport in a way, and a kind of a single sign-on to all services in the same way Google might be able to offer you a lot of products. I think you can just compare your ability to, your ability and your rights in terms of ownership of what you're doing with your finances. I think you just have to compare that with maybe, the percentage of funds held at banks versus in cash or other assets that people have under their beds. And that's really all if you're really talking that kind of scale, but will it compete? I think you really need to just look at that as the single first principle frictions to look at.
Makes sense. And then I guess sort of a follow-on question here is a couple of people have mentioned things like the gas fees on Ethereum, the front-running issues, and obviously you're going to get Ethereum 2. The gas is going to get things are going to get somewhat alleviated, but even the level of alleviation, the level of throughput increase that you're going to get on Ethereum 2 is nowhere near the level that you would expect to get anything like the amount of trading that goes on in the current off-chain world. So it feels, I guess, one of the sort of the question I'm coming to here is it going to be possible to, is it going to be necessary rather to move to move trading off of Ethereum? Like to succeed outside of crypto, is it going to be necessary to move decentralized trading off Ethereum, either to kind of, app chains that are developed specifically for trading, or at least to higher throughput blockchains? Is that going to be something that's necessary, or is Ethereum going to stay the place because of the kind of the network effects of the DeFi protocols and all of those things?
Yeah, I think, and there's a lot of folks working on solutions now. I think everyone will go where the venues works. I don't think anyone's necessarily tied to, we're at for this, like a few dollars worth of USDC, for example. It just doesn't make sense. I don't think, at least for us, or I think goes to what I said earlier, is everyone's profit driven. So everyone will go where things work. I don't think if I won't necessarily trade on Ethereum just because I like Ethereum and I'm loyal to Ethereum. If there's a venue that's better, I think I'll go there. Lots of people will go there as well. So I think it's just and a lot of these protocols are in the works, and I think we will see it's a big opportunity for those protocols right now, because in the last few weeks have really the problems with Ethereum. And so I think we'll see people continue to develop other layer ones to accommodate similar functionality of Ethereum. And once those become better, or see why people wouldn't move there pretty much immediately.
Yeah, so I guess you're sort of saying, really, there's things traders look for, and that's they want all those things we defined when we talked about liquidity. They want certainty, they can execute, they want low slippage, they want all of those features, capital efficiency, and all of that. And so when people come along and create decentralized platforms that are faster and cheaper and better, you think not much is going to cause them to stick around on the Ethereum stuff if it stays much more expensive and worse.
I think we've even seen that historically in the centralized exchange space. You had like Mt. Gox, Poloniex, Coinbase, Binance, and it's even though some of those have been established for a while and are the predominant player, every few years someone comes with something better, and everyone goes to that new platform. So I think we probably will see the same thing here as well. But once there's clearly a better product, I think we'll see a lot of folks adopt that.
Makes sense. It's something I see as well. I think I'm looking at the Ethereum space. I think in order to kind of challenge finance, I guess, then I think there's going to be a need to move outside of that solution space to solve some of those problems. We got, just looking at the chat here, we got a question from Morgan and Hemia, which is there something which, if DeFi had it, that all market makers would have to come into DeFi in order to compete?
I'll let one of you guys take it, because I kind of answered cheekily saying, what makes you think they're not already here?
Yeah, I mean, I guess as I think about it, it's less of binary. It's not as binary, right? It's not like there's no market makers and suddenly there's all market makers, right? It's really a spectrum. So you already have some pretty forward-thinking market makers kind of in the DeFi space, actively providing liquidity across AMMs, whatever the order book models are, Curve. And then you have initiatives like the Chicago DeFi Alliance also kind of bringing in some of these more institutional players. And so I think it's less of like, hey, we need one specific feature and all market makers are going to jump on board. I think it's a spectrum and it's a journey. It's ultimately a learning process, right? Are the market makers comfortable with, interacting with these protocols? How easy is it to interact with these protocols? Is the documentation clear? Is there API access? What assets are available? So I think it'll be a market maker by market maker decision. And I think they'll start small with one or two protocols and they'll eventually continue to continue to provide liquidity. But I would say it's less of one specific feature that's going to catalyze or bring all market makers on board. I do think there are a couple different pieces that may help market makers come on board. So one, maybe scalability or throughput, right? So something like a Diversify, for example, with layer 2 and Starkware integration can facilitate somewhat more traditional order book trading than say something like Uniswap. So that's kind of an advantage for a market maker. Or if you have good documentation or API access that allows market makers to develop very more complicated strategies in the traditional AMM model, that kind of brings market makers in. So I think net it's just a series of steps and a journey to get market makers on board, less of a let's all jump in at once.
I'd agree, and I think my first thought when I saw that comment was trading, right? And if trading is happening and if there's demand for more trading to happen, then market makers will make money. If there's no demand for more trading, then it doesn't matter how much liquidity they throw in, they're just going to be throwing good money after bad and making no return. So it is the chicken and egg problem. You need enough liquidity for people to trade, and then people will want to trade more, and it'll grow and all of that. And I think, for me, it's kind of one way I think of answering the question is how do you bring the flow? How do you bring the users who create the revenue for the market maker? Because when those sort of, your first token allocation to the community dries up, or your VC funded incentives or whatever they are, when you run out of those to give people, if there's no one left trading, then the market makers have no way to make any money. And so, ultimately, we've got to create that engine so that when you take those things away, the incentives and the design of the token, the design of the platforms, the design of the mechanics is actually encouraging people to create markets, encouraging them to trade, and encouraging them to make the markets.
There is actually one secret. One secret thing that is already being made as well. I don't know if it's made or designed, but I think in terms of, at least in the AMM structure, because it's so simple to onboard an asset, you get the risk that there's no filtering. So I think Anjan mentioned Kimchi. It's basically a pure pyramid scheme. It's like because you can arbitrarily set the market cap off one individual trade. The market cap of wine is very large. If someone pays $10,000 for one glass of wine and you value the whole thing on it, you'd be buying up bottles of wine very quickly and staking them in the wine ETH pool. But I think one of the killer features actually is around price discovery. So some AMMs are starting to see the long tail of assets that have not yet been onboarded in a centralized fashion. They are the primary price discovery venue for these new assets. It is absolutely paramount that a market maker has efficient and effective pricing or hedging venues. As soon as a centralized party or for example a sophisticated trading blockchain comes along, they can't hedge that risk. So in terms of something that Vega will be able to do fantastically is encouraging markets that that crypto traders are desperate for, but they don't currently have access to. That's something that's like a real win-win.
Yeah. I'll just add to that as well. I think we work and speak with a lot of market makers as well. I think a lot of the ones working on traditional exchanges are starting to look at DeFi now. It's on the radar for a number of reasons. One is even from the supply side, the new token issuers right now are looking to maybe start with AMMs as their initial listing versus the other way around, because why would they pay exchanges millions of dollars of listing fees or be required to pay millions in market maker fees where they can just launch their token first on an AMM and gain traction there at a much more economical cost to them. So then what that implies is the business for market makers to provide is to some degree going away or has decreased. And so the venue for even one of the fundamental functions of capital markets is where to list your. As we see that shift to AMMs, that could be a big thing that will drive market makers. They'll be forced to look at this space because the traditional venues where they're earning business is just decreasing.
Certainly, and I think something that I always noticed and I thought was a bit crazy at the start of the kind of the 2017 rush, if you like, was the amount of money that some less prestigious projects were having to pay and were paying to create liquidity to allow people to trade their tokens. And some of the stories you heard about what exchanges were asking for to list a token were completely crazy. And I think one of the huge advantages that the AMMs have brought is to go, well, you want to allow people to trade in and out of this, you can do that. You just fill up a pool here and off you go. I think that's a big thing. Going back to the sort of this sort of thought about people moving in, what's going to bring people in. The thought that I have is, let's imagine that we're successful at this and that the amount of traded volume and value locked in DeFi grows by like 1,000x or 10,000x. Like markets suddenly become, not maybe half of all the trading, but they suddenly at least appear on the radar of traditional finance, and they actually start to be a really significant asset class compared to other liquidity. And that means that all of the big HFTs, all the liquidity providers, all the trading firms in traditional finance come in. What would that do? Like, what would that do to the traders and the markets and the liquidity providers who are there in DeFi today, kind of living in this quite small world? What would happen if the rest of finance really woke up and took notice?
You'll definitely have less alpha. Sadly. The market will become rather efficient. Definitely rather efficient. I think you can, which is good, which is great. It allows those who are looking to take directional bets to. I think the first question we discussed was, what does it mean for a market to be liquid? So not only will these markets have great size, but you will likely, suffer very low slippage as as these markets are kind of made or arbitrage to be more efficient. I think what will be more interesting is like how they sit. Do they sit more on keeping the market really, really in line from like an arbitrage perspective, if price discovery is happening elsewhere, or do they sit inside the pools? Or, for example, could they be pool sponsors? Changing some parameters in the AMM design ongoing to help, defend against arbitrage. But yeah, it's definitely be more efficient. It'll definitely be more efficient.
Yeah, and I would add that what we may also see is kind of the passive strategies themselves will just start to underperform some of these more active strategies, right? So the passive crypto holder or stablecoin holder, right now it can deploy capital in AMM and potentially earn the same returns as another passive holder. When you have these active strategies come on board, there may be more active strategies built on top of these AMMs that may start to outperform the actual passive strategies themselves. So I think net, it's still positive for the space, because even if you have all these firms come in, they can partake in more active strategies, but there's still room for the passive holder to deploy capital in these AMMs and earn a yield, which I think is still fundamentally different from traditional markets where retail is somewhat priced out or unable to partake in any type of market making strategy, really.
Yeah. Something certainly, and I think maybe this is something that Carlo and the guys at Hummingbot, I would imagine, have thought about, is the idea of what crypto can do and what decentralization can do for the allocation of capital for liquidity provision. So if I think about traditional markets, everything's done by deals. You've got contracts. You've got to provide 60% of the liquidity on this market. You can't move money around very easily, and also the amount of money you have is quite static, sort of tied up in funds and deals and contracts. And then you look at the some of the things being built in DeFi and AMMs, and you look at the rates of return and some of the things being built on top of those. It feels to me like we're right on the cusp of a real huge improvement in the efficiency of allocation of capital to liquidity provision, because it feels like you can really optimize. If you've got $100 million to deploy, you can really optimize how much of that goes into each market to provide liquidity, and rather than kind of keeping tons of it in places where it's not actually needed right now, it can move to other places. And that feels to me like it ought to be incredibly good for the kind of overall cost of liquidity and the overall liquidity of the marketplace if you can kind of automatically deploy it.
Yeah, I think we'll see a lot more market efficiencies from this, because again, just an underlying premise that everyone will go where it's easiest to make money and where it's most attractive. I think to some degree it's kind of like liquidity arbing, if you will. So you go to whatever venue. I think now, because it's using blockchains, it's a lot easier to move assets around without traditional financial systems that have delays and things like that. I think now we can do everything pretty much instantly to some degree. It will make it more efficient, and I think it will expose wherever there's markets that are inefficient, it will just be less popular, or will have less usage, and we'll try to go to the ones where things are efficient. And as we see other players come in, even if the traditional financial players do eventually get into the crypto space, I think we'll see a lot more efficiencies overall. I think there's a lot of experience they can bring to the crypto as well, industry that could help the industry develop as well. There's a lot of valuable experience that can overall help. So I think it's a good thing. Even though short term for the existing players, the alpha might disappear, but I think overall for adoption and development of the space, that would actually be a really good thing.
Yeah, I agree. I think and I also think there's a big differentiator that can help crypto to beat traditional finance because of some of the efficiencies we can automate. And kind of on a similar vein, we've got a question from Morgan, which is, would you prefer to see similar DeFi markets competing with highly liquid BTC USD markets, or would you prefer to see much tighter but low liquidity on altcoin markets? What's better for the range of retail users who could enter the DeFi space? I mean, I'd go for both if I could.
Hi guys, last question because we need to wrap up for the next session. Thank you.
Yeah, I'm happy to kind of start kicking things off. So, yeah, look, I mean, BTC USD is it's the flagship product of crypto. I think if crypto is going to grow, the entire market is effectively correlated to that product. We're all basically kind of long skewed BTC. So yes, I would love to see DeFi markets compete, and I think that layer 2, different scalability things. We should not just layer 2, but I think we're starting to see a good amount of new products and new technologies coming into the space that will allow us to compete. I think, for example, before one of your questions was, why don't we see 10 BTC quoted each side within $5 or whatever. And honestly, that is less because it's not already possible to do that in DeFi, and actually more to do with the fact that there are no retail users who want to buy 10 BTC. You might say there are, because there are quite a lot of significant retail whales in crypto. But I think more when we speak to retail in terms of onboarding new users to the space. I think you only have to look at things like Coinbase with respect to not Coinbase Pro, but its Coinbase app generates like $600 million worth of profit per year or something. So clearly the retail users are happy with the simple design. They're happy to pay quite significant spreads for a smaller entry. So I think that slightly less liquidity, but in altcoin markets, as in more interesting products that they actually would like to trade. I think that's probably what we should be focusing on rather than just trying to.
Makes sense. We need to kind of wrap up very, very soon. I'm just going to ask one final question as we go, and the question is going to be, what one thing would you love to see happen that would drive greater adoption, greater liquidity in crypto and in DeFi markets? And for me, the answer is, I would love to see DeFi give people exposure with things like stablecoins to synthetic exposure on everything. Like, I would love to be able to get leveraged exposure to the S&P 500, to Japanese stocks, to the price of oil, really like a one-stop shop with complete global access, complete global liquidity and leverage for basically any asset. I think doing that and allowing people to arbitrage and provide liquidity on not just crypto assets, but everything would be a real game changer, would bring a ton of liquidity and a ton of interest into the space. What would you guys love to see?
I think for me, one of the problems with DeFi and DEX is things like UX. I think that's still, I would like to see it be a lot more seamless. And I think that's one of the things that prevents more users from adopting it. It's just hard to set up a wallet and figure out MetaMask, all these kind of things. So I think just having that UX, eventually better solutions for that will definitely increase adoption.
Yeah, I would agree with the UX. I think on the retail side, that's particularly important. So you have a lot of wallets like Dharma, Zerion, Argent, which are helping with that, which I think is net really good for retail. But if you're talking about in terms of actual trading volume and liquidity, that's dominated by whales, of course. They're not as focused on how the retail app looks or what the UX there is. They're focused more on what strategies can they run, kind of the programmatic access to all of that. So I think a combination of those two kind of targets both retail and the whales.
And I'm the same as you, Barney. I'm kind of synthetic exposures to everything under the sun. But I think one thing to add to that is I'd love to see that added into a slightly more sophisticated AMM. So I love Balancer, for example. Balancer is really cool because in essence, you could take all those synthetic exposures, create your index position, your passive investing, follow the market, you can't beat the market kind of stuff. but this time you're being paid to be arbitrage over the long run. So not only do you get passive exposure, but you're not being charged to mint or create those ETFs. You're being paid to have them from the beginning. And at least for us here on this call, if that happens, we'll have some very high returning passive synthetic strategies for the rest of our lives, probably.
Well, thank you guys very much. On that, watch this space, because one of the
Hello, everyone, and welcome back to our penultimate panel of the day. Today we have some proof of work and mining titans. Ethan will be leading this panel, along Leo, Ben, and Timothy, and he will let them introduce themselves shortly. They will be talking about how to decentralize the process of liquidity provision, and also how using derivatives within the whole proof of work and mining space. I'm sure they know it much better than me, so without further ado, I will hand over to Ethan, who will be taking this session. I'll be in the audience and just facilitating in behind the scenes. Bye.
Great, thank you. My internet's a bit unstable, so glitch out. One of you will have to take. Well, thanks everyone for tuning in. Derivatives, and thanks to Vega. On this panel, we've gathered three space, and they're going to be discussing products that they've used and products. While historically miners have in their operations, institutionalized miners these days. So these used. We have a few overall this afternoon, but before round of introductions, and Ben, maybe let's start with you, and then
Sure. Found out about Bitcoin back in college in 2010. Got into it in 2013. Went full into it in 2015. Quit my job. Went into mainland China. Started setting up Bitcoin mining facilities and Ethereum mining facilities. Did that for several years, mostly selling a bunch of hash rate contracts to high net worth individuals and family offices in Hong Kong who wanted that exposure without the operating risk. And in 2018, we realized that the Chinese space is extremely difficult running a wholly owned foreign enterprise, especially doing Bitcoin mining. So we left, went to North America, and I got picked up by Bitfarms in December of last year. I've been working with them ever since, and I run our mining operations and strategy.
Great, thanks. Tim, do you want to go ahead next?
Oh, yeah, sure. Well, first of all, Vega, thanks very much for having me. Excited to be here. Quick background on me. I started my career back in '96 trading in Chicago, the Chicago 30-year bond option pit. And then I left and transitioned into brokering back in 2002. So mostly in oil and gas. And then really started following Bitcoin, only Bitcoin really in 2011-12 timetable, because I had a very large client who was very involved in the space, and I was just trying to get up to speed on it. And so, and then I left oil and gas and started Biduta in 2017, about 3 years ago. So our focus is really on nonlinear products, derivatives, structured products, and we do a lot of work in the mining community. So excited to be here.
Great, thanks. And Leo, do you want to end it off?
Hey guys, my name is Leo. My first job after graduating college was also in traditional finance. So I started in Morgan Stanley structuring equity derivatives. And almost as soon as I started full-time, I became fascinated with Bitcoin. And at one point, I just decided I just can't handle traditional finance anymore. So in 2017, I joined a fund here, a crypto fund here in New York, and I specialized in heading the mining strategies and been doing that for the past 3 years. And during this process, I realized there's still tons of education that needs to be done in mining space, and there are a lot of knowledge gaps. And I want to do, my best effort to create frameworks and try to fill those gaps. So I left and started Anisha Research, which is dedicated to hash power and its related financial instruments this May.
Great.
I've been working on that ever since.
Thanks. Let's jump straight into mining discussion. I'll just give out a theme, maybe kick it off to one of you, and then you guys feel free to jump on, build on each other's thoughts, or debate it. The first theme we really want to talk about is who are the participants of a mining derivatives market? Who are the natural longs? Who are the natural shorts? And how does that differ across products? Maybe I'll start with you, Tim, if you have any thoughts there.
Yeah, no, it's a great place to start. That's how we kind of break down a market, or especially when we're looking and talking to various participants. In proof of work, I guess we should focus on proof of work today. Really, we think of course, the natural long as being the miners. And then the shorts are essentially the family offices and funds who are looking to whatever product we're talking about, or we're talking about hash or something along those lines. It would be a family office or fund, maybe looking to buy Bitcoin at a perceived discount. If we're talking about the other side of on-chain Bitcoin options, usually it typically is a market maker that would provide liquidity for, say, a miner who's looking to mitigate price risk. There could be a host of the long is easy. The natural long is easy to identify in the market, right? It's probably good to the miners. But then the natural shorts, it's not a physical commodity. That's where I come from. I come from the physical commodity market. So it's really easy to kind of identify the natural short. Say in the oil markets, it would be an airline. That would be the natural short in a physical commodity market, where Bitcoin's literally unique, as most financial markets are, in my opinion. But maybe I should pause there.
Ben or Leo, do you have anything to add to
that? I mean, not too much to add to that. I mean, Tim really hit the nail on the head. I mean, miners were default long. I mean, if we do absolutely nothing, our position is long. And I'd say if you're a pessimistic bear miner, something is wrong with your choices that you've made. But in terms of people participating in the derivative space, really, I think there comes down to two kinds of miners who are looking to do that. And the first is going to be the kind who are looking to hedge their price risk. And I think the second one is going to be ones who are looking for different forms of financing. And there's not a whole lot of, revenue streams for us or pools of capital for us to tap into as miners. We're seen as highly risky industry by financial institutions. And we're really historically looking at things like collateralized Bitcoin loans. But if you're a good, reputable operator and you've got good equipment, you've got a demonstrable history of operating that equipment regularly with good uptimes, it is actually a fairly low risk trade. You're not really betting on the risk of the operator anymore. You're betting on the price risk and the economic risk. And so I think there's an opportunity there for Bitcoin miners to get short-term capital by pre-selling their hash for these future contracts and tap into pools of capital to expand their infrastructure or, make short-term liabilities that they might need to meet.
That's a really good point. So something like maybe BitUda's structured hash rate forward contract would not only be a hedge for miners, but also a way for financing.
Exactly.
Yeah, either you nailed it. That's exactly what it is. It's really just, for miners, it's a cost of capital, right? Ben, I mean, you're making, here's debt at this price, and this is where I can sell hash, and ultimately, it's more options for a miner. Just really, what's my cheapest form of capital, cost of capital. So, but
I guess on the theme of like hedge funds or family offices getting involved on the natural short side of mining. What are some ways that you can start getting those funds interested in mining and getting them more involved and educated on it?
I spent a lot of time speaking with family offices. They're part of my primary client base when I started in 2015 building out these mines in China and selling hash rate contracts. That is a bit of a slog, and it's a completely relationship game to deal with the family offices. They're very selective in terms of who they talk with and how they treat you. It's all about the introductions and the networks that you've already had, the relationships, the clients you've already serviced properly. I think that goes way further than actually going through and explaining the math. I do think that there is an opportunity, though, for that math to be very clearly demonstrated. There are very few industries where you can go out and you can get every single day worth of data since the start of the industry, and we can, completely model out hash rate profitability over time. We can very clearly see, there's, no 12-month period where these economic conditions happened, or there's no 6-month period where these extreme economic conditions happened. And over the long term, you should be able to forecast that out a lot easier than you can, Bitcoin price. I think the hash rate futures actually are a lot easier to forecast. And especially if you're looking on a USD per terahash basis as opposed to a difficulty basis, that should be a lot easier to forecast out than the actual Bitcoin price. And so if you're going out to the family offices, maybe that's not really the area where I think this is the sexiest product. Honestly, I think this should be, highly attractive product for someone who's like a pension fund. These are high yielding short-term instruments. And if you're working with large corporates who are proven reliable operators with low operating costs and good uptimes, what's your risk? The risk is on the price spread. And, on a lot of these contracts, the yield to risk ratio, especially if it's a good operator, is very high.
On that note, Tim or Leo, have you spoken to any like mutual funds or pension funds that would be that style of investor?
Leo, I'll defer to you. We need to. I don't want to monopolize the conversation.
Yeah, definitely not mutual funds or or pension funds. Not yet. I think just from my previous experience of pitching mining-related investments to family offices and more traditional funds, I think the most common response is, okay, 100% return looks very, very attractive, but what we really want is a certain 2%, 5% return every year, and that's guaranteed. And in mining, it's while it's much more, it's already a lot more conservative compared to the DeFi investments that or some of the other investments that are that make investors crazy in the past couple of years. But there is still a general lack of certainty, proper risk management methodology when it comes to, okay, how do we think about, how do we perceive risk, how do we quantify some of how these time series fluctuates over time. We have historical data, but they're generally not good indicator for future performances. I think the big hurdle with that is just a general lack of cohesive framework to piece everything together, and not sure how all these components move in unison, and how different components such as price, how that influences hash rate growth, and how that influences fees, which is a new variable that in most recent month that started to become parts of miners calculation. So I want to touch on Tim's point earlier. I think it's very interesting that you mentioned that for oil and gas, it's very so for some of the more physical commodities, it's much easier to find natural the people to take the other side. I think a large reason for that is those commodities you can find consumers. You can find natural consumers for that kind of product. But whereas for digital assets, what are the ways to consume it? The only way that people consume it, but consume by really use it, is still speculative, right? So I think a large part of the narrative of a hash rate derivative is still going to focus on, okay, what is the best way to structure a product that makes it interesting for speculators to be willing to take on that the other side. I think the most popular way to talk about it that we have seen so far is, okay, you can buy a stream of income in a stream of Bitcoin in a discounted way. I think that's definitely one way to craft this story, but I think there's still require a little bit of more work to make it more popular.
Yeah, maybe I could just add to the, Leo's point. Those are great points. It's interesting is I'm very proud of my team. We're actually, when we have done some of these hash contracts, we've been able to introduce new people into the Bitcoin ecosystem. They've never traded Bitcoin before, but are sophisticated traders that understand, and they will, especially when the curve is we all know the curve whips around somewhat. The futures curve I'm referring to, the contango or backwardation of the futures curve. When you have a sophisticated trader, you can and you can approach them on a strategy, they're going to respond. And that's been pretty. We've done it, so it's really interesting to see that, and that's why I think this makes it so fun. In such an exciting time, and also not just to talk about hash, but even on exchange products. On the CME, we're on the CME. We're regulated by the CFTC, so we're not on any of the offshore unregulated exchanges. We're only on the CME. But like if we know that we have a miner that might want to collect yield or sell calls and just collect price or do a risk reversal, sell call, buy put, and we have a large hedge fund that wants to, wants to buy at really big size. It's challenging for market makers there's not much liquidity. We're not talking about crude oil here. So if we know that, then we might be able to line up some really big size. And do it between paper to paper, we call it. And so that's kind of interesting, too. If we talk about on-exchange derivatives, that would be really interesting. If we know somebody has a bullish bias, when we can approach miners and say, hey, listen, guys, we're bid for calls today. Those type of strategies that we would pull from our prior careers. And we're doing that pretty much all. I mean, I'm literally on the CME right now. So you're seeing all these products, I think, coming together, which I think is just great for the ecosystem and the future growth of the ecosystem. As more and more sophisticated players, it's just who we know. We know a lot of traditional folks, private equity, et cetera, who've invested in oil and gas, and it seems to be a lot of excitement around Bitcoin, and that certainly that narrative has changed, and it seems in the last six months as the macro environment seems so much more supportive, of course, of our story, I guess, if you would. So
that's great.
I think it's kind of.
Sorry, go for it, Ben.
I think it's interesting to separate out, the two different sides of this contract, right, between the buyers and the sellers of the hash rate, because most of the products that I see out there on the market are, at least in my opinion, they seem highly designed to attract the purchaser of the hash rate contract and not the seller of the hash rate. And maybe that's because, you don't really need to attract miners too much. They've got lots of different, options, available to them in terms of what they do with their hash rate. But the pricing, is very advantageous to purchasers if they understand the math and the historical math. And there needs to be a way, I think, to separate out the various operating categories, the operating risk category and the economic risk category, and match out the partners and the relative risk profiles with the price. And I think that would make it a lot more competitive in the market and attract a lot more different participants in the market. The hash rate futures as an idea for miners as a form of finance is, I think, really, really attractive, but it doesn't work if, we're assuming that, hey, this is only going to be a 3-month, contract, and we're assuming a 30% discount. For this kind of product to work, we need to be thinking a lot more long-term with our derivative contracts. Most of the contracts are very short-term, 1 month, 3 months, this quarter sort of deal, where, I think most of the risk is on long-term, short-term volatility, right? Over the long term, we're going to experience a lot of periods of really short-term volatile actions that are kind of hard to shield against. But if I can guarantee my revenue for 12 months, then all of a sudden I can actually start operating my business like I'm any other normal commodity producer, right? If you go into the oil and gas space and you're talking about commodity contracts, you're going to be talking on a multi-year time frame that people are locking in their prices. And what that enables them to do is that enables them to go to the banks, and that enables them to finance the equipment, and that enables to finance things like payroll and everything else. On a 3-month time frame, on a 1-month time frame, the risk discount is so high to me as a miner that it's not really interesting to me. It's only interesting to me when the derivative gets much longer, and then I can actually start using that as functioning working capital.
So you mentioned 12 months there. Would that be the ideal contract length, or would you even want to go further out for the entire life cycle?
I'd like to go
2 to 3 years.
I would love to go further out. The further out, the better. My biggest thing that I'm trying to accomplish with mining derivatives is I want to guarantee my payback on my equipment, right? If I can guarantee my ROI on my equipment, then I can start opening all sorts of doors when it comes to actually running my business, as opposed to being worrying about what's the profitability next week, right? Or how am I going to make sure that I can pay, off all my bills if the price Bitcoin goes down $4,000 next month and we just bought all this new equipment, right? Made all these new investments. So the longer the better for me as a miner. And I understand from the purchaser's perspective, it's, they want short risk and they want a quick payback and they want a quick settlement and they want an in and out sort of trade. But I don't really think of this product as a high volume daily trader. This is more of a long-term purchase, sit and forget about it kind of investment. How I envision it from the buyer side.
Yeah. On the other point, Tim, do you have any comments on, talking to some of these funds, if they have appetite for something within the 12 to 36 month range, or is that generally too long for them?
Well, to Ben's point, we absolutely hear that from on the mining side. Usually it's 24 months. They would love to match up their hash contract with the depreciation cycle of the gear. On the buyer side, where we struggle is they're short. I mean, there's a price for anything, right? So, but the buyers, they're going to assume price and difficulty risk. They're going to ask for a margin of safety, and that's what we've seen. So we've seen the longest deal we've done, the longest tenor is 120 days. That's the farthest we've gone. But we've priced stuff anywhere from 6 months to 12 months. And it's easier when, Bitcoin is now somewhat stable, but 12,000, we had a lot of interest. Of course, miners were looking very actively at deals out for 12 months. But we were very close on a large deal, and of course, the bottom falls out on the market, and the deal fell apart. But yeah, no, I mean, there's appetite for buy on the buy side for 12 months, but we run into counterparty risk, and we think we have some solutions. We've come up with some. My team has definitely come up with, we think, with some unique solutions for the ecosystem, but it's really, you're taking on significant counterparty risk. So we've only been able to execute right now. We'd love to grow this globally, but we've been only successful in North America because there is significant counterparty risk. Because the miner receives the capital within 24 hours. So if they need $10 million worth of hash, they get $10 million, and they buy gear. And then they bootstrap their facility, and hopefully they don't have any procurement issues, and they don't have any to deal with any issues in China, and they can bring on new gear, sell more hash, and bootstrap their facility. So it's a really interesting product if you use it, if you have, which unfortunately I know a lot of people are having issues, of course, it's almost a procurement game right now. But if you're able to sell hash, get gear online, sell more hash, get gear online, it's a lot cheaper than 30%. I think Ben was just saying that arbitrarily, but if you do the math, this is a really attractive trade if you can get the gear.
Exactly.
And that's a big if right now, as we all know, I think.
Yeah, which may be something that Leo can work on with Annika Research, and the build out times for hash rate and forecasting, over the next 3, 6, 12 months, what's going to be the new hardware that's manufactured and how much petahash, does that actually represent? Because that has huge implications for the difficulty futures.
Yeah, absolutely. So before that, I want to touch on several things that Ben mentioned earlier. I think you said something really interesting. The first thing is you mentioned the separation of operating risk versus the financial risk, which is also what Tim mentioned as counterparty risk. I think this is a big roadblock for the process of issuance of hash rate, especially you have various different facilities with a lot of physical variances, and that variance needs to be absorbed by certain entity, whether it's the intermediary that's controlling the issuance process before these hash rate becomes somewhat these contract becomes somewhat standardized and pushed to the buyer's market. So now right now the only thing that does that, obviously one is mining pool. Mining pool absorbs that variance and pay out with expected mining revenue instead of the actual mining revenue. Obviously depends on the payout method of the pool. And secondly, you have these cloud mining platforms that They source a hash rate from all these different miners. They absorb the variance themselves and pay out the expected mining revenue to the buyers of the cloud mining contract. I think this is something that will become very interesting when mining becomes more expensive, or the mining equipment becomes more expensive, then barrier to entry becomes higher and higher. And you have all these allegedly $1 million investments into mining facilities, and competition start to converge to a game of only those guys. I think a lot of processes will become more standardized, and the variance will become smaller between facilities, such that the operating risk is much smaller compared to the financial risk. So, and then the marketplaces, or whether it's matchmaking market or a commodity market, can start focusing on, okay, the design of the financial instrument rather than focusing on how to eliminate the operating risk or counterparty risk. So I think that's very interesting. And the second thing I thought that you mentioned, I want to pose a thought experiment, which I've been wondering recently is, okay, so once the block rewards goes to zero and mining becomes a purely fee-based market, and I would assume that hash rate growth will converge to a slower pace, and it will sort of stabilize to a certain range. So when that happens, would it be, one, obviously, is that going to, do you guys think that's the likely outcome? And two, if when that happens, is it much easier to predict mining rewards because the larger variables shift to a fee and a price? Obviously, the uncertainty from prices is impossible to remove. But overall, is it that combination, does it make it easier to make mining investment decisions and make it easier to predict what's your ROI time? Anyways, that's also something I've been thinking about lately.
Yeah. If I could just touch on that thought experiment, in the situation, hundreds, whatever odd years down the road, when Bitcoin block reward goes to zero and there's just transaction fees, I don't think that we're actually going to see a stabilization of the hash rate at all, right? I think we'll continuously see for all of Bitcoin's existence a constant economic incentive to develop better computing power in order, to get profit and gain advantage over other miners. So I don't think we'll ever see a complete flatlining of the hash rate. What I do think will happen is that mining, in my opinion, over the next 20, 50 years is going to be adopted by a number of electrical utilities and distribution companies and primary producers and that sort of clientele as operators. And I think it's going to get entirely predictable. What I think will happen when the transaction fees go to zero, I think it's going to become gambling again. And I think there's going to be a lot of people that are interested in buying hash rate for very short amounts of time and trying to gain advantage just on a gambling basis, like it's roulette. In which case, the mining profitability is going to become even more distorted and volatile.
Yeah, absolutely. I think this is this also related to the duration mismatch between the buyers, the duration preference between the buyers and seller, right? I think in Ethereum we're starting to see some of the discussion shifting towards that direction on how to capture some of the fee dynamics, because this is a relatively new thing that fees are so high, and it's driven by a sustained hype or whatever, movement, whatever you want to call it. And there are new conversations around, okay, how to extract more value from miners, and how to front run them, or just make it a standardized business to pay higher fee to get your transaction prioritized, sort of like high frequency trading infrastructures back in when before that whole the underground cables were built out. So I think there's a lot of very interesting developments in that arena that we can study and borrow from when Bitcoin inevitably shifts towards a higher fee territory.
Yeah.
But I do want to ask. So I think this time preference mismatch between buyer and seller, I think it's inevitable. The question is there a way to introduce, intermediate steps to break? The issuer just does issue a very long-term contract, but when it comes to, but it goes through several steps. I don't know what it's going to look like, but is it possible for it to go through several steps and break down into smaller contracts with short durations, potentially with overlaps when it interact with the buyer?
Yeah, I don't see why that couldn't happen. You could have hash rate holding companies, that are speculating and trying to resell on a short-term basis to investors. I think I can definitely see a market for that emerging, especially as we transition off to Fortune 500 energy companies, who are deploying at small scale, very decentralized, integrated into the infrastructure with a very low cost of production because they're using marginal electricity, right? In which case, then the operating risk also gets decentralized and distributed and reduced because it is a Fortune 500 company that people just, due to a number of different factors in their history and their legacy, will just trust them being reliable operators and provider of that good or service, right? So I can definitely see a market for that developing, an intermediary market that's going to say, hey, we're going to take the risk on a more long-term basis and try and make some extra profit, selling on a shorter term basis to different investors as needed, for sure.
That's really interesting. Tim, would love to get your perspective on this too. I know it was announced that some of the Biduta contracts had multiple buyers, so a buyer would take it and then pass it off to another. What was the most amount of times you saw it switch hands in those 120-day periods?
We only did one deal in the secondary, so we only, so that was, these are all really, as I think Ben alluded to, they're typically buy and hold or set and forget, or some people, but others do some more, sophisticated strategies around their length. But the majority, I think, of the buyers are looking to acquire Bitcoin at a perceived discount. If you bought hash at 12,000, like we had a deal lined up a few weeks ago, and you saw a fall off in price and difficulty rising, that's not too good for the buyers. So, it is various strategies that the buyers employ, but typically it's someone looking to acquire Bitcoin at what they think the buyer thinks is going to be a perceived discount.
Got it. I want to dig into the concept of discount rate that you talked about, Ben, earlier. What do you think would be an acceptable discount to pay for a miner, say 12 and 36 months out? And how does that differ between a contract where you're using it for fundraising, like a hash rate forward, versus a future where it's simply a hedge?
Well, honestly, I'd have to compare that to my other forms of capital, right? And the area where I'm really focusing on it, I'm not looking to hedge my Bitcoin price. I'm not concerned about that risk. As we talked to them, I'm just so inherently and optimistically bullish. I'm not worried about that, and I don't think it's worth the effort and the cost to hedge the price on the downside for what I think is going to be a short-lived event, right? I'm not concerned about a structural correction where Bitcoin goes back to $3,000. I'm worried about a short-term blip, where it dips down to 6,000 or whatever that might be. So if I'm going to look at it in terms of a capital raising perspective, I've got to compare that rate to other pools of capital that I can tap into, right? And so looking at equipment financing, what I would experience, and this is from both oil and gas, and looking at equipment financiers in the space right now, the acceptable range is 12 to 16.5% discount. Now you're going to have to add in 12.5 to 16.5% interest, right? But then we got to add in some discount for time, and we got to add in some discount for risk, and that becomes a lot harder to price. I'm actually not sure what would be an acceptable range, because it's all going to be determined by my other cost of capital and my opportunity to reinvest that into new equipment, which is, as Tim said, is not guaranteed right now. Every day we talk with MicroBT, and there's a different amount of hardware, and it's different models, and it's different delivery dates, and there is no for sure in this business. So I don't know what my fixed price on that is, but I'd be aiming for 16.5% on a year, and I just understand that's probably too low for most investors, because that's what I can get on the equipment financing.
it's some percentage points higher than equipment financing, or I guess like the range is shifted up a bit because of that additional risk, but it's somewhere within, you know, the ballpark of ASIC financing.
It should be comparable to equipment financing, you know,
Right.
and I can understand there's a spread, you know, I'm not sure how big that spread should be, but it should be comparable to equipment financing if that's what I'm using it for.
Yeah, and Ben, to your point, it's really your decision. I mean, we're agency brokers, so we don't take any proprietary positions. It's totally dependent. We defer to our clients on if they want to hedge. If Ben doesn't want to hedge to the downside, certainly. Well, then we turn the discussion. Would you look to employ potentially yield enhancement strategies? Would you look to sell calls or call spreads? Would you look to, you know, or we would try to maybe also alert Bitfarms or Ben if we were engaged, you know, and we are always just trying to communicate to our clients. Right now, we think structurally, we think that the U.S. election is going to cause a catalyst of volatility. So we're encouraging our clients at least to entertain the idea of hedging downside. That we think there is going to be significant volatility. We saw this. I mean, we unfortunately did see the out of China. I think most of us saw what happened with COVID in January and February, and we put out a research report that this was going to, you know, potentially lead to a real a tail event. And we spent a lot of time on that. But I think probably all four of us saw, you know, we had some insight of what was going on in China, I think, than others didn't. But we certainly think that the U.S. election is going to cause potentially is going to be a real catalyst for volatility. So we're encouraging all our clients to just consider that. But if they don't want to hedge their downside, that's fantastic. They're a low cost producer. That's great. But we're also saying, you know, I think I'm in a very unique position to advise clients because I traded my own capital for a long time on the floor in Chicago. I blew out twice. Once I was long vol, the other time was short vol. So I've been there, and please learn from my stupidity. And so it's boy, when you're in a, you know, during the some of these macro events that have happened, when I blew out, it is you know, it's nice to be hedged and positioned properly to take advantage of some of your competitors who might not be. So we just want our clients to be thoughtful about their hedging, and if they tell us, listen, guys, we're not worried about the downside, we've got tremendously, you know, attractive power prices, etc., then that's great. Then we talk about maybe turn the discussion to different topics. But some people are, you know, definitely ascribed, you know, they work with us and we optimize hedges, and they want to hedge at least a percentage of their production. So
yeah, I think most Bitcoin miners do want to hedge a small percentage of their production. You know, and as an operator, we can do that a number of different ways, because the real risk that I'm worried about on the downside is not being able to make short-term liabilities because of a short-term blip in the Bitcoin price, right? And we can hedge that risk in a lot of different ways. And so that tends to be the approach that I go about it when structuring a Bitcoin business is having things like ample cash reserves to make sure that we don't get stuck in a pinch where we can't meet those short-term cash liabilities. But yeah, there's always a cost and a trade-off to those sort of strategies.
So I'm trying to weave together some of the insights you brought today, Ben. It sounds like a hash rate based contract is the most interesting to you. And maybe is that something that would be on a Bitcoin basis versus a USD because you want that Bitcoin exposure? Or would you rather those contracts be settled in USD?
I think the USD settled contracts will be a lot less volatile, just because that kind of acts as a compensation factor. I think the Bitcoin, if it's physically settled in Bitcoin, especially if it's physically settled in Bitcoin at the end, then that actually adds in kind of an interesting speculative gamble part, where you're not only talking about, okay, what is the value of this cash flow over time, but what's the future value of this cash flow that we're earning now. I think that would be a really interesting contract. For me, I would honestly prefer, as the provider of the hash rate, I'd prefer a USD settled contract because I'm trying to cover my USD based liabilities.
Yeah, to Ben, I mean, Ben's point, exactly right. You would want to match up your assets and your liabilities, and so that's why we use the term plug and pray. around here for some folks. It's kind of shocking with some of the mining operations we've spoken to. It's pure, it's literally gambling. But that's kind of foolish. I mean, to match up if your assets and liabilities are matched up in USD, if you're, that would be somewhat foolish. And hope is not a viable business plan in our minds. So, yeah.
But Leo, would love to have you weigh in here. Let's say you had all the regulators yours, you had a huge dev team. What would be the best product you could bring to market for miners? What would that look like? And, would that be multiple products, or what do you envision like a really good future for miners in terms of derivatives?
Yeah. Okay. So I think the most ideal, and this is completely ignoring the technological path and as well as the feasibility of this. The most ideal is obviously in a public exchange where units of hash power is being traded like commodities. And these contracts are the physical variance is being completely absorbed by some form of intermediary, whether it's the mining pools service as custodians. But there are many challenges to that, right? Like one, it's the pricing of that is impossibly hard, and you need just so much more education. You need so much more advance in just even the academic studies of what the hash rate return really is, right? Because right now, when you purchase a unit of a hash rate, ignoring the operating risks, you are purchasing a trivariate option. Like you are speculating on price, difficulty, as well as fees, and this is most of these kind of high dimensional options are OTC products. So that's why I think Tim, your approach of starting with OTC first is absolutely the right way to do it. I think Jeremy Rubin has PAL Swap, which hasn't really gained any traction. I think any first attempt at creating a public traded hash rate product is going to face a lot of difficult challenges, not just from regulator. I mean, that's a huge challenge, but it's not even the biggest challenge yet. The biggest challenge is, okay, how do you even explain this to people trying to speculate on this? Most likely, you're going to have something like that similar to FTX's implied hash rate index, where there's no volume, right? It turned out to be a gimmick. I think, but to go back to your question, if I were to implement a peer-to-peer based, a peer-to-peer hash rate based derivative, I would be considering something like a discrete log contract. I think that is just designed for this kind of forwards. And obviously there's still a lot of problems with discrete log contracts. I think it needs to be fully integrated with Lightning, but there's a lot of challenges. But I personally really like that path, even though it's far from mature. Yeah.
Great. I think we have a few minutes left, so maybe we'll get like a final take here from people. Tim, would love to hear your opinion too on what Bidu is planning for the future in terms of some of these products and what miners can expect in terms of derivatives they can leverage to better hedge their operations and better finance.
Well, one, I'd just like to say, and I'd love to talk to the Vega team more about this. It's just the OTC, we feel, we're regulated. So we're regulated by the CFTC. All the trades we do get reported into a swap data repository. So we started from a regulatory standpoint first. We want to understand I've only run regulated firms. All our chat conversations on a recorded lines and chats, etc. So we went about it that way, become regulated first, and then try to understand and really what we've seen, and I've seen this for 20 years, that the OTC market is very cumbersome, and it's great. I mean, there's a lot of agility you could do. I can do an OTC deal, structure it, send it into ICE Trade Vault, have it done. That's great for agility, but it's cumbersome. So I think what's very exciting is to kind of tie this back into today's discussion about DeFi and all this. And I've got to tell you, I'm just trying to learn as much as I can. I can't. This is fascinating. But would I love to see more capital efficiency go in the OTC market when we're doing these contracts? So I see them going on exchange to ICE or the CME anytime soon. No. I don't think the FCMs will pick them up, and to Leo's point, it's going to be very hard, to get those on exchange. But they can happen in a regulated firm like Biduda. We could do that, but I think there's tremendous room for improvement with working with in trying to improve the whole concept of OTC bilateral trading, capital efficiencies, onboarding, et cetera. So that's what we're really excited about, making the process a lot less, much more efficient and inclusive. So, but those are my thoughts.
No, that was great. And then Ben, maybe a final word. What would it take for Bitfarms to start engaging in some of these products? What products you're excited for, and maybe just wrap up on that note.
I think the only thing that we need to engage on these products is to have competitive yields to other forms of capital. And just a quick note, I think maybe one of the things that really needs to be done in this industry, or that's holding this particular sector of the industry back, is maybe just marketing, because I would think that a hash rate future, although it's composed of multiple variables, I actually would think of it as somewhat less risky of an investment than just buying Bitcoin, on whatever date that you're buying it, at whatever price that you're buying it, and holding for that same period, right? So especially if we're talking about the 12 to 24 month contracts, if everything's competitively priced, it's hard to find a time period historically. You look back at all the data from Bitcoin when it started. Is there a 2-year time period where it made more sense to buy and hold as opposed to invest that same amont of money in mining equipment and get the revenue stream for 2 years and accumulate the Bitcoin that way and get the price appreciation that way? So I think it needs to be, I think we can angle it that way, and you can market the hash rate futures as a less risky form of investing in Bitcoin, as long as you remove that operator risk out of the component. And then in terms of the more retail side of things, it's honestly what a hash rate future is. It's a tradable cloud mining contract. And I think that's how it probably needs to be argued. I mean, Genesis Mining built up a $1 billion business, on cloud mining contracts that are not competitively priced at all if you do the math. And so if you can create there's obviously a demand for cloud mining products. If you can create a place or a marketplace where people can buy into the exact same product, but have the ability to, have that product be market price driven, and also have the ability to trade out of that product, I think that becomes really attractive. And I don't see what the difference is structurally between a tradable cloud mining contract and a hash rate future, as we describe them.
Just to use our last minute here, what would this type of instrument mean for like a public mining company like Bitfarms? Does that change the risk profile? Do you think leveraging these things will increase valuations across the boards for the publicly traded companies?
I think it would simplify our operations a lot and give us access to huge amount of capitals for us to scale up quicker and faster than any other mining companies would. I think you'd actually have a really strong incentive then to become a publicly traded company and to go through all this regulatory and auditory processes that typical miners don't go through. We're audited by a Big Four company. What Bitcoin mining group can say that? And so when we go into conversations with other large institutions, we have a couple of different things that we can quickly say. Hey, we went through the Ontario Securities Exchange Commission with a long-form prospectus. We didn't go through, the back door, to get listed on the exchange. We checked every single one of their boxes. Hey, we're audited by Ernst & Young. Now we're audited by PwC. These are major boxes that you need to tick. And my experience is when it comes to getting people comfortable, people are most comfortable when they see other people are comfortable with it, right? They don't actually want to do the due diligence and the audit work themselves. They want to see that someone else did it, and I trust them to do that work. So I think if these products did
get to in that time. So I will hand over to Tamnin, who will be chairing this panel, and then she will kind of lead you through the introductions and take you through everything, while I'll be hanging out backstage as usual. See you.
Thanks, Dagan. So I'm super excited about this panel. I have been for, 2 weeks or 3 weeks or whenever it was that I decided that this is what I want to talk about. And I'm really, really delighted to have these amazing panelists here today. So I'm working around my square box here. So in no particular order, we have Stani, who is the founder and CEO of Aave. Am I pronouncing Ave right? It's
Yeah,
written
yes.
and talked about everywhere, but just double checking. Who are doing incredible things in the decentralized space, finance space, hugely innovative and yeah, really pushing boundaries. We have David Newell. I'm not sure if I pronounced that correctly. Newell.
Actually, it's Nelly, like the rapper, but you know.
Brilliant.
But you know, any way you want to pronounce it is fine. So.
I don't want to pronounce it rapper.
Or wrap it.
Yeah. Right.
Nice. David, industry veteran, Chicago trader of pushing 30 years, maybe longer. I don't want to presume, but super excited to have David join us and give us a real perspective. I'm sure David's seen a lot of changes in markets, and in our conversations, been super excited about sort of this innovation wave that we're seeing at the moment. And Mona Alisa, who is the founder of Avant-Garde Finance and the Melon Protocol, and a huge, sort of really good friend of Vega. We're very interested in what Mona is doing in the decentralization of funds management space, and we are really looking at the moment on how we integrate that with Vega. And Mona has been a thought leader in the space for a long time, so I'm really excited to talk to you all. Just want to let everyone know that there may be a fourth panelist join us, Anton from Flovtech, who is a liquidity provider. He's, I think, struggling to get on technically, so sorry about that, but if he joins, we'll just loop him into the panel and the conversation at the time. So I've given like a very sort of my perspective, quick intro of you guys, but I'd love to hear a little bit more in your own voice about yourself. And I was thinking it'd be kind of cool to, in this panel, I really want to explore the future of financial markets, of derivatives, what happens when we, with all this sort of new tech and the ability to run things very, very differently, both in terms of governance and technology and movement of value and settlement and risk. What are the implications going forwards? Let's sort of daydream a bit, and we'll be looking forward. But I thought it'd be kind of fun to start with looking backwards and say, 10 years ago, what were you guys geeking out on? What were you thinking about? What was interesting you? I can certainly put my hand over my heart and say that I never in a million years back then thought I'd be geeking out over sort of market structures, microstructure, macrostructure, but I am, and I'm loving it. So yeah, over to you guys. We'll start. Shall I keep going around the square? So I'll start with you, Stanley.
10 years ago, right?
Yeah.
Well, 10 years ago, I think I was still a DJ who tried to get into law school in Finland, and but I finally made there. But still, I was actually doing quite early financial applications. So before law school, I actually did software development, more in mobile applications and Web 2 applications, and related to finance. I think one of my kind of goals was focus more on working capital finance and advancing payments for game developers and other. Pretty much kind of something like you could compare to invoice finance. So I did have like early take on finance, and not much in the derivative space back then, but more for like debt, lending and borrowing. That has been always a bit even early something in my mind, and I wanted to work upon. But in terms of like derivatives itself, I think the once I got more involved into the Ethereum and got involved to lending and borrowing on Ethereum, I started to notice like actually the power of derivatives when things started to get more tokenized, and whether it's basic interest bearing tokens that we have in or any kind of like derivatives that are built on top, and I think the space has been like pretty moving quite fast. So I would personally not imagine anything like this happen. I was more towards the direction that
we will make everything digital in one way, but I would not imagine that there will be a platform where everything is kind of like interoperable and permissionless. Because the cool part about this permissionless technology is not just that you can use permissionlessly different kinds of products and services built in one blockchain network, for example, but actually you could actually build those services and products. So it's a rare, like as a builder, it's kind of unique position where you can just do whatever there is in one particular blockchain network and try to combine different kinds of protocols and make financial products and create value for end users. And like the way I used to develop things is you first need a API key, you need to request a access and so forth, and especially if you're interacting with 2-3 different banks and try to combine something, you kind of need to obey their rules, their policies, get the access tokens, and it's more complex from the builder's perspective. So I'm pretty happy like where we are now, like looking back in the early years, and still I don't have that much experience. I mean, I've been in Ethereum like for three or so years, been building Web 2, but it's always been more of a hobby. And this Aave, and before we were Eatland, it started as a kind of like a community project and just escalated a bit. But I'm happy where things are going. There's still a lot of risk involved that should be handled some more diligent way, but yeah, it's been interesting.
Cool. It's super interesting to hear of your sort of I feel like you've sort of followed the technical innovation personally. Like you've been quite involved in Web 2 and then reached the limits of it and been sort of dug into the Web 3 stack. What about yourself, David?
Sure. So 10 years ago, I had no clue that any of this was anywhere near the horizon. I hadn't read the white paper. I was completely unfamiliar with Bitcoin. I'm not a programmer by trade, and I program lightly now at best. So the technical side was completely outside the realm of what I was focused on. It so happens that 10 years ago this week we launched a new initiative that was speeding up. We're basically in the arms race, the centralized derivatives arms race, as it were. And we had just implemented a bunch of FPGA solutions over a brand new line that became known as the spread line, and we were focused on making things faster. And so my role, I'd been working. I'd created a hedge fund, and we ran that successfully, and we got back into prop trading. So this was in a prop environment. So it was kind of something new and different. And so the twist of events that led me here is probably unlike anyone else, because number one, I'm a boomer, a bit of a dinosaur. I started trading in 1987 on the floor of the Mercantile Exchange. I would say I've always been interested in the technical side of what we were doing, but I had no clue on where it was going and where we are now. So
you will have seen a lot of change in the tech around markets, obviously, throughout your career. How do you sort of feel this compares? Do you get a nice tingly feeling about what's going on here? Are you skeptical?
Well, I know. I think I would say this is very similar to the dawn of electronic trading, with the exception that it's kind of in an n-dimensional space, right? When we started my company in 1993, everyone was screaming and yelling in jackets on the CME and the CBOT and the Life, and I'd moved over to London, which is my tie to London, to trade on the Life. And so we were very early on in writing the gateways from the exchanges onto our platforms, and very early on in the trade algorithmic trading. At the time, and this will really date me, people said there was no way people were going to be able to trade an option on algorithmically. It wasn't going to be possible. So I come from the perspective of rapid change, and that was originally the business that we started in London and ultimately sold. The business morphed quickly. I look at this space, and that was all about centralizing quickly, I suppose, right?
Right.
And I look at this space again, very similar, with a similar evolution in that there's a new paradigm shift, but it's the fact that things are not going to be deterministic, and you're going to have probabilistic outcomes and far more kind of different possibilities. So I look at this as a liberation in many ways. We have a kind of a tagline for ourselves internally of liberating transactions for the way of the space. Yeah. And it's really true in so many ways. You're not caught in the web of spending more money, having to get with the protocols that are told to you, and you creating your own development within whatever protocol you want. So it's been an eye opener. It's quite an experience, and I'm excited where we are as well. So.
Oh, thank you. Super interesting. Mona, what about yourself?
Yeah, so 10 years ago, I was actually thinking about that, and it brought back a few memories. So I think there were two things I was kind of geeking out on / excited about. I was still working in traditional finance. I just moved almost exactly 10 years to the day. I moved to Switzerland and started working in a hedge fund after leaving nearly a decade on the trading floor with Goldman, and having lived through and traded 2008 financial crash. And I became a little bit, I went through, this really does sound geeky, but I went through a period of my life where I joined a book club, which focused on reading books about the economic crisis.
Oh, wow. There's a book club devoted to that theme.
Yeah, it was. I'm telling you, it was pretty geeky. But we, one of my motivations for that is working on the trading floor. I think you were working on a trading floor in 2008 as well, Tamlin, so you probably remember. But in 2008, it was 2007, even the build up to it as well, and 8, and even the beginning of 9 was such a fascinating time. But being a trader, it also passed so fast. It just kind of passed in a flash, and it was like having front row seats to the most dramatic show ever, but also not really having time to absorb it because everything was moving so fast and so quickly, and you were the one making the market, so you didn't really have time to do anything else. And so I went through a phase of really geeking out on the exact details, replaying them, reading the juicy gossip and stories about what was happening in the Fed, who was meeting who, and loving kind of seeing names that I knew or people that I knew in some of these books or had seen, walking past me from time to time. And that was, that was one thing I was definitely geeking out on, apart from the actual investing, which of course I was still doing. And I also went through a phase about exactly 10 years ago where I think, all the Syria stuff was kicking off, and it seems like an age ago now, but there was the whole influx of refugees into Europe was beginning for the first time. And I'd gone through this phase of trying to, do charitable stuff, and in between my gardening leave, for example, I'd gone to volunteer for a charity in India, a microfinance charity, and I'd done a few other things, in my free time before, and I never really was that convinced by the concept of charity once I'd actually done it. I mean, I was obsessed with it before, but once I'd actually experienced it, I was like, I don't really see how this empowers people. You're basically kind of teaching them to become dependent on donations, and I don't really get that as a business model, and what it actually, oh, not a business model, but as a model, you know, and I don't really understand how that's scalable and how it actually gets people ultimately out of this downward cycle. And so I started to become really interested in ways to help refugees that was more empowering. And I won't go into the details of it, but ultimately it was an interesting time for me because I ended up being involved in efforts to help certain refugees, who kind of had entered Switzerland and had made it through somehow, and trying to, rather than just give them cash or give them, whatever, rather try to help them find opportunities to empower themselves. And so I think those were two things I was focused on. I also was totally not into Bitcoin, and like maybe just a small funny story. My brother has worked at Google for a long time now, and I remember having a family dinner about 10 years ago where over dinner he asked me, "So what do you think about Bitcoin?" And I said, "What's that?" And at which point my brother, who hated all bankers and finance people, started raging about how, you're so stupid, you guys work in finance and you don't even know what Bitcoin is, like you call yourself a finance person. And, so that was actually the first time I'd heard the word Bitcoin. And, I never really dug into it until a couple of years later, but it was, all of this stuff happened about 10 years ago. So.
Awesome. So interesting. So yeah, I actually was born in sub-Saharan Africa. So I have also and spent some time there as a child, and I've also done some business there. And it's something I think a lot about, your comment about philanthropy, and what I think the way I look at things, and this is an idea I kind of want to run past you guys and see what you think. But like I feel like a lot of philanthropy is about basically the fact that at least in sub-Saharan Africa, the risk profile of people there, people running businesses, but individuals, is just completely different to my risk profile. So, the sense that, an extreme weather event, which sadly, obviously, with in the last sort of 10 years, we're seeing a lot more of, can, actually significantly sort of alter an entire family's, livelihood and futures, is something I'm sort of, it's like I'm very uncomfortable with it. And given that, like, I'm a professional in terms of unbundling, trading, swapping risk, I sort of feel like there's something that's got to be done there. And of course, I've seen like the emergence of, different microfinance, initiatives and other such things. And I guess I was just wondering, like, how you guys think, like, if we get to a point where we have this, much more global economies and much more ability to much more quickly, cheaply, and maybe more targetedly, I don't think that's a word, address people's direct risk needs, is that something you guys think is a way that markets might evolve? Yeah, I'd just like to hear your guys' thoughts on it. It's something I think a lot about. I don't have like some concrete ideas of how it might all evolve, but yeah. Anyway,
I'll jump in and comment. So, centralized finance is about commoditization of risk, right? You've got to create, in my mind, you've got to adhere to what the commodity rules are that apply to your particular risk needs, and they may not be perfect. I'll give you a great example. The CME tried to launch a while back a housing index across a wide variety of different regions based on the commodity on the Shiller index, and basically failed, right, as far as I can tell, because it was way too specific to get a group of people to agree to the commodity, the commoditization of principle, basically. Now, I look at these markets. People talk about risk mitigation, and I'm thinking more about risk transference, right? For every, and in theory, for every risk you have, there's somebody else bears the other side of the risk or has the benefit of the other side of the risk. So the question becomes, how do I price that value? What's that value? And what the promise of derivatives within this space is that you can specify risk and then price them based on individual needs. Now that's a lofty goal. That's very aspirational.
Yeah.
But the ability to have different oracles, the ability to have assets collateralized against risk, those are the kind of the building blocks of this. And and that's where I think that this will go, right? Where we go from less risk commoditization to more risk specialization and specification. And that's one of the things where I think I'm so hopeful that this would lead to broader and broader adoption. So that's kind of my initial viewpoint on it.
That's super interesting. And just while I've got you, David, like, do you have any sort of examples of what you see in the world right now that you think it's like unhedged risk, but it just can't get hedged because there isn't a market there, or it's something people are just used to bearing potentially and don't realize that could be, transferred basically.
Sure. I mean, you could imagine house prices at a very specific level to become derivatives contracts. Or building prices or anything. And who would write a contract, a price derivative on a commercial building? Well, before it was very difficult to find a commodity that necessarily covered it. You'd have to search for the right index. It may not exist. May be very illiquid. There may be a large buyer willing. Number of participants who are willing to write the contract on their home for whatever reason, and then embed it in some kind of contract, embedded in a smart contract, as long as it bears, some kind of revenue to them. I know for a fact that there are people who are looking at this particular kind of contract. So it becomes a future on a specific home price.
Interesting.
That's just one concept, but you could extrapolate that out to millions of different scenarios, and that, the fact that you've got collateral to this, you've got potential oracles to this, it's really an imperfect solution today. But what's that going to look like in 2 or 3 years, right? So I think the move towards specification and specific instance is really going to be where the blockchain has the biggest benefits in terms of.
It's really, really interesting. What do you guys think?
That's a great point, which I'd never really thought of before, but it's very well articulated by David. And I think we're already seeing it, but I think, the possibility now to just go onto an interface like Vega, be able to spin up any kind of contract, derivative, etc., in a matter of a few clicks, hey, it's not the end of the world if no one takes the other side, but at least you've got your wish out there. You've put out your market, if you want, if you like, or your position, and you're looking for the other side, and there probably is someone in the other side of the world that might be looking for the exact opposite side of that trade, or that you can meet in the middle. So I think it's pretty fascinating that, it's a nice way to articulate it, that the blockchain empowers that kind of specialization of derivatives that may not make it to markets otherwise.
Yeah, that's fascinating. Someone earlier actually talked about like a sort of global RFQ market, and I really liked that. I was like, yeah, it's like people's sort of desires, and that global RFQ market, the way I see it, doesn't even need to be populated by a human. It can be something that gets detected as a need, as a risk need, by any of the kind of predictive sort of tech that's out there, or any of the sort of any sort of tech that's looking at, say, a weather forecast and realizes that this human has an increased risk profile, or this business or whatever, and can actually sort of start to just on a much more efficient and shorter time scale start to try and unpackage that risk and connect with people, like you say, Mona, who might be willing to take the other side of that. I find that fascinating.
Yeah, and the great part of it is you sort of really disrupt the layers of complexity that would typically lie within setting up a market like that. And I think I think empowering is a word I keep repeating, but I think it is really empowering that anyone can try to create, or a group of people who are all facing the same problem can try to create a market. And as long as the right price is found, there will always be someone probably willing to underwrite that risk, as long as as long as the risk reward is worth it.
Yeah, exactly.
I keep coming back to the Lloyd's of London model for insurance, right? And Lloyd's of London had built a great business around insurance because they were able to find, they had a pool of people, and I don't know that much about them, so that may be speaking, but my analysis is they had a pool of people who were willing to underwrite anything for a price, basically. And you would, if you couldn't insure something, you would go to Lloyd's of London, right? Well, now that was great if you're, insuring bridges or huge capital formation, but when does it get to the micro derivative level, right? When can individuals start to participate? And if they're willing to take some risk and get some kind of payout in it, you could imagine an enormous market for very bespoke things that you couldn't possibly list, right? And so the Lloyd's of London model is a bit of a kind of, I would call it a peer-to-peer kind of, no pun intended there with the Lloyd's crowd, but there would be a model that would be potentially propagated on an electronic scale at a much smaller smaller level to numerous people around the world. So I find it fascinating and very exciting. So
yeah, what do you think of all this, Stanley? You're obviously very deep in the ideological space of this. I'd love to hear your thoughts.
Yeah, for me, this is very, very fascinating. I like the kind of like the background on the Lloyd's of London, because it's kind of reminds a bit of decentralized finance in the way that now you have a lot of like very established financial markets, and on the other hand, you basically have now something very permissionless in sense that anyone can participate, create a market, and actually get insured and do that risk transfer. And I think it's very fascinating in the sense because there are a lot of people who are willing to take the risk, and they might have received gains from other risk transfers that they could actually take more risk and insure more things. And for me, that makes a lot of sense. And I think now, if ever, this is more important in the sense that I think like in terms of developing countries, but also in terms of technology, things are moving super fast. I mean, when we started to build our technology, it was so novel, so there wasn't that much of a, so for example, venture capital involved, so the risk was very high in that sense. And if you look further, I mean, the technology will just expand quite a lot. I mean, we will see a lot of examples where we might see, for example, some kind of like a credit default swaps or insurances or options in related to, for example, space flights and all the stuff that they are carrying with their rockets, for example, and the whole space there. And this is just one aspect of the tech and innovation. I think there was going to be like many fields that are going to evolve, and somehow those risks needs to be transferred. The current markets are sophisticated in the sense that it's not always easy to participate in terms of like globally and in permissionless fashion. And I personally would love to. Maybe I have like a weird perspective, but I love to do my financial decisions by myself. I like to decide how much I save. I don't like to. I mean, I'm risk aware in the sense that I kind of understand risks. I'm okay to disclaimers and so forth. I mean, but I would like to decide where I invest and how much I have upside and downside. And I think there's many other people like me out there that kind of like don't want to be limited in that sense. And I think definitely we'll see some related. And in terms of like derivatives itself, like in tokenization, it really allows quite interesting access, because let's say if you're basically having a weather derivatives or related to crops and let's say the agriculture industry, you can actually build applications on top where if you're buying, for example, seeds, you are basically putting options and other derivatives on that. And that's just one, like the classical farmer example. It fits very well now in the DeFi space with all the yield farming. But I think what's interesting here is that it's just a good sample. Like there's just one interesting place where you could actually achieve this permissionless chain, but there's plenty of other things, and especially if you're you can also work with oracles and permissionless kind of like a dispute resolution and whatnot. I mean, that will be a game changer, and we're not far away from that. I think we're thinking that it's going to happen in a few years from now. I think it will happen sooner or later, maybe even like the next 6-12 months.
What exactly do you think will happen?
I think there will be a lot of derivative markets. I think.
All right, I see. Yeah. I mean, a few things you said that I'm keen to pick up on, but I pester the engineers on the Vega team all the time. I'm like, but hang on, like the Internet of Things is this like global kind of Oracle data source, right? And I think there's still a whole bunch of problems with security, obviously, and so. That we've still got probably a ways to go. But once sort of a bunch of those problems are solved, we start to get some really interesting kind of use cases where, really, you can get ephemeral markets that spin up based off particular triggers. You get, contracts that get entered into, exited into, and there can be this entire sort of risk management layer almost that happens. And at the moment, I would say quite a lot of it, despite, the rise of algorithmic and HFT trading, but I would say like generally in terms of risk management on the planet, there's, quite a lot is done, manually through human intervention. And I sort of daydream about that, but then, the engineers tell me that we've still got some security things to figure out with IoT, and that makes a lot of sense. I traded a weather derivative, actually many weather derivatives for power markets, but it was always really fascinating to think, there's this weather station, and if a cloud comes over, that's going to have a multi-million-dollar effect on whether this triggers or not. And you're tempted to go out and get the hairdryer, and obviously I didn't do that. But it's sort of interesting to think about how the world might look in 10 years' time. And actually, I had a question for you guys, thinking about all that, and then of course all of the adjacent, sort of tech that's evolving around, predictive AI stuff, and probably stuff you guys know better than I do. Like, what's sort of the craziest derivatives or financial market that you guys could dream up that might be looking forward 10 years, might be in action, useful to humans or the environment or whatever?
I can kick off. It's a mouthful, so I'm going to say it twice.
Okay.
And then probably someone will need to translate it. But I'm thinking. So this is crazy, but we're starting. I'm very happy to see for the first time, really, since DeFi, became a thing. We're starting to see insurance in DeFi, which is a really nice and good thing. And it's impossible for DeFi to scale without proper, viable insurance solutions, because you do have this smart contract risk. Ultimately, it's the elephant in the room. Sure, your returns are great, and you can create a lot of complex and beautiful products, but ultimately, if the technology fails, it's all gone. So insurance, I believe, is really pivotal to the growth of DeFi. And, whether that's asset management or lending, borrowing, or, options derivatives. And I think, the natural evolution of that is that ultimately people will start trading the second derivatives of what we're building now 10 years from now. And I can see this is crazy, and this is probably not that original, but variance swap on smart contract insurance derivatives 10 years from now will probably be a thing.
Very nice.
So essentially trading the underlying volatility on smart contract insurance derivatives.
Interesting. Interesting. I like it. I've not ever thought of that one. I do like a good variance software.
You sound like you're more in the AI kind of.
Oh, I'm really not. I'm just curious about probably a whole bunch of stuff I don't fully understand. Yeah, that's super interesting. And I think that kind of touches on what I'm saying, whereas it's, there's this kind of, this like sort of interconnected on-chain data that's being produced and has very real kind of implications for people's risk profiles. And then, then obviously building derivatives on top of that makes a lot of sense. What do you think, David?
This is a really difficult question because there's so many strange, but I think, in general, derivatives are related to tangible things, right? And I mean, you've got metrics that are tangible, and I wonder if there's a derivative that could be that to try to measure something that's difficult to quantify, right? And an intangible. And so for instance, could there be a derivative on happiness? Right.
I was literally, you read my mind. When you said that, I thought a happiness index. Amazing.
Right. And people have talked about the world GDP is measured improperly, right? And that somehow happiness is a bigger component. I mean, they talk about the Nepal having the highest GDP in the world if you base it on happiness or something.
Wow.
And so now if you had a way to if you had a number of oracles that could measure what happiness meant, and then you could put it into some kind of metric, and in other words, something that was unquantifiable before, then you may have something that would be a derivative on something that wasn't on an intangible. Now, and it sounds a little bit insane, but then if, for instance, there were a derivative on happiness, could someone make somebody happier and hence take delivery on that derivative or something, right? So it could get, and
well,
that's where it gets a little bit hazy for me. But
yeah, it's a little interesting. I guess the connection there would be, does money make you happy? Because if you hedge, like for example, the classic example of this is you're watching your favorite sporting team and you bet against them winning so that if they lose, you have a emotional hedge, right? And is that effective? I have no idea.
And who knows, right? And anyway, so I found that kind of an interest. I've seen a little bit of writing on people discussing it, and I think it's an interesting train of thought that could yield something down the road. So
yeah, I love that. It's definitely like something I've sort of looked at in the last sort of 4 or 5 years. Just out of sort of personal interest is obviously we're collecting so much more digital data on humans, and there's sort of like a sort of almost global behavioral science growth of understanding of humans because we're capturing so much digital data basically. And that really, really fascinates me. And I think the ability to understand that a human is happy and like be able to do that on a very sort of live basis, or even a society, or like understand sort of the risks that are coming to those humans or whatever. I think that there is definitely something in that. I could see that within 10 years there are markets around that. So yeah, I really like that. I think that's really interesting. What about yourself, Stanley?
Yeah, I was thinking about this happiness thing because it's kind of like it's difficult to. I mean, because one thing is that I come from Finland, and I get it often that when I said that I come from Finland, that I know Finland, that I read that it's the happiest country in the world, and that is based on some sort of article or like some kind of like a polling or measurement that was done. I don't know exactly, but that's exactly what you could actually do. I really find it somehow like very interesting. But in terms of like how things will look like in the future, I think many things will be relying upon the data. My kind of concern now is the getting that data into blockchain is a bit expensive at the moment in Ethereum. Okay. But I could imagine like if some of the derivative trading and kind of like a settlement events could go into layer 2, that would be pretty fascinating because you could push a lot of data inside and then you're going to have the derivatives contract, and then you can settle there, and if you want actually to somehow finalize your settlement with more security, you can then go back to Ethereum actually and have the bigger security. So I think one important point is that when we are going towards the scalability and layer 2 stuff, then I think we'll see like more data, and when we get more data into the on-chain, that will be very fascinating. Then I think that people start to realize what kind of stuff you could actually do and what kind of contracts you could actually conclude and trade them in aftermarkets, and that is like the big thing I think that we need now. And the layer 2 stuff, I think people are now pushing it quite a lot. I mean, the gas price, I remember like was it a week ago or something, like 500 all above, and that's a bit insane for thinking of permissionless idea and everyone can access.
Yeah, it doesn't become everyone can access it anymore, does it? Only the whales survive. Yeah, very, very interesting. I think, on one of our earlier panels, Barney asked his panel, like, kind of what's the sort of ultimate? And then he said that his ultimate was like that you can, get leveraged trading on pretty much any asset on the planet, in a decentralized setting. And I just wondered if you guys, like, what would be like, not just like what you think will happen, but almost like what you want to happen. Like what is good look like for, the global markets and economy, and what would make you sleep better at night and happier? And I'll make this our last question actually, and throw out to the community watching, see if they've got any questions. Please pop some in the chat while these guys give us a brief couple of lines on
not too far away from where Barney is actually. I think that would make me very happy too. I think it's the underlying assumption. It's definitely the underlying assumption I had 5 years ago when we set out to start building Melon.
Right.
And it's been a little bit slow getting there. I think partly because of some of the reasons Stanley just mentioned, and partly for other reasons. But I'm also, I'm in full agreement with Stanley that as applications move more and more to layer 2 solutions, it becomes much easier to have data on chain. It becomes easier and cheaper to have data on chain. Then you also are able to incorporate a lot more in assets, in liquidity, in strategies and products, and so I'm really excited about that.
Yeah, that's really, really interesting. You guys want to add any thoughts to that?
I've got to say that your question about what product would immediately make me happier is stumping me a little bit. That's what, right. And it's maybe it's because there are so many products. I think I wish there were an option product that were fully decentralized on on say indices in the United States, for instance, that were fully liquid, right? And so that just as an immediate thought, that's the one that pops in my head. I think I don't think we're very far from that. I think we're probably, less than a year from something really working out. There's so many initiatives in this space, but I think those will be the ones that kind of start to bridge the gap between this kind of netherworld that we were talking about and kind of where we are today. So.
Yeah, interesting. And so it's really about bringing the sort of traditional markets, but expanding them, like growing that pie, basically, or like sort of expanding access across the breadth of indices, or is it?
It's about. I think that there's a gap of understanding between kind of the real world, the conventional world, and the people who are focused on this space. And something's got to be the gap that kind of brings them together, right? Or the bridge that brings them together.
Yeah.
And my initial thinking is the power of you don't want to give people too much too quickly. But the power of an Ethereum based, something that's why I was so impressed with Vega. Because what it looks like in so many ways is what we see, but it's such a bridge to what is possible. And so one of the things when I looked at your demo and I was, that to me was what got me excited about the project. And so we're just not there yet. As you're talking about we need level 2. Protocols, and we need other things. But so when I think about what gets me excited, it's what gets us over that bridge, is what I would say.
Yeah, I totally agree with that. It's about actually decentralizing sort of real world finance and use cases, and like you say, have that bridge. And I think what obviously is super important for that is the evolution of the space in general, like, the wallet providers and the UX and, all the sort of and Oracle providers, as we touched on, all the adjacent sort of, basically all the necessary ingredients for people to be able to actually, put a trade on, so that you can have your mate who isn't a crypto enthusiast be able to just go, all right, I can get exposure to this and I can include this in my portfolio. And, I'm very passionate about that as well. And like you say, I think that's what we've sort of had our heart set on right from the start with Vega, and hoping to pull off. I feel we have kind of almost there. Stanley, what about your thoughts?
I'm just reading the stuff here. Derivatives for fear and greed, measuring emotions with textual analysis. Like there's pretty cool things that you could actually
absolutely
you could actually do. Yeah, I mean it's kind of like it's getting quite interesting in the space in general. I think like even though like there's like a lot of opportunity, I'm still like wondering like how this whole thing can scale. I mean, we're actually like in Ava, we're not doing derivatives that much in terms of we do have interest bearing tokens which are kind of derivatives, but I'm just thinking like what it takes like for institutionals to see like because the way I see like I see value added as kind of like a new consumers in terms of who could consume derivatives, but also traders participating in new opportunities. But maybe it's like more of a question for you in the sense that like how like what it takes for institutions to actually start getting more involved and interested in the derivatives in general and see opportunities. I mean, what's the kind of like a bottleneck at the moment?
I mean, I think David's probably best placed to answer that. But do you mean just to be clear, do you mean sort of generally in crypto, or do you mean in decentralized finance?
Yeah, I mean, and I know that kind of like there is some institutionals in DeFi, but what it takes to actually like people to understand and the opportunities, and also kind of like shield them a bit in the in the institutional side, because I remember when blockchain was a thing in 2016, 17, and the value proposition was quite big, and institutions were talking about it, and there wasn't any infrastructure, any applications that much. But now we have DeFi, we kind of understand the opportunities, but what it takes the institutionals to basically talk about these opportunities and build bridges.
Well, I think there are a lot of institutions that are trying to put their toe in the water, but afraid to go in the deep end at this end. And I think the biggest issue for most institutions, and speaking, is really making sure there's proper KYC AML that's been done, and that's obviously one of the issues around the DeFi space. How do you ensure that? And I think a solution. Such a solution will be necessary before institutions get in any big way. My personal feeling. Now, Ethereum has got some interesting things that they've worked on in that, and I think there are some other protocols like I look at Civic. I don't know if you have ever seen that, but that's kind of that has real possibilities for being something like a digital passport or something. I'm mentioning it without having But I think that's from my perspective and from with whom I speak, those are the biggest hurdles that for institutions kind of getting in.
It's really interesting. I mean, we really need to wrap up really soon. I just saw the time, and you need to jump on another call, David. But in terms of sort of the way, the assumptions that underpin KYC AML and sort of people's identity and their permission to trade, I'm very, very curious to see, maybe more in the 20 to 30 year time frame, like how that looks. Like, do people build up actually an on-chain identity and proof of citizenship and good behavior and so forth? Something I muse about. I don't know if anyone else does.
I know what you mean. If it's not done properly, then it could actually end up having the absolute extreme opposite effect of what was initially intended with the whole blockchain movement. But it will be interesting to see.
Yeah. Well, guys, I think we have to wrap up. I'm really sorry this went so much faster than I thought. I really, really enjoyed talking to you guys so much. We do have some questions that are unanswered, but we do have some community Discord, so I might just transfer them